Whether you're a complete beginner just getting into trading or you've been trading for some time but you're still not consistently profitable, this is the last trading video that you will ever need if you want to become a consistently profitable trader. I'm going to take you step by step throughout the entire process from start to finish, from a complete beginner to, by the end of this video, becoming an expert and helping you when it comes to making your first $5,000 or $10,000 trading and becoming a consistently profitable trader, or like myself, a full-time trader in the future. And if you don't know who I am, I'm Arkham. I've been trading for the last 6 years, been consistently profitable, and a full-time trader for the last 4 years, and coach helping new or beginner traders and consistently profitable for the last 2 years. This is my overall P&L calendar, having well over a 70% win rate, trading every single day with my students. I've been able to make well over $13,000. You can see here on the dashboard, just like the broker statement here, right? Made well over $13,000, made well over $13,000 on just one of my multiple accounts. Here on my trade comp here, I manage well over $730,000, making anywhere from 5 to 10K or even sometimes 15K per day. And throughout my entire trading career, I made well over $300,000 in total payouts. If you're just getting into trading or you've been trading for some time, I want you to know that it is possible. If someone like me who grew up very dirt poor in Haiti is able to come to America and make well over $20,000 a month trading, you can do the same with much more opportunity than I even had. So it is possible and you can do it, and I want to help you the best way that I can along your trading journey to make sure you get there. So if you want the most value from this video, I strongly urge you to grab a notebook, to grab a pencil, and to take notes throughout the entire thing. This video is very long. It took me many hours, many days, and many weeks to come together. So I urge you to really pay attention, take notes, and watch till the very end. It's step by step by step. If you want to become a consistently profitable trader and change the trajectory of your life, I strongly urge you to really take this seriously, take notes, pay attention, and do the best that you can to learn and implement into your own trading so you can become consistent. And since this took me so much time to make, I would really appreciate if you guys can go to the bottom and click that like button. This video took me many weeks and even months to make, and it only takes you 1 second to click that like button. Will really spread the word to other traders who may need this information to help change their life as well. So it takes you 1 second to click that like button, and I really appreciate it. I've helped well over 200 plus students become consistently profitable. So if you really get value from this video and you want to work with me directly, helping you learn how to trade and become consistent in reaching those milestones, make sure to click the first in the description to learn more about the Arkham University. Once you click the first in the description, I want you to watch that video, and then from then answer the questionnaire, tell me more about yourself, and then from then book a completely free call to talk to me personally. Let me see where you're at in your trading journey and how I can help you. With all that out of the way, let's get into the first lesson. First thing that you want to do is you want to go to your browser and you want to type in Tradingview. So trading right here, and you want to click on the first link, which is Tradingview. Tradingview is our charting software. This is where we see the charts. This is where we place our trades. This is where we utilize everything that we need to becoming a trader. So this platform is going to be your best friend. So I urge you guys to bookmark this right now. First thing that we want to do coming into Tradingview is we want to get the right subscriptions in place. What we want to do here is we want to go up here to the products and we want to go down to pricing. You don't have to do this yet as we're still in the beginning, but later down the road within your trading journey, you want to invest in yourself. When it comes to Tradingview, it's very, very worth it. So we want to go to monthly and start off with the essentials package. So this is only $15 a month. The next thing that you want to do is go back to products and you want to go to market data. You want to scroll down from the market data and you want to find the CME group. Right, this CME group is futures. Specifically, if you're in the United States or Canada or even around the world, right? Futures is one of the best assets that you can trade that's very consistent. So for you to trade futures and utilize futures, you have to get the CME group data. It's only $7 a month. All in all, from the essentials package to the CME group, only paying $22 a month. And this is very worth it when it comes to charting and just overall getting everything set up with the real-time data, as well as being able to backtest, as well as practice on Tradingview in the future. So after watching this video and going through all the education and everything I'll teach you, you want to sign up for these two packages. Now let's get into the charting. So you want to go up here into the search to type in ES, right? This is the S&P 500 and you want to launch the chart. Chart may look a little bit different from mine, but that's totally okay. Let's get you started with the charting colors. What you want to do is you want to double click on these candlesticks right here. And this basically lets you change the colors. So these are my specific colors right here. Me personally, I utilize this green right here, which is number 529D55. But if you want to change your color to blue, you can. If you want to change it to, let's say, pink, you can. Purple. If you want to change it to orange, yellow, whatever you want, you can. This is when price goes higher, you can see a green candle. Now, when price goes lower, I personally utilize black, and I teach a lot of the students to utilize black. What you have to do is come here to black. You want to click on the black down here, and you want to set the opacity to 80%. So the opacity for the body is both 80%. So whether you choose purple, red, green, right, whatever you use, right, you want to set the opacity to 80% for the green and the black. And for the borders, you want to use it a darker color. So let's say I utilize a light blue here. For the borders here, I utilize more so of a dark blue. And this gives you that ambiance right there. So since I have this as green right here, I utilize a dark green right here. It creates that ambiance or that shadow. Obviously, this is black 100% opacity, right? 100% opacity right there. And for the wicks, both black right here. So this is setting up the colors for your candlesticks. Now let's create our subcategories for our chart. What you want to do is you want to go up here and you want to create a new section. In this new section, so you want to double click on this new section and you want to call this futures. Under this futures, we want to put our specific charts. So first we're going to put the ES. So ES1 right here. And we want to put the NQ, the S&P 500 and the NASDAQ. Now we want to go back up here and we want to create a new section below. This is our future section. Now we can call this the Forex section. This section we want to put EURUSD, right? And we want to use the Wanda. So essentially, so this is Euro USD. Next, we want to put GBP USD right here, utilizing a Wanda again. So this is GBP USD. Then we want to put AUD USD. So this is the Australian dollar. So we have Australian dollar, the GBP pound, and then the euro dollar right here. So this is Forex. This is more my international traders who want to trade Forex, whether you're in Europe, Australia, the UK, whatever. That's Forex. And then last but not least here, we want to create a new section and we want to call this section commodities. Specifically under this section, we want to put XAU USD right here. We want to put XAU USD on Wanda. Or for futures on gold, we want to put C. So we want to put GC right there, GC1, bam. So this right here is gold. It's a commodity, right? We all know you're on gold bars and silver. If you didn't know, you can actually trade the gold bars and silver, and a lot of traders do trade gold. It's very consistent, very repeatable, and it's a pretty good market. Our futures, which is the S&P 500 and NASDAQ, and we have our Forex, which is Euro USD, GBP and AUD and then we have our commodities, which is gold, XAUSD, and GC for gold futures for the futures traders. The next thing that you want to do is you want to set up your time frames. So I want you to come up here and you want to set up these specific times, right? I want you to go to the daily and put a star next to it. Put the daily and put a check mark to it. Then I want you to come to the 4 hour, star next to it as well. To the 1 hour, put a star next to it. I want you to come to the 15 minutes and put a star to it as well. You have the daily time frame, the 4 hour time frame, the 1 hour time frame, and the 15 minutes time frame. Right? This is what we call a top-down analysis, and we'll utilize this a lot more later down, but this is very important. We have it set, right? We have our specific markets that we're going to trade. Either you're going to become a futures trader, Forex trader, or a commodities trader, and we have our specific time frames that we're looking at. Next, let's talk about the tools. So this is how we actually chart on this market. So you want to come up here, and there's a whole lot of different tools, but these are specifically what you're going to need. First is the trend line. So you want to come up here to this long line right here. I'm going to click on the little arrow right there. Basically marks out all of your different tools that you're going to utilize. Right? I want you to put a star next to the trend line and put a star next to the horizontal ray. So these are the two specific tools that we want to utilize, and it basically creates a taskbar up here of all the different tools. So first is the trend line, and then the horizontal ray, as well as you can also put a horizontal line as well. That's okay. Then next we want to get into this paintbrush right here. You can see this paintbrush, the little arrow right there, and we want to mark out the rectangle right here. So this is the rectangle. We want to mark out that rectangle right there. Gives us some specific tools. We have the trend line right here, have the horizontal ray right here, and then right here we have the specific box. Obviously, when it comes to a box, it's going to look a little bit different. So you want to change your color here. So right here, this is where you change the bucket color, basically the main color of the box. So we can change it from yellow, green, red, right, all this stuff. And you want to put the opacity to around 26. If it does have a middle line within that box, all I have to do is remove that middle line right there. So this is a box, and this box can act as our support and resistance levels. So we can see price came back within this level. It was not able to continue going higher, and then we seen this drop lower. So this would be referenced as a level of resistance, as well as something like this, where we can see price comes down into this level, was not able to continue going lower before pushing back higher. So we would reference this as green right here, and this would be our level of support. This is going to be important later on. Regular line is simply to mark out original high points and original low points. Right? These are the specific tools that you generally need within trading. That's pretty much about it. We set up our trade view. We got our specific markets. We got our time frames. Now let's get into the next tool, and that's Forex Factory. We go up here and search up Forex Factory, how we read the fundamentals. So there's specific news that comes out within trading, and you want to pay attention to these fundamental events that happen, and we don't want to be trading before they occur because that can be very bad. So this is where we keep track of everything. And when it comes to Forex Factor, this is what it's going to look like. And what you want to do is you want to come up here to your calendar. Your calendar, you want to come up here, screen funnel right here. We're going to check off everything like AUD, CAD, CHF, right? If you are someone that is trading Forex, let's say you're trading the AUD USD, you obviously want to mark out the AUD as well as the NZD, right? But if you're someone who's trading, let's say GBP USD, you want to mark out GBP, right? As well as the USD. If you're someone who's trading Euro USD, you want to mark out the Euro and the USD, right? This is more so later on within the trading, but this is how you take a note of the general news and events coming out. So at the moment, let's just mark out all of them. So AUD, NZD, GP, Euro, NZD, USD. And you want to mark out the red folder, orange folder, as well as the gray folder. Red folder is when we have major news that comes out. This is CPI inflation data. This is non-farmer payroll, basically the jobs data, right? These are fundamentals that happen that drastically affects the market. Don't want to be trading before these times that these news and events come out because they are very volatile and dangerous. So it's very important that you keep note of the fundamentals that take place. Here we have all the news data that comes out. So specifically here, when I'm recording this is a Tuesday, and we can see here that around 10 p.m. we have news on NZD USD. So if you're trading later today during the Asia session, which we'll talk about later on, you don't want to be trading before 10 p.m. because we have 10 p.m. news that's very dangerous. Same thing like tomorrow. Tomorrow we have 2 a.m. news, which is CPI for GBP USD. So if you're trading GBP USD tomorrow during the London session, which we'll talk about the sessions and the times later on throughout this video, you don't want to be trading before 2 a.m. So this is just a way to keep track of what's happening throughout the week and when you should start trading, what days to avoid, and everything like that. Pretty much it. These are specific tools that you need to bookmark and save within your dashboard. And this is what we're going to utilize throughout our entire trading journey. Now that we have the exact tools that we need, let's get into the education part of trading and how to actually make money. First, starting off into trading, let's talk about candlestick analysis. Candlestick analysis is the cornerstone of the market. Each candle has a particular story, and each type of candle tells a different story. This is where your trading journey begins, and you'll learn about candlesticks and how you can use them to frame a picture. Right? And there's millions of patterns out there when it comes to trading, utilize these candlesticks, but we're just going to focus on a couple. First is an engulfing candle. Right here to our left is called a bullish engulfing candle. This is where we can see price open up. We can see price come lower to create this low, and then we can see price push higher to create this high. This is where we can see price close. And the main focus of a candlestick is from the opening to the close. If price opens up lower, and it closes up higher, this is what we call bullish, which is good. As price went higher, when price opens up and it goes lower and closes lower, this is what we call bearish, which is bad. This is when price closes below that opening. So if we open up and we go higher and we close higher, that's good. If we open up and we go lower and we close lower, that's bad. Right? And this is called a bullish engulfing candlestick, and this is called a bearish engulfing candlestick. And this is an engulfing candlestick because we can see here that price closes with a strong body. So the bottom right here from the open to the low, and the top from the close to the high, this is referred to as our wick. The middle part from the opening to the close is referred to as a body. When you have a big body, this is referred to as an engulfing candle. Same thing right here. The opening to the high as the close to the low, this is referred to as our wick. The opening to the close, this is referred to as our body. So when we have a big body right here, right, this is a bearish big body, and this is a bullish big body. This is referred to as our bullish engulfing candlestick and our bearish engulfing candlestick. Next candlestick we want to talk about is the doji. Right, this is when we have a small body. You can see right here, price from the close to the high creates this long wick, and then right here from the opening to the low, price creates this long wick as well. But we can see here that the body is small. This is called a doji candlestick. Basically, a doji candlestick is an indecision candlestick, right? We don't know if price is bullish or bearish. It's kind of in the middle. When you see price open up and go higher like this and close with a strong body, we know that price is bullish. It wants to go higher. But when price is kind of in the middle here and it doesn't know whether it wants to go higher or lower, this is called an indecision candle. We'll refer to this in the next lesson, but this is very, very important to take note. So this is a engulfing candlestick, and this is a doji candlestick. The next, we want to talk about rejection candles. So this is where we can see price open up and it creates this long wick to the downside for coming back higher, right? Creating this push higher, referred to as a bullish rejection candle. This is where price opened up and it was initially going lower. It was not willing to continue going lower, meaning that most likely it found support, and we see this strong rejection to the upside. This is a great indication that price is bullish or price is wanting to go higher, because the fact that price opened up and it went lower, so low, creating this long wick, but it was not able to continue going lower before seeing this push to the upside, is kind of like a slingshot. When you take a slingshot and you pull it back, and it fooms, that's good. Here we see it open up, it comes lower, and then it zooms back higher. That's a slingshot, and it's a great candlestick confirmation to note that there is strong volume. Vice versa can be said for a bearish rejection candle. This is where we open up, price goes higher, but it cannot continue going higher before it slings lower. So you can see here, opens up, goes higher initially, creating this long wick to the upside, but it cannot continue going higher before it slings back lower, closing bearish. So this means that no matter how much price tried to go higher, it just couldn't continue going higher, and it slung itself back lower, meaning that most likely that price wants to go lower, because we have to understand in trading, price can either go higher or price can either go lower. So if we have the right signatures that show us that price is now willing to go lower, we can anticipate price going higher. Same thing for the right signatures that show us price cannot continue going higher, then that forces us to give us the idea that price wants to go lower. These are the three most consistent candlestick patterns that happen within the markets that we can utilize when we're trading. So let's talk about candlestick narrative. Right, candlestick narrative is when we piece together a story. When you have a market where candlesticks consecutively go higher, this is called a bullish market, right? We can see price going higher. This is a bullish market. The other hand, when you have a market that have candlesticks consecutively going lower, this is a bearish market. We can see price going lower. This is a bearish market where price does not want to go higher. It's going lower, right? How you make money trading is either you're anticipating price to go higher and continue going higher, and you make money off of it going higher, or you have the idea that price is going lower and you, what we call, short it which when price goes lower, you make money. Trading, price can only go higher or lower. Those are the only two options. And your job as a trader is to piece together a story to tell why should price go higher, why should price go lower. This is the first part of our candlestick narrative. The next we have is a reversing market. So this was a bullish market where price was going higher. This was a bearish market where price was going lower. Now we have a reversing market where we can see prices going from lower to now higher prices. And the first indication of a reversing market would be our doji candle right here, which is represented in yellow. This is our indecision candle, where we can see here that price reaches a level to where it's kind of in the middle. Doesn't know whether it wants to go higher or lower. This is our indecision candle, where we don't know if price is going to go higher or lower, and it's kind of just here in the middle, right? And this is one of the first indication that the market has reached a level to where it doesn't know whether it wants to go higher or lower, and most likely we could see a reversal taking place. And then this right here is when we get that rejection wick, where we can see price opens up, it comes lower, but you can see it could not continue going lower before seeing this slingshot to the upside. This is a reluctant sign. See, this is indecisive, where price reaches a level to where it cannot decide whether it wants to be bearish or it wants to be bullish. So it's kind of in the middle. That's a hint of a potential reversal taking place. And then we have a reluctant idea where we can see despite price opening up and going lower, it was not able to close lower, meaning that when price went lower, it was able to find a support, and we see this slingshot push the upside. So from this indecision candle to this reluctant candle, this gives us the overall idea that price cannot no longer continue going lower, and instead, most likely we're going to go higher, which we can take note of this next candle right here, seeing this big push to the upside. So as the market was going higher, you were buying, right? And whenever the market continued going higher, you made money. As the market was going lower, you were selling. And every single time the market was going lower, you made money. And price reached a level to where it could no longer continue going lower. This is your indication that price is reversing from one direction to another. So instead of selling when you see these specific patterns, you want to be buying, which you can see price went higher and you made money as it went higher. These are the three market conditions that happen. Either it go higher, either it go lower, or we're in a reversal where it's going from lower to higher prices or higher to lower prices. It's very, very important within your trading journey. Next, we're going to go over the most important lesson you're ever going to learn in trading, and that's market structure. When it comes to market structure, we have to pay attention to these three aspects of it. Type would be obviously an uptrend, right? This is where the market creates these consecutive higher highs and higher lows within the market. Hold on now, stay with me. The second would be a consolidation. This is where price remains within a range. This is also known as an accumulation. Basically, price doesn't really go anywhere and it kind of goes back and forth between these lows as well as between these highs. Then last but not least, this would be our downtrend. This is where price creates consecutive lower highs and lower lows. A higher low would be when a low is higher than the low prior. So this right here would be our starting low. And you can clearly see that this low right here where price creates this what we call pullback, right? Where price pulls back. This is where price creates this higher low before creating this next extension, which this new high is much higher than the high to prior. So you can see this high right here. This high creates a higher high, higher than the prior high. This high up here creates a higher high, which is this high that's higher than the high to the left. And right here, this is the low that's higher than the low to its left. So it's pretty simple. Higher highs and higher lows means that the market is going in an uptrend where it's consistently going higher, meaning that whenever price comes lower, you should not immediately be looking to sell within the markets, yet you should be comfortable with the idea that for a uptrend to happen, price has to give pullbacks. So when you see the market pulling back, you're not looking at it as fear, but you're understanding that this is just the basic fundamentals in trading. A lot of times, whether long-term investors or traders, they would see that the market is going higher, and the moment that it starts going lower, they start thinking a reversal is taking place, but that's not true just yet. This is simply a pullback before we create a new extension. This happens all the time. See, price creates these higher highs and higher lows. This would be our uptrend. And right here, this is where price creates equal highs and equal lows. For this high right here is the same as the high prior to it. Same thing right here. This is where the high is the same to the high prior to it. This is the same as the high prior to it. Same thing with the equal lows. This is where this low is the same prior to the original low. This is where this low is the same prior to the equal low. This low is the same prior to the equal low. So usually when you see a condition to where price is creating these relatively equal highs and relatively equal lows, this is what you can classify as a consolidation taking place. Price isn't necessarily going higher, but it's also not going lower yet. It's kind of like ping-ponging within the specific range. Last but not least would be this overall downtrend. And just like how the market is in an uptrend, creating higher highs and higher lows, the opposite can be said for a downtrend. We can see price creates this low, which is lower than the low prior, and it creates this high, which is lower than the high prior. So whenever you see the market creates consecutive lower lows and lower highs, this would classify as a downtrend. Trade isn't always as simple as the market creates these lower lows and lower highs, so we should just wait for a pullback and sell to continue going lower. Not necessarily. Some situations might happen where the market creates lower lows and lower highs, and then it starts to what we call reverse, where instead of going lower, it starts to reverse and start going back higher. And this is where a lot of traders can get faked out. They see price create this lower high right here, and they try to short here, and then the market reverses on them right there and goes completely against them. So this is how to understand when the market is going to reverse on you, going from one direction to another. As this is how to avoid situations to where price may be in a downtrend, may take out this high. Instead of seeing this as a reversal, market continues lower. So I'm also going to teach you how to avoid this trap or this fake out. Whenever you're looking at market structure, you want to pay attention to the lows as well as you want to pay attention to the highs. You have to understand you don't immediately just sell when the market is going higher, right? You can clearly see that this is where we started up here before we start creating these lower lows. Low right here, we had this lower high right here. Obviously you would see price come higher, create this lower high right here. You would probably frame a short to then target back below lower prices to continue even lower. This is the general gist of market structure. But the thing is, you don't always want to short here within the pullback, but instead you want to be patient. The market pulls back like this, creating this lower high right here. Pay attention to this level right here, this last down closed candle. This level right here at times can be a level of support. The market can come down into it, find support, and reverse. Same thing can be said with this last up close candle right here. It could be a level of resistance where the market can come up into, find resistance to go lower. Market structure is simply just where is price going next. Clearly see price creates this lower high, it comes lower, but it fails to take out this low. To this situation to where you can clearly see price creates this lower high, it breaks through this low and continues lower. Now, what was the main difference? Main difference is to pay attention to the lows. The market is in a downtrend, it should easily break back below prior lows, as well as it should struggle to take out prior highs. In this case scenario, we can clearly see that the market creates this pullback, then we have this next low below us, which is a next level of targeting. It's because price creates this pullback, creates this lower high, does not mean we immediately buy just yet. Immediately buy based upon the reaction from it. But once price creates this lower high, this is a good sign that price respects this previous high, meaning that it's still bearish. The thing is, we still have this low right here. Off of this rejection, we're anticipating price to come lower and create a potential new low. When we want to see price create a potential new low, we want to see strong, what we call displacement within the market. Basically, strong momentum coming back lower into that original low. And you can clearly see when price creates this lower high, price struggles. It comes lower once, comes lower twice, then it sees this pop to the upside. Looking for a strong bearish move, this is not what you want to look for. You want to see price create a lower high, then immediately start seeing strong pushes to the downside. This means that sellers remain in control. We're seeing strong displacement take place. Whenever you see price create a lower high and then it struggle to take out this original low, this means that buyers are starting to step in and it's harder and harder for the market to continue going lower. So eventually the market is going to see a pop higher, which is exactly what happened. So the main difference is when price creates this lower high right here from this prior lower high all the way back up here, see the market pulls back. Once price comes back within the same level, sees a strong push to the downside. At the moment that you see strong displacement to the downside like this is when you can frame your short and your stop loss back above this candle high, back below these lower prices. Find yourself in this situation where even though yes, the market is in a downtrend, where it creates this prior high right here. So essentially same thing with this situation. It creates this prior high and then you see strong displacement to the downside. So as the market strongly displaces away from it, you can frame a short, stop loss back above this high point, reaching back below these lows right here for a quick scalp 1 to 1 hour. Difference between this situation right here, even though the market creates this pullback right here, you can clearly see it's not seeing strong selling momentum. Instead, once the market reaches down to this level, it starts to consolidate, and it sees a pop higher. That you see the market fail, right? This is what we call a failure swing. It fails to take out this original low, and instead it's now breaking through this original high point. This is your indication that a reversal is taking place. So at this point, I want to see, is this reversal confirmed? Is price going to pull back, and is it going to hold within this level to then see a push higher? So that's what I'm looking for. I want to see the market pull back. You see it does end up pulling back right here. And then from that pullback, you can clearly see the market breaks back above this high point. So the moment that the market breaks back above this high point, I can frame along my stop loss back below this low. Now I can target back above these highs to 1 hour. Clearly see price ends up finding supports all the way back up there. The biggest takeaway that you can learn from this second trade is how we waited for that additional confirmation. Too many times a lot of traders get into predictive trading where they see that the market is in a downtrend, they wait for price to create a pullback, and then they immediately short within the market, stop loss back over this high, anticipating lower prices, like creating consistent lower lows and lower highs, right? That oversimplification. A lot of times what happens is price will come lower, go into profit for a little bit, then it starts to reject and then goes against them. The reason why that happens is because you did not wait for the proper confirmations to confirm that the market was going to continue even lower. Just because the market creates a pullback doesn't always necessarily mean that it's going to continue even lower. In this situation, from that pullback, you want to see market make a strong break lower. That strong break lower then gives you that confirmation that sellers are within the market, and this would be your proper trade idea to then take. Firms that selling pressure is within the markets, it's going to break back below this low point. You only want to take trades that make the most sense and that are the easiest to capitalize on. This trade was very easy to capitalize on. We've seen that price create this high, create this lower high, then it created another lower high right here. Market creates this lower high, it sees this strong push to the downside. So following the strong push to the downside already gives us momentum that sellers are within the markets, and we can sell within this candle, putting our stop loss back up here, reaching all the way back down lower prices, because the confirmation was strong displacement, strong bearish engulfing candlesticks looking back below these low points. Compared to this trade idea, a lot of traders waited for price to pull back, and a lot of traders their sell up here, putting their stop loss back up here, reaching back below lower prices, but they don't understand that this is predictive trading. You're simply predicting that the market is going to come back down here and take out this low. It doesn't necessarily have to. You always want to wait for that confirmation to confirm price is going to take out that low, or if it's not, that confirmation was based upon right here. The market failed to come lower. It rejected from once, rejected from it twice, rejected from it 3 times. Then we seen this break to the upside. This indicates to us price is not trying to go lower anymore. Now it's seeing this break higher. Following this break higher, we can then wait for a pullback. Like I mentioned, we're not immediately just buying within the pullback. Once price creates this pullback and then we see a breakaway from it, this is when we then buy, reaching back above these higher prices. And you can clearly notice the stark difference between predicting that the market's going to go lower versus waiting for the additional confirmations give you a better trade idea. You wait for that additional confirmation. Yes, it takes a little bit more time for the trade to pan out, but it guarantees you the difference between the trade not working out and you get a new trade idea, which in this case we were looking for lower prices, we ended up taking higher prices. But this is the stark difference between taking just any trade in predictive trading, basically gambling, versus taking an educated trade. Educated trade was price was not trying to go lower, and we seen a break higher. So off of the pullback from that break higher, it gave me the confirmation that buyers were now in control and we could anticipate higher prices. Trading isn't always as simple as follow this pattern higher or lower. A lot of trading requires critical thinking skills, waiting for the proper confirmations. This is something that no one's really going to teach you because it's easier to tell you it creates lower lows and lower highs, follow the trend. It's easier to tell you that rather than telling you that, you have to use your brain a little bit, not just follow every pattern out there. And that's why I'm one of the realest traders, because this channel is not about following patterns. It's about how to make money. How to make money trading is not easy, but can do it. Next idea here, you can clearly see the price is in this uptrend. It creates this low down here, and it creates this new higher low right here, this new higher high right here, creates this new higher low right here, and it creates this new higher high all the way back up here. Obviously, within this case scenario, right, if you follow just a simple pattern, it tells you it creates this higher high, higher low, higher high, higher low. This is the pullback to maybe continue going higher. Like I mentioned, we're not just following simple patterns. Yes, this is a uptrend and this could pull back, continue going higher. We're not just going to immediately just buy here. Instead, we want to see the market pull back higher. If price makes an effort to break above this level, then we can frame a buy, reach back over these highs. But if the market comes back up here and it consolidates and runs away from it, then we could frame a short, then see a reversal taking place. So at this point, even though we're in an uptrend, we're not going to try to predict the market. Instead, we're going to wait for the right confirmations. So we can clearly see that the market pushes higher here, gives that pullback right there, and it consolidates for a little bit. And then right here, bam. Once the market pulls back like this, and then you can clearly see it start to consolidate. This basically tells us the price is not willing to continue going higher. It gives us the idea that once the market aided this high point and then it created this low, buyers stepped up. Yes, they stepped up to push higher, but they were not strong enough to create a new high. Now this tells us that sellers are in control. At this point, once price breaks back below this low point or just off of this strong displacement lower, we can frame a short setup. We're anticipating the market to continue going lower. Put our stop loss back with this high. We're simply just targeting below this next recent low. You can clearly see that the market ends up finding resistance right there and it gets all the way back down there. Perfect. This is the real market structure. Had the initial idea of higher prices, you can clearly see that the market was not willing to continue going higher. The moment we see that sellers are in control, we simply just ride the wave with them. Not about predicting the market, it's about riding the wave. If the market pulled back here and it's seeing a strong bullish engulfing candlestick, that would have meant buyers were in control, and I would have bought here anticipating us to break above this high and continue even higher. That's not what happened. What happened was when the market created this pullback, struggled to continue going higher, instead seeing this break to the downside. So this tells me sellers are within control. As long as the sellers are within control, I want to be selling in alignment with them. So I sold right here, anticipating us to continue going lower. Trading can really be this simple. It's not about trying to be perfect. It's not about trying to predict the market. Simply by identifying who is currently in control. Is it more buying pressure or is it more selling pressure? How can I be in alignment with one of them? Understand that as a retail trader, you cannot control the market, so trying to predict them is not going to work. Instead, if you see strong selling pressure like this happens, you sell with the sellers. You see strong buying pressure like this trade right here, where you can see it gave this pullback, then we see this strong bullish engulfing candlestick and it continue higher. This would be strong buying pressure which you can buy from, anticipating higher prices. It's not about predicting the market, it's about catching the wave. And this is simply just the first lesson when it comes to market structure. The next video, we're going to be going advanced market structure, covering things like breaker structure, change of character, and so much more that's really going to help your trading. What's going on, guys? Welcome back to another video, and in this video we're going to be going over the complete guide when it comes to understanding market structure. Right, the problem on YouTube is just like how people can overcomplicate trading, a lot of times on YouTube people can oversimplify trading. Right, you've probably seen the basic market structure videos. Price creates lower lows and lower highs and you wait for a pullback to continue going lower. Even though this is good advice, it's a little too simple for most people to understand. While you can watch a YouTube video, go onto a charts and not being able to see it or being able to implement what you just learned. And that's exactly why I created this YouTube channel and exactly why I'm creating this video. By the end of this video, I want you guys to take notes. So by the time you go onto charts and ready to put this into action for yourself, you actually understand what you just learned and you can implement it into charts and become a much more consistent consistently profitable trader. And first we need to talk about the different types of market environments. And these are the three different market environments that take place on a consistent day-by-day basis. Either the market is in an uptrend, creating consistent higher highs and higher lows. Either the market is in what's called a ranging market, or what some of you guys may know as consolidation, where prices creating equal highs and equal lows, basically chopping around in a specific area. Or the third, which would be a downtrend, where prices creating consistent lower lows and lower highs. These are the three specific market environments that happen consistently. When it comes to identifying uptrends, it's pretty simple, right? This is where you can see that price creates a higher high and then we create a higher low, right? A higher high is basically when this high right here is much higher than the high to its left, and a higher low is basically when this low right here is much higher than the low to its left. To uptrends, you want to specifically pay attention to these lows. Right? If the market is in an uptrend, it should not be breaking back below specific lows. Whenever a market is creating consistent higher highs and higher lows, where it's respecting previous lows and not taking them out, but it's disrespecting previous highs and taking them out, this is how you know that you're in an uptrend. It disrespects, basically breaking above original highs, and it respects previous lows, not breaking below them. You would identify a ranging market is when the market is in a specific level to where it's not necessarily going higher, but it's not necessarily going lower either. It's when price creates these consecutive highs and these consecutive lows within a specific range. So during these ranging markets, you don't want to be trading. What you want to do during a ranging market is you want to be patient and wait for a shift to take place, something like this. So if price was creating consecutive higher highs and higher lows, we would be necessarily buying, because obviously the market is going higher. Whenever the market is ranging like this, we don't necessarily want to be doing anything, but we want to wait. In this case scenario, price breaks lower, right? And then we start the downtrend, right? And the downtrend is pretty simple. It's when price creates lower lows and lower highs. Low is when a low is lower than the previous low, and a lower high is when a high is lower than the previous high. So during this ranging market, we're patient and we don't trade at all. In the moment that we see price start to create lower lows and lower highs, this is when we can now short the market. Basically, we want to see the market continue going lower. Whenever we short the market, every single time that it goes lower, we make money. So within trading, you can make money when the price is going higher, as well as you can make money even if the price is going lower, right? This is the beauty in day trading. Whatever market environment condition, it could be even the Great Depression, you can make money trading. Whenever we're identifying market structure, we always want to be on the 1 hour's time frame. So on your time frames here, you want to go on the 1 hour. So this is when you're marking out your higher highs, higher lows, your lower highs, lower lows. Basically, whether the market is in an uptrend or whether it's in a downtrend, you specifically want to be looking at the 1 hour's time frame. The higher time frames is going to hold a lot better than the lower time frames. So whenever you're marking out your market structure, whether an uptrend, downtrend, you always want to be on the 1 hour's time frame before you start trading. To look at this example, it's pretty simple, right? Obviously, price is currently in an uptrend. Like I mentioned, whenever you're identifying market structure, always want to pay attention to the lows, right? If price is in an uptrend, it should respect previous lows. Clearly see here that price creates this high and then we get a pullback, right? This is called a pullback, where price pulls back within the markets before continuing even higher. We're going to be talking about this more in our next example. Following this pullback right here, you can clearly see that price does not take out this low. This means that price respects the low. For prices in an uptrend, it should respect previous lows within the markets for continuing higher. The moment that we see price respect this low, followed by this break to the upside, gives us the overall confirmation that price is in an uptrend. This now becomes the next higher low. This was our first low point right here, and this is now our higher low. So this is our next low point that we should expect price to respect and not take out. You can clearly see, followed by this push to the upside, higher to create this higher high right here. Bam. Following creating this higher high, price has to pull back. Price is pulling back. We should expect price to not take out this low. We can clearly see that price pulls back, does not take out this low before pushing higher. And where is it pushing higher to? Higher back up into this previous high point, creating a new higher high. This right here is our new higher low. And this would be an uptrend, right? It's specifically paying attention to these low points. Price should respect previous lows and price should disrespect previous highs. This would be our classification of an uptrend. Higher low, higher high, higher low, higher high, higher low, now a higher high. Pretty simple and easy to understand. I hope you guys are getting it. To our next example here, we're going to be going over downtrending markets, and this is going to be a little bit more technical, so stay with me. Obviously, when we're looking at downtrends, it's when price is creating lower lows and lower highs within the markets. For our first example, I want to take note of this high right here. This was the highest high point for seeing this drop to the downside. That once price created this high point, disrespects this previous low right here. Bam, would be our high right here. This right here would be our lower low, where price creates a low that's much lower than the low to its left. This right here is our respected high, right? Respected high, meaning that price should not come back up here. That when price pulls back, it should not come back up here. So you can clearly see right here that price pulls back right here before seeing this drop to the downside. This right here would be our lower high, our lower low, where price created a low that's much lower than the low to its left. And this right here is our lower high, where price creates a high that's lower than the high to its left. As price creates this lower high, you want to take note of the most recent low before creating that high point. So this right here was our most recent low. Bam. So the moment that price breaks back below this low point right here is now our new lower low. Right here, extended forward, lower low. We can clearly see price comes lower, takes out this previous low. This is that lower low. Goes back, specs this high, does not take it out, lower high. Now that we create this lower high, see price break back below that lower low. Bam. Now that we broke back below this lower low, we want to see the market pull back, right? And when it pulls back, we want to see it respect what? Respect the lower high. This right here was our last most recent lower high. You can clearly see price comes close to it, but it does not take it out. Exactly what you want to see. It does not take out that lower high, but we take note of this lower low. Bam. Right? You don't want to be shorting here, right, off of this pullback, because why don't you want to be shorting there? Because it did not take out this low right here. You want to see the market take out this low and then pull back to short to continue going lower. It's very important that you don't get tricked within these markets. Some situations might happen where you can see it fails to take out this low, and then you might try to short here and then it takes you out before going lower. So you always want to make sure that whenever you're shorting within the markets off of a pullback, it creates a new low, then pulls back, respects that previous high. Right here was our most recent lower high. You can clearly see takes out this previous low and it respects that previous high. You see price take out a previous low and then respect a previous high, and then we see it start to go lower. This is where you sell within the markets. Right here. And this is how you actually trade market structure. It's not just about market creates lower lows and lower highs. That's a little too simple, right? It's about paying attention to the key details. And this is what my channel is about. It's those key details in trading that you may not even know make the biggest difference within your trading. Key detail is price has to take out a previous low and it has to respect a previous high. Once you can get both of these confirmations and you see the market go lower, this is exactly where you're short, and you can see, bam. This right here would be a ranging market, and a ranging market is pretty simple. It's where price isn't necessarily creating lower lows and lower highs, as well as it's not really creating higher highs or higher lows. Look something like this: equal highs and equal lows, or every single time it takes out a low, it takes out a high, then it takes out a low, takes out a high. Basically, it's in a state to where it doesn't know where it wants to go. And during these situations, especially as a beginner trader, you don't want to be trading these type of markets. And this is exactly what I'm talking about. You can clearly see that price creates a lower high right here, right, from this prior high. So you would think, okay, this could be a downtrend. But instead of taking out this low, right, because this is the most recent low, or creating this lower high, instead of taking that out and then pulling back to continue going lower, you can see that price creates a higher low. Okay, that's pretty interesting. Instead of creating a lower low to pull back to go lower, which would be a downtrend, it creates a higher low. Thinking this is maybe an uptrend because it's obviously respecting these lows. Trend, it should be taking out previous highs and then respecting previous lows. And clearly see right here, price creates this low, doesn't end up taking out this high point. Instead, it goes back lower. Well, in this case scenario, off of this pullback, you would not be shorting because it never took out this previous low. At the same time, you should not be buying either, because price never took out this high point. Clearly see that price is staying within this range, not taking out previous highs, but it's also not taking out previous lows either. It's simply just staying within this consolidating range over and over again. And this is why it's very important that you pay attention to those key details, because if you go off of just market structure alone, right, price is creating higher highs and higher lows, right? Most people say, yo, lower lows, lower highs, you buy here, but that's not necessarily the case, as well as price is creating lower lows and lower highs. So most people will tell you, okay, you short here because this is a lower high, but that's not necessarily the case either, because price is not breaking through levels of structure. So for it to be a downtrend, it has to break back below a low and then pull back to continue going lower. Not breaking back below these lows, it's not necessarily a downtrend. Since it's not breaking back above these highs, it's not necessarily an uptrend. So whenever you see these situations to where it's not taking out a high or a low and it's kind of staying within this range, that's called arranging or consolidated markets. And typically you want to be patient and not trade at all until the market shifts, right? The market consolidates, breaks back below this low, and then what? Right, once price breaks back to this low, then we get that pullback right here. Bam. So it breaks back below this low right here, pulls back, is our new lower high right here. This was the last high before price broke back below this low. Obviously, once you can see the market pull back and it respects this high, and then we start to go lower, this is not when you can say the market is in a downtrend and you can take a short going all the way back down here. Perfect. These little details are very, very important when it comes to understanding and mastering market structure, right? It's not always so simple as higher highs or higher lows. Attention to those key details will really help you from choosing low quality setups and losing within the markets to now choosing those high quality setups and increasing your win rate, meaning you make more money trading, meaning your path to consistent profitability is a lot easier. We're going to be talking about impulsive moves versus correction moves, right? Obviously, a correction move would be a pullback. In an uptrend, you want to be paying attention to previous lows, right? Meaning as the market is going higher, it should respect previous lows within the markets. And as the market is going lower, it should respect previous highs within the markets. These are the general classifications of a uptrend and a downtrend. An impulsive move should be price breaking back below previous lows within the markets. And a correction move would be price respecting previous highs within the markets. Obviously, you can see here in this depiction, during an uptrend, we had an impulsive move to the upside. Price creates this impulse higher, then we create a correction. This correction should not take out this previous low right here. You can see here price respects that previous low, and then we see a break to the upside. This is our new impulsive move higher to now take out this previous impulse. So you can clearly see price pulls higher, takes out this previous high, then once it takes out this previous high, then we can look for the correction. So you can clearly see here price corrects itself. This is our new higher low, meaning that price should not break back below this previous low point. You can clearly see it doesn't before creating this next impulse to the upside perfectly. On this next impulse to the upside, it should now take out where this previous high point. Once it takes out this previous high point right there, that's that finished, and we should now wait for the correction. Obviously, following this correction to the downside, it should not take out this previous low point. You can clearly see it does not take out this previous low. It respects it before continuing higher. I'll take out this previous high. This is a perfect definition of an uptrend taking place. We have impulsive moves to the upside, taking out previous highs, and we have correction moves to the downside, respecting previous lows. Impulsive move to the upside, taking out previous highs, correction move to the downside, respecting previous lows. So for a down move, we have impulsive moves to the downside, taking out previous lows, but we have correction moves to the upside, respecting previous highs. So the moment that we see price respect this previous high right here, and then we start seeing an impulse move to the downside, this is when we can start taking our short, reaching back below this low. Bam. Once it takes out this low, you want to see the market pull back, respect this previous high right here, not take it out. And then once price starts going lower, this is when we can frame that short to now take out this low point right here perfectly. This would be our classification of an uptrend. For every high that price takes out, it has to pull back and respect the previous low before continuing higher. And for every low that the market takes out, it has to pull back, respect a previous high off of that impulsive move lower, should now come lower to take out a previous low. So this would be an example of an uptrend, would be an example of a downtrend. Perfect. Right here we have a clear example of a downtrend as well as an uptrend taking place. Price creates this high point right here, and this is our previous low point right there. So obviously this is our lower high right here, bam, and this would then validate as our lower low. So from this high point to down here, this would be our correction move. As you frame a short within the markets, you want to establish your stop loss at least back above this high point up here, reaching back below this low point perfectly. Once price takes out this low, you want to wait for a pullback. This is the last lower high right here before price took out this low point right there. Obviously, off of this pullback right here, you want to see, is price going to respect this high point, which you can clearly see ends up pulling back, does not get all the way back up here before seeing a continuation lower. So at this point, you would then frame your short. Price creates this bearish engulfing candlestick. Your stop loss back with this high. This would be a quick scalp move, reaching back below these most recent lows, a 1-to-1. Perfect. And then right here, it's very important. Once price creates this low here, you want to take note of it right here. Bam. Price creates this low. We can see that price pushes higher, but instead of taking out this low point, you can clearly see that price respects it for pushing higher. This is how you would identify a change in overall market environment. Once price took out this low point, this would be our new lower high, lower high, lower high, lower high. But you can clearly see here, instead of creating a lower high, it breaks above it. So this would not be a correction. This could be a potential reversal taking place, right? Because a correction should look something like this. It takes out this low, it creates a lower high, and then it goes lower. We got the first part down where it took out this low. It did not give us the second part where it creates a lower high. So this could mean a potential reversal is taking place. Case scenario, you want to be patient. You want to pay attention to how does price react within this low. This comes lower to take out this low, then you would wait for a correction to continue lower. Price does not take out this low, and that confirms that a reversal is taking place. So you can clearly see right here that price comes lower, right? It ends up pulling back, nothing significant here. It ends up coming lower again, and then creates a new high right here. If you look at this example, would you say that price is in a downtrend, creating lower lows and lower highs, or is it now a reversal taking place? Obviously, a reversal is taking place. This would be a downtrend. Create this high point right here, drop, pullback, drop, pullback, drop. This would be now an uptrend. Creates this low, broke back above this high. Instead of taking out this low, you can clearly see price respects it, and now it's breaking back above this high right here. So this is a clear indication that a reversal is taking place. Impulsive move to the upside because it broke back with this high, and this is our correction because it respected this previous low. So now that we get this impulsive move higher, this is where you can frame that long. On here, stop loss back below this low for 1-to-1 perfectly. And let's just say you missed out on an opportunity down here, right? You would wait for a correction. Once price comes higher, takes out this high point, price ends up pulling back right here, pulls back right here, followed by this push to the upside. This is your higher low. This is your new higher low. As price respects this previous low, so as price creates this impulsive to the upside, higher low, correction right here, respects this previous low, starts to push higher, your new higher low. As price pulls higher, entry up here, stop loss down here, reaching back higher, quick scalp 1-to-1 above this high point right here, bam, perfect. Or in this case scenario, it does go higher for a 2-to-1 R all the way back up here. It's basically those little key details that make the biggest difference when it comes to identifying whether you're in an uptrend or whether you're in a downtrend. Uptrend, you want to pay attention to previous lows. Is price respecting previous lows? Disrespecting previous highs? Downtrend, you want to be paying attention to previous highs. Is it respecting previous highs, and is it disrespecting previous lows? The moment that it starts to shift where price is taking out previous lows and now it's taking out previous highs, that's your first indication of a reversal taking place. But that doesn't mean you instantly just buy here, because if you bought right here, would have actually stopped you out. How you would know that price is going from lower to now higher prices? Is it breaking back above previous highs, and is it respecting previous lows? The moment that we see price break back with this high, that's our first clue. The moment that we see price respecting this previous low, not taking out, but instead seeing this massive impulse to the upside, that right there is our confirmation. The reversal is taking place, and we can now start taking buys. Boom. Perfect. Now again, to our next example, we're going to be going over swing highs and swing lows within the market. Swing high and a swing low is pretty simple. Starting off with the swing high, when we have this middle area up here that's higher than the area to its left as well as the area to its right. Usually when it comes to swing highs and swing lows, this is a potential indicator of a reversal taking place. Same thing for a swing low. Basically, when we have a low here that's much lower than the low to its left as well as the low to its right, this right here would be identified as our swing low point. Back to the caricature of paying attention to lows during an uptrend, pay attention to highs during a downtrend. During an uptrend, price should respect previous lows. The moment that you see that price is going from lower lows to lower highs and now it's respecting previous lows. This right here is your starting point to tell you that a potential reversal is taking place. Same thing for a uptrend to downtrend. The moment that you see that price is going from higher highs and higher lows to now lower lows, and it's respecting previous highs, this right here is your swing high point. It's basically the starting point right here that indicates that a potential reversal is taking place. So the moment that you see that price is no longer taking out previous highs right here, this right here is your confirmation that reversal is taking place, coming back all the way down into those lows perfectly. Swing highs, swing lows, pretty simple classification. So when we have a high point that's higher than the high to its left, high to its right. People also call this a head and shoulders pattern, where this is a top head, left shoulder, right shoulder. Call this an inverse head and shoulders. This is the bottom head, left shoulder, right shoulder. It's a pretty good reversal signature that a lot of people use to make a reversal taking place. But in the SMC ICT world, we call them swing highs and swing lows, or strong highs and strong lows, which gets us into our next lesson. Back at this previous example here, it probably went over some of you guys' heads, and we're going to be looking back at it and adding a little bit more detail. You can clearly see here that price was in a uptrend, where price created this low right here. Bam, clearly see it came hard to take out this high right here. Bam, right? So from this low to this high, here is your swing low. This is the low that's lower than the low to its right and the low to its left. So this right here is your swing low point. So obviously, once the market pulls back, clearly see that it does not take out this low point. Whenever you're taking a buy within the market, see price break back above a original high, you want to see price respect an original low. This is the last low point for price create this breaker structure to the upside. See, once price pulls back, want to see it respected. You can clearly see it pulls back, it starts going higher. Point, once you can clearly see that price is starting to respect those lows, you can frame along here. Your stop loss at least back below these lows right here, reaching back above those most recent highs up here. This trade alone will yield us a quick scalp, 1-to-1, reaching back above these highs. If you want, you can hold the trade a little bit longer, reaching back above these highs right here for a 2-to-1 hour. So this right here would be a perfect trade idea. Clearly see price was in a downtrend, creating lower lows and lower highs, but you can clearly see it shifted from lower to now higher prices, where instead of taking out this low, then creating a pullback to continue lower, clearly see that price breaks above this original high point, right? So that's our first indication of reversal taking place. Next indication would be, is price respecting this original low, which you can clearly see it came lower, it respected that original low. We're going to see this push the upside, and we frame this long, stop loss back down here, reaching back above higher prices, catching the entire reversal. Those little key details that are very important if you want to see success in trading. Most people would probably tell you, oh, this is a lower low, lower high, then right here price gets a lower high, you should sell here to continue lower, and then price ends up stopping you out and you know blow your account. It's those little key details that this video provides that helps you become a much more proficient trader, and that's what my entire channel is about, giving you guys real trading education that actually makes you money. I mentioned if you want to work with me one-on-one and want me to personally guide you and hold your hand throughout this entire process, that's the first link in the description. Book a free call, talk to me personally, and let me help you out. That right there would be our classification of a strong low. It was the strong low point because this was a low. It's lower than low to its left and the low to its right. So obviously once the market pulls back, should not take out this low before continuing higher. Right here, you want to call it a strong low. We call this a strong low. Right here is also a strong low because this is the low. It's lower than the low to its left as well as the low to its right. Let's see, even though that the market seen this massive drop to the downside, most people would probably tell you pull back, you short here and anticipate price to go lower. Then you can clearly see it stops you out and then you blow your account. Not how you trade market structure. Those key details, remember. The price did create this impulsive move to the downside and it did pull back. It doesn't necessarily mean that the market is going to immediately just start to reverse and continue going lower. You always want to pay attention to these lows right here. Obviously, the market creates this correction move to the upside, ends up pulling back, and you can clearly see instead of coming lower to take out this low, respects this level, holds within this level right here, and then we start to see this push to the upside. Bam! See, off of this push to the upside, we can clearly see it starts to break above previous highs. Breaks back above this high, breaks back above these highs right here, and it breaks all the way back up here. The moment that you start to see strong displacement to the market like this is when you can be confident that this is a strong low right here. Bam, identify this as a strong low. Basically, the start of a reversal taking place. Obviously, this is our strong low point. This right here is our new higher low. So this is our new higher low. See, off of this push higher, when it starts breaking these highs, seeing strong displacement to the upside. When that price starts to break back with these highs right there, you can then frame a long setup right here, back below these lows, quick 1-to-1 setup right here, or a quick 2-to-1 R all the way back up here, reaching back above these highs perfectly. So bam. And obviously, since this is our new higher low, right, we can obviously expect the market to pull back, hold within this level, right? So obviously, since this is our strong low point, push higher, pull back, hold. So following this break higher, right, you obviously would say this is an uptrend. So you want to see the market pull back and you want to see it respect this previous low. So you can clearly see price does not take out this previous low, respects it, and then we start seeing nice pushes to the upside, breaking back above original highs. So you can clearly see price breaks back over this original high point here. Really nice push to the upside. So off of this push higher, can frame along, put your stop loss back down here. This would be a quick, nice 1-to-1.5 setup, reaching back below these highs perfectly. And you can clearly notice the stark difference between, oh, the market creates higher highs and higher lows, you buy, lower lows and lower highs, you sell. Right? You can clearly see the stark difference, right? Trading isn't always that simple, right? There's a little key details that you want to pay attention to, and those key details are the main factor between you being a consistently profitable trader versus you constantly losing and repeating this cycle. This is why I created this YouTube channel, and why I create these videos is to give you guys the raw reality of trading and taking note of everything, every minor detail, every key insight that you may need to help you become more consistent. So this is the overall classification of strong lows within the markets. Back above original highs, respects previous low. If we look at this next example, this is our classification of a strong high. You can clearly see that this is our highest high point, which is much higher than the high to its left, as well as the high to its right. Clearly see that price is breaking back below previous lows. You can clearly see once price creates this high point right there, that's much higher than the high to its left, start seeing price break structure to the downside, bam, respecting this original high right here. This right here is referred to as our strong high. When it comes to these strong highs, it basically means price should not come back up here. The moment that price comes higher to create a new high, and then we start seeing a break, price not coming back up here, this is when that reversal takes place, and this is that strong high perfectly. Once the market pulls back right here, respects this high point, and then we start seeing a drop lower, this is when we can frame our short, bounce back below this high and reach back below lower prices for a 1-to-1 scalp perfectly. Yeah. So this would be a 1-to-1 scalp, reaching back below these lows. Strong high is basically when we have a high point higher than the high to its left and the high to its right. This basically gives us an idea that a reversal is taking place, and as long as price does not make an effort to come back up here, right, we should expect continuation lower perfectly. Strong highs and strong lows. Next, let's get into our last terminology, which is change of character versus a break of structure. And this is something a lot of people can actually get confused on, but it's a lot simpler than you think. A change of character is the exact same thing as price creating a strong high or a strong low. It's basically the last high point before price starts to see a reversal. This would be our change of character right here. You'll be asking, why did you choose this low as the change of character? Oh, it's pretty simple. It was the last low point for price created this high all the way back up here. See, during an uptrend, you want to see price pull back, respect this high, and then create a new high. This would classify as the uptrend. You can clearly see here that price did pull back, but it never took out this high, aiding a strong high. This is now referred to as a strong high. The reason why this is a strong high is because this high higher than the high to its left, the high to its right, meaning that price made an effort to come up here, but it was not strong enough to take out this high, meaning that this is a potential reversal taking place. Doesn't mean it's a reversal just yet. It's our first indication of reversal taking place. It's the strong high that price does not want to take out. But what confirms the reversal is if price takes out the low before creating the strong high. It was the last low during this pullback creates this new high. So the moment that price takes out this low right here, this is your change of character. It's basically telling you that price is going from higher highs and higher lows. The moment that price breaks back below this low right here, should now go to lower lows and lower highs. It's the last low point before creating this high. Now that price breaks back below this low, this is your strong high point. So you want to wait for the market to pull back, bam, and respect this high. Clearly see it respects it. It does not take it out. The moment that you start seeing the market consolidate here and seeing it break lower, is exactly where you're short. I'll bounce back over this strong high, reaching all the way back down here and reaching all the way back down here to 1 hour. This is advanced market structure. This is complete market structure that you won't learn anywhere else really, or at least this in depth. I really hope you guys are taking notes and learning a lot from this video. Change of character is the confirmation of a reversal taking place. The first confirmation is a strong high, where this high is higher than the high to its left and the high to its right. Basically signals that price was not strong enough to take out this high point. The confirmation is when price takes out this low right here, bam. As we know, in an uptrend, creating higher highs and higher lows. Now that we're in a downtrend, what's it doing? It's respecting previous highs and taking out previous lows. Respecting previous highs, confirmation takes out previous lows. Once the market pulls back, not looking to buy here. Instead, you're seeing this as a correction. It starts to consolidate. It starts to impulsive move lower, and you can frame a short, then go lower. Really solid. So that's a change of character. The breaker structure is pretty simple. The market is in a downtrend. Every single low that the market breaks back below is a breaker structure. Clearly see here, once price creates this change of character, this is the confirmation. Obviously, this low right here, price breaks back below this low. This right here is our break of structure. So mark this out as BOS. So the change of character always comes first within a reversal, right? The first move lower, this is our change of character, meaning that the reversal takes place. Next new low, our break of structure. Every previous high is referred to as a strong high. It's now referred to as a strong high right here. This low right here is our break of structure. Bam. Breaker structure. See, the market pulls back, respects this high. This is our new strong high right here. Respects it. Our breaker structure. Our breaker structure is this low right here. Bam. Price break structure to the downside. Let's wait for the pullback. So this right here is the pullback. So you can clearly see the market pulls back. Within this level starts to go lower. This is where you frame the short. Stop loss back below these highs, back below lower prices. Very important. If you're going to take a correction move, you want to see price break structure, meaning that if you're in a downtrend, you want to see price break back below this low, then pull back to continue lower. You don't want to be in a situation like this where price pulls back and it does not take out this low. Even though in this case scenario it did pan out, it's not really the best trade idea. This would be a much better trade where price breaks structure, then pulls back to continue going lower. Breaker structure is basically the confirmation to then look for the pullback. Price does not break structure and it pulls back, you don't necessarily take a short here. Wait for price to break structure and then pull back, then take a short to continue going lower. Character is the classification of the reversal taking place, and the breaker structure is the continuation of the move. Tells us price is going from higher highs and higher lows to now lower lows and lower highs. And the moment that price breaks back below this low, then you want to wait for a pullback to continue going lower. It's the difference between a change of character and a breaker structure. You can clearly see that the market holds within this level and then breaks higher. This right here would be your change of character. Right here, here would be your strong low right here. We'll mark this out as a strong low. This low is lower than the low to its left and the low to its right. That's your strong low. Your change of character would be right here. Anything past this change of character is a break of structure. Breaks back over this high, break of structure. Price breaks back over this high. That's a break of structure. Is this liquidity? This liquidity? Is this liquidity? Or is this liquidity? Liquidity is the backbone of the markets, and it's one of the key concepts that you need to master if you want to have any chance of becoming a successful trader. And over the last 4 years as a day trader, I've taken thousands of trades utilizing liquidity, as well as I've made tens of thousands of dollars trading specifically turtle soups, aka liquidity sweeps. In this video, I'm going to break down everything that I know within these last 4 years of profit trading liquidity. So by the end of this video, you guys have actionable steps so you can take onto your charts and get a much better understanding of this concept and hopefully get you one step closer towards being consistent. Get into the trade setups, the breakdowns, and the charts. Let's talk about the psychology of liquidity, because it's very important that you understand what is liquidity in the first place and why does the market even care to use it. We have to understand that the market is an auction. For every buyer within a certain market, there has to be someone on the opposing end selling to that person. For every person that is selling within the market, basically shorting, someone has to buy off of that seller. This would be the auction within the market. Obviously, you would see situations to where the market creates these higher highs and higher lows, right? We talked about this in our last lesson going over market structure, but there is a point to where the market becomes inefficient. If the market is only going higher, who is going to be selling within the market? Not a lot of people, right? If the market is all the way back up here, everyone's most likely buying. This gets us into our first classification of liquidity. This is inefficient liquidity. So the market is inefficient of sellers. Since we're all the way up here, the market can no longer continue going higher. But what does the market do? The market has to come back lower. It's going to refer back down into these old lows. Price ends up coming lower, takes out this low for continuing higher. This right here is our liquidity sweep. Well, that's inefficient liquidity. Now, our next classification of liquidity would be in reference to a goal. This is called our draw on liquidity. So basically, if the market is in an uptrend, every previous high within this market, previous high right here, this would be our draw on liquidity. Basically, this is where price is going. The price would come higher, break above this high, back lower for a pullback. If the market is still bullish, this high right here is our draw on liquidity. We can take a buy to reach back above this high. Back, if the market is still bullish, this high is our draw on liquidity. This is where price is going next. So bam, and price will continue to go higher until it is broken. So let's say that price reaches this high point and it can no longer continue going higher, right? And then we see, instead of pulling back, price breaks back below this old low right here. Right? This is in reference as our break of structure. Structure is shifting from higher to now lower prices. So instead of targeting original high, our new draw on liquidity is original low. So this low right here would be our new draw on liquidity, new draw on liquidity, new draw on liquidity. Clearly see here, price ends up pulling back, finds resistance, goes lower, takes out this first low, resistance goes lower, takes out this second low, finds resistance, goes lower, takes out this third low. So it's pretty simple. Inefficient liquidity is basically the start of a reversal. The market is consistently going higher and it reaches a point to where it can no longer continue going higher. See, it has to come lower. Here, once the market takes out this original high, there's no more liquidity up here. So obviously, as the market struggles up here, these new lows now are areas of liquidity we can then target. Now we're looking at the chart here and we're looking at the 1 hour's time frame. Let's take note of this high right here. Every single high within the market, we want to reference this as buy side liquidity. Every single low within the market, this would be referenced as a low, as well as this would also be referenced as a low. These lows are referenced as sell side liquidity. Before you understand liquidity, you have to understand market structure. Are we currently in an uptrend or are we currently in a downtrend? You can clearly see here that we had inefficient liquidity at these lows. Price was in a downtrend, creating consistent lower lows and consistent lower highs until it reached a point to where it could no longer continue going lower. Everybody was selling within the markets and there's no more liquidity down here. There's no more lows at this specific level. Whenever the market reaches a bottom, obviously has to go higher. This is where reversals take place. So obviously the market reaches a bottom, can no longer continue going lower, then we see a push to the upside. When it comes to spotting reversals, you want to pay attention to these two things. So you want to see price break above prior areas of structure. So this right here is a broken level of structure. You have to understand when the market is in a downtrend, creates consistent lower lows and lower highs. The moment that price breaks above a prior lower high, right, this is the first indication of a reversal taking place. Second indication of a reversal taking place is if price now respects this low. So instead of coming lower to take out this low, price fails to take out the low, creates new highs. This right here is our classification of a reversal taking place. First is a break of structure right here. The second is if price is respecting that original low and failing to take it out. You see, that's exactly what happened, where price created this pullback, but instead of taking out this low and creating a new low, ends up pushing back higher. So we understand that price is now in an uptrend. Let's see, we can clearly see here that price was reaching back above higher prices. See, during this uptrend, we have to understand that highs are now our draw on liquidity. So this buy side liquidity pool is our draw on liquidity. So let's say price pulled back here and it failed to take out this low. You would see this as a pullback that was held. Basically, price respects this level. For this pullback, you would frame a buy here and you would target back above this high. This is exactly how you would trade liquidity. If the market gives another pullback right here, you would take a buy reaching back above new highs. If the market pulls back right here and it holds within this level, you would take a buy here and you would sell back above this high. It pulls back again, you would buy here and you would sell back above this old high. It pulls back right here once again, take a buy here, you would sell back above this old high. We'll take note of this high as well as a draw on liquidity. Clearly see here that the market never took out this high. This is where we get into inefficient liquidity in the auction. The reason why liquidity sweeps happen is because the market lacks liquidity. So if everyone is buying up here, the market cannot continue going higher forever. Eventually, the market has to reach a point where it has to come back lower, gather liquidity for continuing. So it basically has to come lower, take out multiple lows, and then use those lows liquidity to go higher based upon that auction theory. Because we have to understand, for everyone who buys within the markets, they put their stop losses back below old lows. There's stop losses right here, stop losses right here, and there's even stop losses right here, because you have to understand all of these stop losses are buy orders. Every seller within the market has to be someone on the opposing end buying. The market wants to continue going higher, they need more people to sell. If the market is all the way back up here, they're not selling up here. The market has to do is it has to come back lower and take these traders stop losses. It's kind of like driving a car. You drive a car, you drive a car, you drive a car, and then it runs out of gas. So what do? Go to the gas station, refill on gas before you continue driving. It's the same thing in trading. The market cannot just continue going higher and higher forever because it's eventually going to run out of gas. It has to come lower and stop people out and use them as liquidity. And then once they gather that liquidity, then they get the fuel, continue going higher. That's why liquidity sweeps are very important within a market, the basic gist of them. Clearly see here that the market is in an uptrend. Just because price is creating these lower lows and lower highs does not mean it's a reversal just yet. Basically means price is simply just coming lower, gather liquidity before continuing higher. So right here, we want to pay attention to how does the market react. Once price comes lower and takes out this low, as well as this low right here, is the market going to pull back, find resistance to continue going lower? If it does, that confirms a downtrend. We can wait for a pullback, continue lower, or is the market going to find support here and going to continue going back higher? We want to pay attention to this specific level right here. You can clearly see here that the market coming down a bit, saw it in, then we see a pop to the upside. Pop to the upside here basically confirms once price came lower to take out these lows, it can no longer continue going higher, right? I mentioned a reversal is a two-step system. First is a breaker structure, broke structure back above this high right here, and second is a respect of a prior low. This right here was that low. You can clearly see that price did not take it out. Price never took out this low and it respected that level, basically meaning once price reached back down into this level, can no longer continue going lower. Move lower, even though yes it's going lower, price is still in an uptrend. This move lower was simply just a move lower, gather liquidity or gather fuel before continuing higher. The market cannot continue going higher forever. It has to eventually come lower, fuel from anyone who put their stop losses down here, and use that fuel to then continue higher. That's the point of liquidity. You see here, price ends up coming lower, takes out this low, this low, this low, till it reaches a point to where it can no longer continue going lower. Right? Notice how I never took out this low or this low. That's very, very important. You see this break to the upside, creating a new high, plus it respects this low. This is when you can frame your buy right here. Your stop loss back below this low right here, and you would target back above where? Buy side liquidity. Right? Since we're anticipating higher prices, these original highs are referenced as buy side liquidity. So this high right here would be a liquidity pool. This high right here would be a liquidity pool, and all the way back up here would also be referenced as liquidity. I'll let this trade play out. You can clearly see prices of find support. It's all the way back up there. So now that we understand liquidity and efficient liquidity, draw on liquidity, buy side, sell side liquidity, how can we put this into a game plan to where we can come into markets every single day and profit from it? Well, I'm about to break that down here through one of my students. Okay, seeing one of my students here, Jake, been working with him for almost 4 months now, and the trade that he took here on Friday, it's a really good interpretation of everything that I've taught him, as well as everyone within the mentorship when it comes to liquidity. You can clearly see he was able to short at this exact level. He was able to buy his position back at this exact low. You can clearly see here by this blue line, and this blue line we're going to be breaking down in this trade breakdown, and how he was able to sell at the exact lows, utilizing and mastering liquidity. Right, this is why it's very important that you have a mentor within your trading, because it makes trading a lot more simpler. You don't have to learn how to trade and do all of this on your own. I've been able to help well over 100 students, help them make anywhere from their first $5,000 to $10,000, and a handful of students become full-time traders. If you're someone who's been trading for some time or a complete beginner, you want to learn from me directly, just like Jake has, and click the first in the description, book a free call, and talk to me personally. I'm going to be breaking down this exact trade and how you can utilize liquidity consistently every single day. So we're on the 15 minutes time frame here, looking at the NASDAQ. Can we identify and utilize liquidity on a consistent day-by-day basis? And this gets us into our next topic, which is our liquidity hierarchy and time-based liquidity, right? The liquidity hierarchy is pretty simple. There's certain levels of liquidity that are more important than others, right? The first level of liquidity that we have to mark out every single day, that's the most important, is previous daily highs and lows, the prior daily highs and lows. The second would be our time-based liquidity. This would be prior session highs and lows, and we'll talk about sessions in the next few minutes, but this is very important. The third hierarchy would be cool highs and lows. Fourth hierarchy, which is not the most important, but it is very important to know, is old highs and lows, basically buy side and sell side liquidity, right? If the market's going higher, target back above these old highs. Market goes lower, target back below these old lows. What I'm going to do here is I'm going to go to my indicators tab, and I want you to type in kill zones. Kill zones. You want to look for the one by at Joshua. So you can clearly see here kill zones at Joshua. I want you to click on that. This indicator right here basically marks out all the session liquidities that take place. This red box right here is referenced as our Asia session liquidity. It stems from 8 p.m. to 12 a.m. EST. Session right here is our London session liquidity. 2 a.m. 5 a.m. EST. This right here is our AM session liquidity from 8:30 to 11 a.m. EST. This is our PM session liquidity, right? This is from 1:30 all the way to 4 p.m. EST. Right? These specific liquidity pools are areas to where the market can see reversals from. Whenever you're taking a liquidity sweep setup, basically you're anticipating price to take out a high and then reverse from it. You don't just take a liquidity sweep from any specific level. Obviously, it's not going to work. Let's see, this would be a old high. So you would see price come back up here and you may try to frame a short here and it's not going to work. The reason why this liquidity sweep here didn't work is because it's not really referred back to anything. It doesn't refer back into an ASA session, previous day highs and lows, just a regular high within the market. Whenever you're catching reversals, they have to stem from levels of what you call prominent. These are important levels within the markets that tend to create reversals. Right? In the first area that tend to create reversals is previous day highs and lows. The second area that tend to create reversals is session highs and lows. So you want to mark out every single session highs and lows that hasn't yet been taken out. So this right here, in session low, you can clearly see price never took it out. You want to mark this as a point of liquidity. You can clearly see right here, you have this ASA session low, it's never took it out, point of liquidity. You can see right here, higher day AM session low, it's never took it out, point of liquidity. Price already took out this London session high from the prior day, so it doesn't even matter. And then obviously you have this ASA session high right here, point of liquidity from the prior day, and then you have the previous daily high up there. So that's a point of liquidity that price can tend to reverse from. That would be sessions liquidity. We marked out every single session liquidity that hasn't yet been taken out. Next, we want to take note of equal highs and lows within the marketplace. These are levels of liquidity that price tends to find reversals at, as well as these are levels of liquidity that price tends to target. Up here, this would be equal highs. This is where this high is relatively close to this high right here. So if I was anticipating higher prices within the markets, an area to where I would anticipate the market to reach back up into. So these equal highs here from the prior day to the ASA session high, these two levels are equal highs that I want to take note of, as well as these would be also equal lows. So this low right here is relatively close to this low right here. So if I was anticipating the market to go lower, and if we can see the right signatures, let's say the market breaks back below these lows, this would be a level that price would reach back down. We have taken note of our equal highs and lows, session highs and lows, previous day highs and lows. This one's our last one, which is basically just buy side and sell side liquidity. This is very self-explanatory. Basically, whenever the market's in an uptrend, higher highs is referenced as buy side liquidity. Whenever the market's in a downtrend, higher lows is referenced as sell side liquidity. This old high would be referenced as buy side liquidity, as well as would be a New York AM session high. This old low would be referenced as sell side liquidity right here. It's simple. It's basically just old highs and old lows within the markets. Not really the most important compared to everything else that we just mentioned higher. Now that we have our liquidity pools marked out, we want to look for a liquidity sweep. Basically, it's when price takes out a prominent area of liquidity and then immediately goes in the opposing direction, right? Whenever it comes to liquidity sweeps, you never want to see prices come into these highs and then pull back and hold and continue higher. You want to see price take out this high and immediately run away from it. That's a liquidity sweep. It's a sharp turn. I'm gonna allow this market to play out here. You see here, the market opens up. You hear the market opens up. Bam! You can clearly see right there. It comes higher, takes out what? This New York AM session high from the prior day, and then we see this big drop to the downside. I'm not going to immediately short here. The reason why I'm not immediately shorting here is because you still have level of structure right here. So this is still a potential level of support. So what I want to see here is, now that we got this liquidity sweep, price going to break through this level of support and use it as resistance to go lower. I want to look for clear see, opens up, breaks through this level right there. This tells us that once price took out this area of liquidity, could no longer continue going higher. Then once price breaks through this level of support, this is our clear indication that a reversal is taking place. What you want to see is, you want to see price pull back and it hold within this pullback to continue to go lower. In this case scenario, this was his exact trade. Price ended up pulling back up here and he was able to frame his short right up here. So as price pulled back all the way back up here and then started to reject, framed his short right here, and his stop loss just back above this high right here. Bam, perfect. And where would you then target? You want to target within the most recent points of prominent liquidity. So prominent liquidity are important levels of liquidity. We mentioned previous day highs and lows, session highs and lows, and the equal highs and lows. So the nearest prominent area of liquidity would be this London session low. So obviously, this was the London session low right here, area of liquidity perfectly. As well as another area that you can target would be this ASA session low. Just like how I mentioned the previous day highs and lows, price tends to take out 80 to 90% of the time. Well, Asia session highs and lows, if they're not taken out, price tends to take them out 70% of the time. So you can clearly see here that price never took out this Asia session low. So now that you see a reversal at these highs, break structure to the downside, you wait for the pullback, get short within the pullback. This would be an area to where you can then target Asia session low. This is a level of liquidity price tends to take out more than 70% of the time. This was that exact blue line. You can clearly see here price ends up finding rejection. It's down into Asia session low perfectly before starting to see this rally to the upside. Guess where it went high up into? Went back up into that previous day high, as well as those equal highs right there perfectly. Whether you shorted right here, or let's say when price took out this Asia session low and then you saw this break to the upside, could have also gotten on a buy right here to reach back up into this high right here, as well as these highs up here. Clearly see here how we went from in the beginning not even knowing what liquidity is. So now we understand all areas of liquidity, whether that be inefficient liquidity, draw on liquidity, and we marked out the 4 pillars of prominent areas of liquidity: previous day highs and lows, session highs and lows, equal highs and lows, old highs and old lows. And this is how we can utilize liquidity on a consistent day by day basis to catch some insane trades. And this just goes to show the market is not random. The market respects these levels. The market finds reversals at these levels. To understand the market this way, the more proficient that you will be as a trader. None of this was random. We knew price was going to take out this high, and once it did, it saw the reversal. It broke back below this low. That was the confirmation. So obviously price respected this high. Notice high never took it out, and we knew that price was going to reach back down into that London low, and we knew it was going to reach back down into that Asia session low. And after taking out that Asia session low and seeing the reversal higher, we knew that price takes out previous day highs and lows 80 to 90% of the time. So where it was reaching back up into, it was reaching back up into previous daily high, right? None of this is random. None of this is guessing. We know exactly what the market is going to do on a consistent day by day basis. Within the last 4 years, I've taken thousands of trades utilizing and mastering liquidity. And it's one of the most important concepts that you need to understand if you want to become a consistently profitable trader. And there's a lot of key concepts that not a lot of people talk about. And in this video, I'm going to break down everything that you need to know to help you get one step closer to that goal. Things like inducements, where price will come lower to create a stop hunt before moving in your direction. That's a very important concept that you should understand. Things like weak highs and strong highs, weak lows and strong lows, another important concept, as well as external and internal points of liquidity in terms of the extreme highs and extreme lows of the ranges, as well as internal highs and lows, which then creates the inducements. All of this may sound confusing now, but as we get into the video, I'm about to break it down step by step by step. So you can start off this video as a beginner or even intermediate when it comes to liquidity. By the end of this video, I guarantee that you will become an expert in this one top. When it comes to liquidity, there's 2 specific terms that I want you to know. The first term is a liquidity sweep, and it's very simple. So you can clearly see here that price creates this low within the market. And when it comes to liquidity sweep, you want to see price come lower to take out this specific low, just like we can see here, right? Price was creating lower lows and lower highs, came lower to take out this specific low, and then we seen a break to the upside. Right? What validates a liquidity sweep is very simple. Right? Once price takes out this low, it immediately rejects from it. You can clearly see it takes out this low and sees an immediate push to the upside. Another validation of a liquidity sweep is what we call now a protected low. This is basically when price is refusing to take out the low that swept the liquidity. So basically this right here was a liquidity low. So since price came lower to take out this low point, and then we seen this push to the upside, we want to validate this as a protected low. And what makes this a protected low is because you can clearly see that price comes close to that low once, comes close to that low 2 times, comes close to that low 3 times, but you can see price never takes out this low point. So this validates as our liquidity sweep, where price takes out this level of liquidity, and then we see this immediate push to the upside. As you can clearly see, price gives multiple attempts to come close to that low, but it never takes it out. So this right here is a protected low. This basically tells us that a reversal is taking place. So once price came lower to take out this low point, it was not willing to continue going lower. So where can the market go? The market can now go higher. Basically, so now since this is a protected low, price isn't going to take it out. Of these high points are now what you call unprotected highs. This right here is a level of now liquidity. This right here is now a level of liquidity, and this up here is now a level of liquidity. So you can clearly see here, since this is a level of liquidity, we want to see once the market takes out this high point, what is it going to do? So you can clearly see here, price comes higher, takes out this level of liquidity, as well as it does reach a level of resistance, and you can clearly see price starts making an effort to go lower. See, so this right here would also be a liquidity sweep. It makes an effort to go higher, but it does not come back higher to this high point. This right here is now our protected high. Since this is our protected high, what does it make all these lows? It makes all of these lows now liquidity. This right here would be a liquidity pool. This right here would be a liquidity pool as well. So if you were to frame a trade, you would be shorting here, your stop loss above this protected high, right? Because this is the high that took out this liquidity pool, and you would be targeting back below these lows. And this would basically be the setup, reaching back down there. Bam. So liquidity is not a very complicated concept. It's actually a lot simpler than you think. There's another component to liquidity sweeps that you should also probably know. In this next example, we're going to be going over liquidity runs. You can clearly see here a liquidity sweep is when price lower to take out this original low, and then we immediately run away from it. Or as right when price takes out this low and then runs away from it, price does not come back below this low point. This right here is our protected low, but you can see price comes lower, does not take out this low point, comes lower, doesn't even come close to it before we see this push to the upside. This push to the upside targets back above this high, then it targets back above this high. So that's our liquidity sweep. Now, what if you have a situation to where price takes out this high, but instead of reversing, price continues higher? Well, that would be classified as a liquidity run. That's exactly what's going to happen here. You can clearly see here, price comes higher. This high point creates this rejection lower, and then what do you see here? Price creates this push higher. This is not what you want to see when it comes to a liquidity sweep. When it comes to the liquidity sweep, you want to see this signature right here, where price comes lower, takes out that low, and it creates a rejection, meaning that once price takes out this low point, it immediately ran away from, because the entire point of liquidity is it's a level to where there's a lot of orders. When price gets to this specific level, all of these orders then get filled, moving the market in the opposing direction. So if the market was going lower and lower and lower, but it reaches this point to where that, let's say there's a large buyer here who puts, let's say, 5 million contract, price tags into this specific level, all of those contracts get filled and it immediately moves in the opposing direction. And since this is such a strong level to where all of those contracts get filled, price is not willing to break through this level. So every single time that price attempts to get down here, cannot break through it, kind of like a barrier. So basically what you want to see is price comes lower, takes out this liquidity pool, immediately moves in the opposing direction, and then there's a barrier here that's struggling to break through this level before we start pushing higher. Situation, that's not what happened. Initially, when price did take out this high, we saw this rejection. You can clearly see here there is no barrier. Basically, even though price gave this rejection to the downside, once it took out this liquidity pool, we did not see an immediate push in the opposite direction, price struggling to continue going higher. And instead, it's actually the opposite. You can clearly see here that price is pushing higher, right? This is a bullish engulfing candlestick. So this right here would validate as a liquidity run. So in this case scenario, what you want to do is you want to wait for a pullback within this last high point, and then you want to see if this level will hold to then continue even higher. You see here, it ends up coming back lower within that original high point. Then obviously right here, you can clearly see comes lower, rejects back higher, comes lower again, rejects back higher again. This gives us an emphasis that once price comes back into this high point, it's not willing to continue going lower. So obviously it's going to run back higher. So at this point, if you were to frame a trade setup, you would place your entry here, maybe your stop loss down here, targeting back above higher prices. This right here, be your liquidity run, crazy push higher. Nice. You can see the stark difference between a liquidity sweep as well as a liquidity run. Liquidity sweep is when we have a low, price comes lower, takes it out, immediately runs away from, and it struggles to take out this low point. Liquidity run can be when price takes out this high, it's back lower, but instead of immediately reversing, it holds within that original high point. Right? Once it holds within this original high point, shows us that price is not willing to go lower, and instead is going to take out this high and continue even higher. This concept that we're going to be going over is strong highs and strong lows, and external versus internal highs and lows. And even though this sounds like a mouthful, It's actually a lot simpler than you think, and let's break it down. This right here would be referenced as a strong high, and the reasoning for why this is a strong high is pretty simple. It's basically when price comes higher to take out this original high point, and then once price takes out this high point, we can see here that price creates a break of structure. So this right here would be referenced as our break of structure. This basically tells us that once the market reached back above this high point, it could no longer continue going higher. And then once we seen this break to the downside, right, strong displacement lower, this is the indication of a reversal taking place. From the liquidity sweep to the breaker structure, this right here is referenced as a strong high point. Only is this a strong high point, this is also what you call an external high. An external high is basically the highest high point within the market. As you can see here, if we look to our left, there is no other highs above this. This is the highest high point within the market. And when it comes to external highs and lows and strong highs and lows, these are levels of liquidity that price should not take out. Because if we look at this diagram here, price came higher to take out this high, then we see this break to the downside. This is the start of the reversal. Even though price can come higher, it should not take out this highest high point. It should respect it to then continue going lower. This right here would be our external high and strong high point. Start of a reversal, meaning that this highest high point should not be taken out. Since this is our external high, this right here would be referenced as our internal high, because this high right here is below this high right here. It would be the same thing for lower prices. Actually, let's say this was our external low, right? This isn't an external low, but let's just say it is. Right? Anything above this would be referenced as internal low, right? It's the same thing here. This right here is our external high because this is the highest high point before we see a reversal taking place. So anything below this would be our internal high. This right here would be referenced as our internal high. Even though price could come higher and let's say take out this internal high, as long as it doesn't take out this external high, we are safe. Clearly see here in this next depiction, market ends up pushing higher. It takes out that internal high. Look right here, never takes out that external high, because the market respects this level. This is why understanding and mastering liquidity is very important. If you see this exact pattern within your trading, this is one of the easiest trades that you can ever take. This trade right here is what you call the inducement. The inducement is pretty simple. It's whenever we have an external high within the market and then price creates an internal high. So the inducement would simply be price coming back higher to take out the internal high, but it respects the external high. Basically indicates to us that price respects this level and it's not want to take it out. So whenever you see price take out an internal high, but it respects this external high, or let's say it respects a high above it and then it sees an effort to go lower, this is an easy short indication, frame a short or sell within the market to anticipate lower prices. And it can be said the same in a bullish example. Let's say price creates this low, then we see a push to the upside, right? This would be our strong low or external low. Price creates this internal low, then we see this push to the upside, then price comes lower to take out this internal low, right? Inducement simply means to trap people, right? It basically is a trap. The price creates this internal low and then it comes back lower to take out this internal low, but you can clearly see it respects this external low. Then we see this push to the upside. This right here would be that inducement, and whenever you see this setup, you would frame a buy, put your stop loss back below this new low right here, right, reaching back above higher prices. When price comes higher to take out this internal high, then we see, so essentially, but it respect this external high, then we see this drop to the downside. What we can do is we can frame our short, put our stop loss back with this high, reaching back below lower prices. See here, the market ends up respecting us and all the way back down there. Perfect. Within this one example, we covered three things, right? The strong high plus external high within the market was we covered internal liquidity, then we covered the inducement. All of these things, even though it may be a little complicated to you right now, they're all very important if you want to master and understand liquidity. So make sure you're taking notes. As we're paying attention throughout this video, because it's about to get a little advanced right here. So this right here, what would this be? This would be our external low, right? This is our lowest low point within this range, right? This is the low that took out this prior low right here as a liquidity sweep before we seen this breaker structure to the upside. The structure to the upside from taking out this previous low right here would be referenced as our external low. as well as referenced as our strong low point. Right? So anything above this level, this would be internal liquidity, right? This would be internal liquidity, which you can clearly see price takes out, right? We'll mention that later on, but this would be internal liquidity as well. You can clearly see price also does take out. Coming lower, takes out this internal liquidity, takes out this internal liquidity right here, but it respects this external liquidity, right? Because this is the lowest low point before we see this reversal take place. Came lower to take out this internal low, but you can clearly see price respects this external low right here, right? We see this break to the upside. So this right here would be referenced as our new strong low. And a strong low is pretty simple, right? It's when price takes out an area of liquidity and then we see a break to the upside. So right here you can see price comes lower, take out this area of liquidity, which was that internal low, and then we see a break of structure to the upside. Here would be our strong low. This is the external low because this is the lowest low point, right? Price should not take out this low point by any means unless that price is in a downtrend, but you can clearly see right now price is going higher. So this right here would be our new strong low, right? Because this is the low that came lower to take out this area of liquidity, and then we see this break of structure to the upside. So now, right, this is our lowest low point. This is our new higher low. So now price should not take out this low point. This is our strong low, as this is also our inducement. If you remember, the inducement is basically when price comes lower to take out an internal low, right, and respect the external low. Chief on a break higher. So this right here is our inducement plus our strong low. Right? Hopefully that's all making sense to you. It's all very important to understand. Since this is our like inducement and strong low point, this is a level that price should not take out. We can take note of this low right here, as well as we could also take note of this low right here as points of liquidity. You can clearly see here the market opens up, sees a drop to the downside, ends up taking out this low point. Let's see what happens. It ends up coming back lower right there. It ends up also taking out this low point right here, but you can clearly see here it respects this strong low. You want to see price respect this level and not take it out. You can clearly see here price respects that strong low, and let's see, sees a break away from it perfectly. Off of this right here you can frame along, and let's put our stop loss, we don't want our stop loss too big, so let's put our stop loss back down here. Now where would our levels of liquidity be? The level of liquidity right here, this would be a level of liquidity all the way back up here. This is where we would be targeting. You can clearly see here price creates this strong low, and because this is the low that came lower to take out this low right here, followed by this strong break to the upside, right? This breaker structure. So obviously from this liquidity sweep to this breaker structure, that's our strong low. Anything above this level, it's not necessarily a strong low. You can clearly see that's why price was able to come lower and take out this low, hold back a little bit into this point of resistance, and then it ends up coming back lower to take out this low. But you can clearly see here, even though it does look like it's coming close, it doesn't take out that low point, because we already know, right? Because obviously these markets are an algorithm, it's a robot, right? It should not take out this low point. And the more that you understand this algorithm, the more that you understand this robot and become better, the more money that you make as a trader. You guys subscribe to this channel and keep watching these videos to help you become a much more consistent trader. And you can clearly see here price ends up respecting that low point and gets all the way back up there. Let's take an example. I'm gonna break down this exact trade that you can see right here, which I took on January 12th. You can see here this was the exact execution when I entered the trade right here, and you can see this is the exact exit where I was able to sell my position at these highs in just under around 10-15 minutes. I was able to make $2,000 using the exact concepts that I just taught you in this video. Well, I'm about to break down this trade step by step so you get a much better understanding. See, when looking at this chart, a lot of you guys may be confused, right? We simply just need to break it down to its core. So first thing we want to take note of is, where is our external liquidity points? Right here would be possibly our external liquidity, right? This was the lowest low point before we seen this push to the upside. So we seen this break higher right here, bam. And clearly see once price came close to that external low, it didn't necessarily take it out. You can see it respects that level right there perfectly, but as it does take out this internal low right here, followed by this break higher, that makes this now our strong low. It's sharp. You guys are starting to get it down. This would be our strong low point right here. We see this break to the upside right here. Coming into the market here at 9 a.m., we're simply just taking note of what's currently going on. We can clearly see here that before 9 a.m. price had came lower to take out these points of liquidity right here. Came lower, took out this low right here, this low right here, this low right here, but you can clearly see it kind of respects this low right here where it doesn't take out this low. So what is this low point right here? Let's go down to a lower time frame. the 15 minutes. Down to the 15 minutes time frame here, we can see here that this is a strong low. Right here was the low that came lower to take out these lows right here before we see this breaker structure to the upside. Came lower, took out these lows right here before we see this breaker structure. This right here would also be a strong low. This is a low right here that came lower to take out these lows right here before we see this breaker structure to the upside. See here before 9 a.m. it came lower, took out this low right here, this low right here, then it even took out this low right here. It took out all of these low points, but you can clearly see it respects this low right here. This tells us that the market is in an uptrend, because if you want to see the market being bearish, you want to see price take out previous lows. The fact that we're respecting these lows right here, where you can clearly see it takes out these lows, but it respects the strong low, does not mean that the market is bearish. It means that it's actually still bullish. It's simply just coming back lower to take out internal liquidity. So this right here was internal liquidity, and internal liquidity. It came lower to take out all of this internal liquidity, and then it respected this low right here, where you can clearly see it does not take out this low, followed by this break to the upside. That right there would be our confirmation. Note of this high right here. Bam. See here the market came lower, count all of these liquidity pools. If we can see a breaker structure above this point, what does it make this? It makes this, right? Let's get rid of this, but it makes this now new strong low point. Here would be our strong low point. As the market opened up, it was very simple. Want to see the market open up and break above this level and hold to continue going higher, because obviously the market was in a downtrend, took out multiple points of liquidity. Once it took out this liquidity pool, right, this low right here, and even this low right here, it got the liquidity that it needs. See price break structure to the upside. Let's let this play out here. The market ends up opening up and we see a break to the upside. This is exactly what you want to see. I was able to frame along here, putting my stop loss just back below these low points right here, reaching back above higher prices for about a 2 to 1 hour. And this was the exact trade idea here, reaching back above these higher prices, utilizing and capitalizing on simply just liquidity, nothing else. We didn't talk about fair value gaps, order blocks, market structure, simply just using these advanced liquidity concepts and pairing these advanced liquidity concepts with the previous video that I just mentioned about liquidity. The future videos coming out later when it comes to order blocks for value gaps are going to really make you a killer trader. But in this video, we're simply just talking about advanced liquidity concepts. So if you want to watch other videos to pair it all together, make sure that you guys subscribe to my channel and watch all of those videos in order. As you can clearly see right here, price ends up breaking back above this original high point for that breaker structure, and we were able to frame along here, capitalizing on this massive push upside, making us about $2,000 in just 10 minutes. Make this inducement setup where price was able to come lower, rebound all of these liquidity pools, but it respected this low right here. This was a strong low because it was the low that took out this area of liquidity, followed by this breaker structure. Whenever you see this signature where price takes out multiple points of liquidity, but it respects this low right here, right? This was that strong low. It means that the market is in an uptrend. The market is still going higher. So once price respect this original low point, all that we're waiting for is the breaker structure. So we have this liquidity sweep right here, and once we get this breaker structure, I was able to frame along, reaching back above higher prices, giving us a really big. Today's video, we're going to be going over everything that you need to know when it comes to understanding and mastering order blocks. In the previous lessons, we went over market structure, we went over liquidity. Now we're going to be simplifying and structuring our entries within the market, making sure that you understand how to mark out these order blocks and trade them. But I'm also going to break down this exact step that we took this morning, utilizing the exact same frameworks that I teach you within these videos. So you can clearly see here on my trading view, I was able to take shorts this morning right here, and I was able to buy my position back at these lows. This one trade alone made me a little over $3,700. This $3,700 is spread across 5 funded accounts. You can clearly see here I made a little over $740 times 5. It's on the high end of $3,000. As well as on these funded accounts, I am up $4,000 spread across 5 accounts. So last month plus this month of February, I am up $20,000 within the month. I show you guys to prove that everything that I teach you within these these lessons I actually implement and use within my own trading, and I teach my students. Into the charts here, looking at this example, an order block is pretty simple. It's basically the last up close candle, which you can see this was the last up close candle following a massive drop to the downside. It would be referenced as a bearish order block, as well as a bullish order block can be the opposite, where you can see this is a last down close candle right here or a massive rally to the upside. So this would be a bullish order block, and up here would be a bearish order block. One of the key questions, as you guys may be asking, is why did I mark up this entire order block here, while for this one I only marked out the top to the lowest body? Well, it's pretty simple. Whenever you have a very long wick, like in this case scenario, price creates like this very long wick, this just creates a much bigger zone. So instead of marking out the entire order block here with this very long wick, which you can see it makes it even bigger, you simply just want to mark out from the highest point to the lowest body. Same thing for here. Let's say the wick on this upper order block was super long. We simply just want to mark out from the lowest point to the highest body right here. Basically, that would be how you would draw up your order blocks. And one of the main concerns that you may have when watching YouTube videos on order blocks is a lot of people may create order blocks like there's some type of pattern, right? They probably say, oh, if price does this and then do this, and then there's an order block down here, you buy down here with the limit order, and then it goes higher. Not necessarily. You never want to be trading based upon patterns. You want to be trading based upon logic as to why should this happen. If you watch the previous lessons when it comes to market structure and liquidity, this all comes into play. Usually when it comes to order blocks, they're within levels of strong highs and strong lows. If you don't know what a strong high is or strong low is, it's pretty simple. So it's when price creates a liquidity sweep, which you can clearly see price comes higher to take out this original high point, and following taking out this high point, you can see price makes no effort to continue going higher, but instead it sees a drop to the downside. It gives us a clear indication that once price took out this high point, could no longer continue going higher. The drop to the downside, we create a structural shift. You can clearly see here price comes lower to break structure, and this will be referenced as a market structure shift or break a structure, whatever. Basically, price comes lower to break structure to the downside. Giving us a clear indication that price is going from higher to now lower prices. Whenever we get this classification of a liquidity sweep to this breaker structure to the downside, this right here would be referenced as our strong high point. This is the start of the reversal. Market was going higher and higher. This is where the reversal starts. So obviously, once we break structure, price should not make an effort to take out this high point, because this is the high that started the reversal. So obviously, once price comes up here, it finds resistance to go lower. When you're looking at order blocks within the markets, you want to look at them from areas of strong highs and strong lows. You can clearly see here that the market was in an uptrend going higher and higher, and then we've seen a strong break to the downside. Here, if you look at this market, you can clearly identify that we are now within a downtrend. At a point, the market was going higher, but you can clearly see right here, it reached a level to where it could no longer continue going higher. Obviously, we see this drop to the downside. Now, when the market makes an effort to pull back, this is simply a retracement to continue going lower. Mark this out as a strong high, but as well, since we know that this is a strong high point, most likely this last up close candle would be our bearish order block. We know that since this is where price reverses, not want to take out this high point, this last up close candle here would be a strong level of resistance that if we seen the market come back up into, should find the resistance that it needs to come back lower and start that downtrend. So that would be the first identification of an order block. Any of that is confusing, don't worry, we're about to break it down step by step throughout this entire video. By the end of this video, you'll be a master when it comes to spotting, identifying, catching trades when it comes to order blocks. Simply be the first step. Is basically creating the logic behind it. Why should price come up here to find resistance to go lower? It should come up here to find resistance to go lower because this is a strong high. It was in an uptrend. It reached a level to where it could no longer continue going higher. Price breaks structure to the downside. So obviously, once price pulls back, this would be a level of resistance. Continue that trend lower, aiding the context, creating the logic behind it. Not trading random patterns, but actual context as to why something should work. This is how you need to be trading on a consistent basis. I want to see price come back within this bearish order block level. What I necessarily want to see is I want to see price make an effort to run away from it. I'm on the 1 hour's time frame. You're marking out order blocks, you want to mark them out on the higher time frames. So like the 4 hour and the 1 hour's time frame. So that we see that price has come back within this 1 hour order block, I'm going to go down to the 15 minutes time frame to frame my entry, doing a top down analysis. If you guys remember, this is that 1 hour order block above us. You can clearly see here that on the 15 minutes, price has came back within that 1 hour order block. The reason why I like trading order blocks is because these are usually levels that create immediate reactions. As soon as price comes back within them, price tends to run away from them. Obviously, when it comes to looking for confirmation, you simply want to see price come back within this level, struggle to continue going higher, and seeing a break in the opposing direction. Play out here, and we can see price sees a push to the downside. You can see here that price creates a push to the downside. This is a pretty good confirmation. Basically tells us that once price came back within this level, gave this initial doji candle a little indecisive, then it created this push to the upside a bit. Okay, see price create this push to the downside, which is actually pretty good. And you can clearly see here that once price came back within this order block level on the 1 hour time frame, right, you can see that price consolidated here, and consolidated, creating a push to the downside. Basically tells us that once price came back within this level, it was struggling to continue pushing higher, right? And this is the overall emphasis of an order block, is a level of supply and demand. Once price comes back up into, it struggles to break through. Obviously, this would be a strong level of resistance, and when you're within a resistance level, you want to see price tag within it, tag within it, tag within it. You don't want to see price break through it. You want to see price consolidate, or what we call exhaust, basically tire itself out within this area, and then as price breaks to the downside, that would be the confirmation and frame a short to go lower. Our gist is when you have a clear order block within the market, which is a overall resistance level, you want to see price struggle within it, struggle to go higher, then seeing a drop to the downside. It gives you the clear indication that price, once it met this level, can no longer continue going higher. In a frame my short, you want to put your stop loss above the order block, because obviously this is still a level of resistance. See, so you always want to put your stop loss above the level of resistance. You don't want to put your stop loss here because price can easily come higher, wick you out, and then go lower. You want to put your stop loss above the resistance level. This is something I try to teach all of my students. You always want to prioritize your stop loss where you feel the most safest. If you feel the most safest with your stop loss above the strong high, keep it there. If you feel pretty safe with your stop loss above the order block, keep it there. Put your stop loss where you feel the safest, not where you feel like you'll lose the less amount of money. You always want to pay attention to structure, support and resistance levels, and where you're at within the range. Basically, we want to be targeting most recent points of liquidity, if you guys remember from the liquidity lessons. So obviously this would be a most recent point of liquidity right here that we can then target, which yields us about a 2 to 1 R, as well as we do have a area of liquidity all the way down here we can then target. And if you guys remember from the liquidity lessons, right, since this is a strong high, which we can see that price is obviously not making an effort to take out, that makes this weak low, and that also makes this a weak low. The reason why this would be a weak low is pretty simple. And this is a strong high because this is the high, right, that took out this area of liquidity, followed by this breaker structure to the downside. It would look something like this. We have an area of liquidity, take it out, breaker structure lower. So obviously once price pulls back, it comes back into this order block level, finds resistance to go lower. So this would be a weak low, and this would also be now a weak low because this is a strong high. Right? Price did not take out this high point. So this is a area of liquidity that price is not going to take out. Confident, putting our take profit here and putting our take profit all the way down here. And we let this play out here. You can clearly see since I've taken out that low, and also as takes out this low as well, and continues even lower. Pretty solid. I'm going to talk about continuation order block. What I showed you above here was a reversal order block. This is basically an order block at an extreme high or an extreme low. Basically, when price creates a reversal, this would be referenced as an extreme high, and let's say price reverses at the low, so it reverses down here and pushes higher. This would be referenced as an extreme low. Obviously, from the extreme high to extreme low, like these would be reversal order block setups, where price creates this extreme high, comes back into it, finds resistance to go lower. If you guys were paying attention as well, price did also create this order block up here, where you can see price came back within it right there, found resistance to go lower at the extreme high. But what if you have a situation to where the order block in the middle of the range? So instead of taking an order block setup all the way at these lows, take an order block setup in the middle of the range right here. So this would be a continuation order block setup. This is one of my favorite setups. That's also called an inducement, and it's pretty simple. If you're taking these order block setups within the middle, always want to pair them with a level of liquidity, and these can create some pretty big moves. So in this case scenario, if you guys can spot it, you can clearly see here that the order block, or you can see that the continuation order block would be right here. So bam, this would be an inducement setup right here. What makes this order block pretty special compared to, let's say, this down here, or even this right here, is this right here, liquidity. In this case scenario, when price came lower, you can clearly see here that price came lower to take out this area of liquidity, as well as it came lower to tap into this last down close candle, right? This was the last down close candle before we had this pop to the upside. Obviously, this right here would be an order block. The reason why this last down close candle is much better than this one, because when price came down into this last down close candle right here, there was no points of liquidity. Basically just consolidated, and even broke through it right here at this wick level. Obviously, this would be a low probability continuation order block setup, as well as this right here would also be a very low probability continuation order block setup. Right? Whenever you're taking a continuation order block, you want to look for this specific signature where price creates a low, right, but possibly comes higher, and then it comes lower to take out that previous low, and then you're going higher, right? Specifically, you would like the order block to be below or around that previous low. So once price comes lower, it not only takes out this low level, it also taps into that level of support to go higher. Right? This would simply be a trap within the markets. Like all of my trading, everything has to have some type of logic behind it, right? The market loves to trap traders. So when the market initially went higher here, a lot of traders went long or were buying, right, anticipating higher prices, and all of those traders put their stop losses back below this low. So once the market came back lower, it tricked those traders, took them out, and then gave you the real move. If you ever found yourself in this exact position where you take a buy, price comes lower to take you out, and then it goes into your favor, that's exactly how the market runs 99% of the time, right? The goal is to trick you and take your money and offset that liquidity to then go in the favor. But if you ever got tricked by the market, right, don't feel bad about it. That's just how the market is, and you know why trading can be very difficult, right? Sometimes you feel like the market can be against you. Well, because it is in a way. So the reason why this order block should work is pretty simple. Price created this trap right here where a lot of traders were buying. They put their stop losses back below this low. Clearly see here that this low is also above this order block level. Now once the market comes back lower, only taps into that support level right here, which is that order block. It also takes out this area of liquidity. So this right here would be referenced as the inducement, which is one of my favorite setups to take in the markets because of the trap. Now I'm gonna go down to the 15 minutes time frame and show you guys the lower time frame confirmation and entry. The 15 minutes time frame here, like I mentioned, you want to see price come down into these support levels, then make an effort to run away from it. What we want to see is one of two things. Either price opens up, comes lower, consolidates within this level for a bit, basically showing that exhaustion like I mentioned earlier, where it basically struggles to continue going higher and then breaks lower. Well, in this case scenario, struggles to continue going lower and then break higher, or it would be more so of an immediate reaction. Let's say price comes down into this level, finds support here, and then sees a pop to the upside. Like, these are the type of signatures that you want to see. Price enters levels of the support and resistance. You want to see an immediate reaction or consolidation within that level, indicating that price is not one to break through it. So I'm gonna let this play out here. You can see the market slightly opens up lower, and then we see a nice pop to the upside. So this is a pretty good setup right here. Case scenario, I'm gonna frame a long setup right here. Like I usually mention, I do like my stop loss all the way back below the level of support. This stop loss can be a little wide. Honestly, it does mess up my R multiple a little bit. All the way back up here would simply be a 1-to-1 R, which can be okay, but we want to prioritize having a good R multiple for every single trade. Then that you can do here is, if you are someone that is able to take on a little bit more risk, you can adjust your stop loss back below this low. And let me break it down. Usually when it comes to a level of support, the price comes down into that level and breaks away from it, that can also be classified as a strong low. Just how we can classify a strong low as a liquidity sweep, where price sweeps this area of liquidity, then breaks structures to the downside, right? This would be referenced as a strong high. This can also be referenced as a strong high or a strong low point, where price taps into a level of support or resistance, and then we see a break of structure in the opposing direction. If you ever find yourself in this situation to where, let's say you get an entry a little bit late, and you typically want to put your stop loss below the low of the support level, but since you got a later entry, it can be okay putting your stop loss below the low that tapped into the order block, followed by the break the opposing direction. Because usually when price comes down into this level of support, finds support, and then breaks away from it, I should not revisit down here. Targeting would be within this original high point. This would yield me a 1.2R, which isn't too bad at all. Let's see if we can get a 2-to-1R back up here. Can never go wrong gathering a 2-to-1R. This does end up finding support pretty nicely there. It ends up getting back up into our 2-to-1R target. The reason why we didn't target all the way back up here or even all the way back up here is because this could still be in a downtrend. Even though we are taking buys down here to go higher, this would simply be a correction move, basically a pullback. Okay, so I'm not necessarily going to target all the way back up here or all the way back up here. I'm simply just going to target back up into the middle of the range. So this is where the range started, this is where the range finished down here, and this would be the middle. Because if we look on a broader picture, the market is in a downtrend where we can clearly see here price pulled back, found resistance, went lower, pulled back, found resistance to went lower. We did come down here to find support. This wouldn't necessarily classify as a reversal just yet, so we'd simply just be taking buys to get back up into the range. For anyone wondering, why did I target here, instead of reaching all the way back up here, it's basically because we're still in a higher time frame downtrend. This is simply a lower time frame pullback. It's very important to understand where you are within the range. Looking at our next example here, we're looking at gold, and we're on the 4 hours time frame during the New York session, which, if you don't know, the New York session on gold is between 8 a.m. EST till the market closes. What you want to do before you start trading every single day is you want to create a daily bias, right? This is going from the higher time frames, marking out your higher time frame support and resistance levels, as well as higher time frame liquidity pool, right? So in this case scenario, I'm on the 4 hours time frame, and I'm basically creating a context of where we are within this range. The first thing that I can take note of is right here. You can see here that price had created this pushy upside from reacting off of this order block right here. So this was the last down close candle before we had this massive swing to the upside. So obviously once price came back within this swing level, price found a level of support to then push higher. Next thing I can take note of is this last down close candle right here. So this would be kind of like that continuation order block there. Right? This is an order block, found support from a prior order block. So obviously we can see here that price had came down into this level as it did take out some points of liquidity right there. You can clearly see here price initially went lower, on support to push higher, came back lower, took out this liquidity pool, as well as we did tap into this order block level, gave a slight push to the upside. Coming into the New York session here, I'm paying attention to this level right here. This is the last down close candle, as well as I'm extending this right here. Found a level of support within that order block right there, created this push to the upside. This right here is now a potential strong low point. This is the low that tapped into a level of support followed by a break to the upside. So now this is a potential strong low level. To New York session here, my overall emphasis is I want to see the market find support to go higher, right? My overall emphasis is higher prices. Now it can do either one of two things. It can either open up, rally higher to the upside right here, or maybe it could come lower a little bit or consolidate within this level. Ultimately, I want to see higher prices, right? Whenever we're creating a day bias, we gotta understand the market can either move higher or the market can go lower. In this scenario, I want to see higher prices as prices clearly finding support within support levels. Came down to this initial order block, found support, push higher into this next order block, and it's finding support here to push higher. So price is clearly respecting these support levels, as well as we do have areas of liquidity above us. We have this high up here right here. We have this high very close to it, reference as equal highs within the liquidity modules. And then we obviously have this high up here. Right? If price does end up finding support at these lows and price does respect these lows, then this would be a weak high. This would be a weak high. All the way back up here would be weak highs, all areas of liquidity that price can then target. I'm gonna go down to the 1 hours time frame to get a little bit more information. The 1 hours time frame here during 8 a.m. around the New York session, looking at gold. Obviously, we took note of that 4 hour order block right here, and within that 4 hour order block, we obviously took note of that strong low point right here. So usually when it comes to the 1 hours time frame, we want to get a little bit more refined. Basically, if there's a 4 hour order block on the 1 hours time frame, you want to look for maybe a 1 hour order block within it. That just gives you a little bit more precision. In this case scenario, within that 4 hour order block, we can take note of this last down close candle right here, as well as kind of like the low here, continuing that last down close candle. So we're basically just refining what we already seen on 4 hours. Very important to understand where you are within this range. So since we're at a clear level of support, it wouldn't necessarily make sense to be shorting trading within the markets, right? And this is why it's important to create a daily bias. You don't get faked out, right? So if the market were to open up and come lower, I'm not chasing the market lower because I understand that we're within a higher time frame support level. So don't get faked out on the lower time frames. Always start your day on a higher time frame. Then a clear level of support of this strong low down here, right, which is the low that tapped into support, followed by this breaker structure to the upside. Obviously, coming into the market, this is obviously a pullback, and we want to see price hold as a level of support to then push higher. That's the main emphasis we're looking for today. On the 1 hour time frame, that's pretty much about it. We're simply just refining everything that we've seen on the 4 hours. I did was refine this order block here, marked out this low. This has a breaker structure right here, as well as mark out some liquidity pools. So we have some areas of liquidity up here, and liquidity up here. So now that we have our top-down analysis done, we can now go down to the 15 minutes time frame to look for our specific entry. So on the 15 minutes time frame here, we understand that on the higher time frames, we're in a level of support. The market opens up here, coming into the New York session, we're not going to be so hasty, right? We created our plan, so now once the market opens up, we're trading that plan. So we understand that we're within the level of support. What we want to see is we want to see either one of two things. Either the market will open up and see an immediate push to the upside, give us the idea, right? Obviously, price has found support here, and we can frame buys to go higher, or something that can happen is a fake out, where the market can initially open up, go lower, maybe find a level of support down here, then see a push to the upside, right? The goal is not to just immediately come into a market forcing a setup or trying to predict it. Instead, you wait for the market to open and allow it to either open up and run higher, which you can take a breakout setup, or wait for it to open up, come lower, find a level of support to then go higher. But the main emphasis is that you have a plan. I'm anticipating higher prices, so as the market opens up, I'm waiting for it to either do one of two things in alignment with my plan. Allow the market to open up here. You can see creates a little wick there, creates a push to the upside. Let's see if we can get a nice pop higher. Okay, it comes lower a little bit, right? This is why it's important to stay patient, but this is still very good. You like to see consolidation here. It's still very good. And we see a nice break to the upside. This is actually a pretty good set, right? It basically tells us that once price kind of reached down into this level, consolidated a bit, consolidated a bit, basically struggling to continue going lower. I think this pop to the upside here is pretty good. Do here is I'm gonna frame a long right here. Instead of putting my stop loss kind of like back below this low, I'm gonna put my stop loss back below this low right here, because we do kind of have a little order block right here, right on the 15 minutes time frame. So this was kind of like the last down close candle right here, right? Within that 4 hour and 1 hour order block, we have this 15-minute order block right here. You can kind of see here that price did come down into that 15-minute order block right there, and it did kind of come back into it once, come back into it twice, and now we're seeing that push to the upside. So just to be extra safe here, instead of putting my stop loss right here, which is a little tight, I'm gonna keep my stop loss back below the low here of now this 15-minute order block. And I can reach back above areas of liquidity for at least a 1 to 1 hour. So we can see here we have an area of liquidity up here, as well as we do have some areas of liquidity that we did mark out earlier, like up here and up here. Area of liquidity all the way back up here yield me a 2 to 1 hour. From the looks of it, this actually doesn't look like a bad sub at all, right? Obviously we can see here price created this low. Obviously we can see here price created this high, came back lower, found a level of support right here, seeing this push the upside, pulled back, so validating that this is a strong low. So now that we know that this is a strong low, these highs are weak highs. So this would be a weak high, this would be a weak high, as well as this right here would be a weak high. And if price breaks through all these levels, most likely this would also be a weak high, come back up into. We're utilizing everything that we learned from market structure to liquidity. Now we're adding order blocks. So it's very important that if you want to master trading, it becomes the best trader that you can be, you have to master all of these individual concepts, but I try to simplify them easy to understand for you guys. Can let this play out here. You can see price doesn't find support, and it was a great thing that we put our stop loss down here, because you never want to be too careful, right? Price ended up coming lower and took out that low. You want to prioritize putting your stop loss in an area to where you feel the safest, which at the time I felt the safest, putting it back below the low here of this 15-minute order block. You can see here price does end up finding support, and it does end up reaching back higher. It's up coming back up here for our 1 to 1 hour target, pretty solid. Does end up finding support even more, or reaching all the way back up into these highs here for our final take profit. Perfect. Let's see, does it end up getting all the way back up there as well? Yes, it does. It ends up getting all the way back up there perfectly. Probably say half of what I've made trading within these last 4 years have come directly from trading and utilizing fair value gaps. And the reasoning for why I'm making this video is because I check on YouTube, right? And some people, they make these fair value gap videos, but they're like 5 to 10 minutes long. And I really do question some of these videos on YouTube as if people actually get value from them. And then I see other videos of people making fair value gaps, but they're teaching it completely wrong. You've probably been in a situation to where you watched a fair value gap video and they tell you fair value gap looks like this, where this candle is, bigger than the other candle. This is the right fair value gap versus the wrong fair value gap. If this wick is like, just bull crap that doesn't actually work. And then some other people, they'll make YouTube videos. It comes to, okay, this is how you trade a fair value gap, but before you trade the fair value gap, you gotta wait for liquidity sweep, then CISD, then the macro, then this, and then you get down to fair value gap. And it's like, okay, there's all these freaking steps. Let me just trade the fair value gap. You're watching this video, you're probably in a situation to where you understand fair value gaps or you heard about it, but you're still confused, right? You're still confused in terms of, how to identify the right versus the wrong fair value gaps, or you try trading fair value gaps in your own trading, but they don't seem to work, or you may got some wins here, but you're not as consistent as you would like. Well, in this video, I'm going to help you with all of that. I'm not only going to teach you how to trade fair value gaps, how to spot them, but I'm also going to teach you how to choose the correct fair value gaps versus incorrect fair value gaps, as well as I'm going to teach you some more advanced stuff, like how to use fair value gaps to create a day bias, as well as pairing fair value gaps with order flow, as well as quadrants with a fair value gap where you should buy specifically inside of a fair value gap. There's a whole lot of intricacies in fair value gaps that not a lot of people talk about. In this video, I'm going to break down, and hopefully by the end of this video, you have a much better understanding of utilizing and mastering fair value gaps to help you become a much more consistent, powerful trader. As well as I did take a trade this morning with my students, which you can clearly see I was able to buy down here at these lows, was able to sell up here at these days of session highs. This one trade made me a little over $2,400. Not only am I going to teach you guys fair value gaps and how to trade them the right way, I'm also going to break down this exact trade idea that I took this morning, trading the day bias, trading the entry, as well as other things that helped me get a confluence only using fair value gaps. So whatever you know about fair value gaps right now is at the bottom of the iceberg, and hopefully by the end of this video, you have a much greater understanding. When it comes to fair value gaps, there's 3 specific fair value gaps that we want to take note of. First would be a reversal fair value gap, then a continuation fair value gap, then lastly, we're going to be talking about inversion fair value gaps. But for this first example here, we're going to be going over reversal fair value gaps and how to spot them, trade them consistently. But whenever it comes to reversals within the markets, like I mentioned, you always want to pay attention to the overall market structure. Whenever you're looking at fair value gaps, it's 2 main things that you want to pay attention to. First is the overall context, and then second is the draw on liquidity. And if you don't know how to spot a fair value gap yet, it's pretty simple. A fair value gap is right here in the middle. See separation between where this candle right here creates this low, and then it's the high here where this candle creates a high. So this separation here between this candle low, this candle high creates a gap within the middle, which is referenced as a fair value gap. If you look at other candles within the markets, you can clearly see here that there's no separation right here. So this would not be a fair value gap. There's definitely no separation up here, no fair value gap up here, slight separation right here. You can clearly see here, separation right there, fair value gap right there. You can see here, separation here, fair value gap right here. Then you see here, this candle creates this high, and this is where this candle creates its low. No separation there, so no fair value gap. So fair value gap is when there's a separation in the middle between this candle's low, this candle's high. So this would be a bearish fair value gap, and a bullish fair value gap would be something like this. Bang, and then bang, separation right there. Bullish fair value gap, you see price comes down into it, found support to push higher. So that's how you would identify or classify a fair value gap. When it comes to identifying and spotting reversals within the markets, have to pay attention to and understand where is the strong high and where is the strong low within the market, because every reversal stems from a strong high or a strong low point. If you don't know what a strong high is or a strong low is, it's pretty simple. We covered it in the market structure and liquidity lessons. So a strong high is something like this, where price creates this initial high point right here, taking out a initial high right there. Then we see a break to the downside. Usually price creates a pullback to then continue lower. So this right here would be classified as a strong high. This price created the high here because this is the highest high point, creates this reversal. So this is where market goes from higher prices to now lower prices. Obviously, once the market pulls back, should not take out this high point because this is the high that took out this prior high, followed by this breaker structure to the downside. So usually when you're looking at uptrends, price creates consistent higher highs and higher lows. The moment that price creates, right, let's say a new higher high, instead of creating a higher low, it breaks this original low. You can see it reject to take out this original high. Right, that's a great indication of a strong high in place. So you see here, the market was in an uptrend, higher high, higher low, higher high, higher low. Market creates a higher high. It does not create a higher low. It breaks below the previous low and it struggles to take out the original high. This is a strong high point. It should not come back up here. We see a reversal take place. You can clearly see in this example, that's exactly what happened here. The market had came higher, took out these original high points, right? We were in an uptrend, creating consistent higher highs and consistent higher lows. The market reached a level to where once it took out this higher high, did not create a higher low, but instead a broke structure to the downside. But ultimately, this tells us that the market has reached a level up here where it can no longer continue going higher. And obviously, when the market reaches a level to where it can no longer continue going higher, it reaches a ceiling and it has to come lower. And as the market came lower, we see a breaker structure of this low, creating the start of the downtrend. Higher prices to now lower prices. So obviously, looking at this example, we would identify this to be our strong high. And since this is our strong high, we know that price should not break back above this high point. So obviously, this fair value gap right here, this would be a high quality fair value gap. That's not it. A lot of people in this case, you know, they'll probably tell you once price gets into this fair value gap, you immediately frame a short and you immediately, you know, look for lower prices. That's predictive thinking. You have to understand these fair value gaps are like magnets. Whenever price creates a fair value gap, price tends to come back into them. If you spot a fair value gap within the market, always want to wait for price to come back into that fair value gap and then give you confirmation, then frame a short. Whenever you're trading, a pro tip is you always want to be in control. Whenever you create a plan, you want the market to be in alignment with your plan. If I want to see price come back into this fair value gap before framing a short to go lower, you will wait for price to come back into that fair value gap to frame that short to go lower. Always be in control of your trade and never force anything that's not 100%. Case scenario, you can clearly see here that the market opens up and rallies higher, and what you want to see is you want to see the market stall. When it comes back into these fair value gaps, this is a resistance level where it struggles till it finally breaks. What you don't want to see is price come back into these fair value gaps, then make an effort to continue going higher. That's not what you want to see. You want to see price create a resistance, which would be the fair value gap, back into that resistance and act like a ceiling where price can keep going higher if it wants. It keeps smacking its head on the ceiling. Eventually, it will fall exactly like this. Price comes higher, creates a ceiling, smacks its head, smacks its head, smacks its head, smacks its head, eventually falls. Just higher, creates a ceiling, cannot break higher, eventually falls. That's exactly what you want to see in these specific resistance levels. We're going to let this next candlestick opens up here, and this is pretty good. You can see here that the market initially opened up in red higher, but then eventually seen this drop to the downside. This gives us a pretty good indication that once it came into this fair value gap, it has hit a ceiling here, and this could be a great idea to frame a short. And whenever you're trading fair value gaps, you have to understand your A3 candlestick pattern. This right here would be the first candle, this right here would be the second candle, and then obviously down here would be the third candle. Since this is a bearish fair value gap, you want to put your stop loss above the high here of this first candle. And the opposite can be said for a bullish fair value gap. This would be the low here, which would be that candle. So basically around this low right here, this would be the first candle, this would be the second candle, this would be a third candle. If you were to take a buy here, your stop loss would be right here at the low. As this candlestick closes, I would frame a short, put my stop loss back above the high here of this fair value gap, then obviously I would be targeting most recent points of liquidity. Right here would be referenced as my draw on liquidity. Basically, a draw on liquidity is a frame of target. Fair value gaps are nothing more than a retracement tool, or where price is going to retrace into, right? But a retracement is not going to work if you don't have any targeting, meaning that if the market sees a push to the upside, price creates a fair value gap in the middle. Where you want to be targeting is back up here, where you're going to be targeting. Well, some situations like this where price creates a high, it creates this other high, then let's say there's a fair value gap here, a frame of targeting would be this high, as well as it would be this high. Well, these two highs would be your draw on liquidity. Fair value gap is simply just a retracement to get into our objective. Our objective is price is in a downtrend, but we want to see price pull back. Fair value gap is simply where is price going to pull back into. It's going to pull back within this range. So once price pulls back into that fair value gap, should find resistance to continue lower. And we're going to let this play out here. We can see price stalls a little bit, sees another push to the upside. That's why it's very important that you prioritize where you put your stop loss and put it in the safest areas, because a lot of people, they like to trade with pretty tight stop losses, and they get in situations to where they get stop hunted. Your stop loss based upon market structure and where you feel safe, not where you feel like you lose the least amount of money. Just play out here, price ends up finding a level of resistance and gets back below this low. You can see the stark difference, right? We're not trading based upon how does the fair value gap look like, is this first fair value gap, you know, big, or is the candle small, or any type of weird patterns that people might teach, or we're not really trained based upon specific patterns, like wait for this to happen, then this to happen, this to happen, and then take the fair value gap trade. No, we're trained fair value gaps based upon context. Where have we been? Where are we currently at? And where do we anticipate price to go next? Right? Where have we specifically been? We're currently in a downtrend. Right? Price came hard to take out this original high, and then we seen this break to the downside. Right? This does not give us the indication that price is bullish. This gives us the indication that price reached a level to where it can no longer continue going higher, and we're seeing a reversal take place. Or are we currently at? Currently, we're within a pullback. Right? We identified that price gave a massive drop to the downside, and we have a fair value gap in the middle. We want to see price find a level of support, come back into the bearish fair value gap to pull back before continuing lower. Where are we going next? Next, we're going back below this low. You can see here that price is in a downtrend. Once price pulls back, it goes into that original low. Obviously, once price comes back into this fair value gap, you can see it struggles to break higher, goes higher again, struggles, and then eventually, boom. Train fair value gaps based upon patterns or any complicated steps, or train fair value gaps based upon overall context. Where have we been? Where are we currently at? Where do we anticipate price to go next? This is the only way that you should be trading, based upon logic and context. Don't oversimplify it and don't over confuse it. You have to be right in the middle. As well as, if you've been watching up until this point and you got a lot of value from this video and you want to work with me one-on-one to help you become a consistently profitable trader, I've been helping people learn how to trade and help them become consistent for the last year and a half, and so far I've helped well over 500 students, and I want to help even more people. So if you get value from this video and you want to work with me directly one-on-one to help you become consistent within the next 90 days, the first in the description, book a free call, talk to me personally, no one else, talk to me personally. Let me see your trading situation. Right? Are you a beginner? Have you been trading for some time? Or are you currently struggling with? Let's build out a plan to help you become consistent. And on this example, next we're going to be talking about continuation fair value gaps. Only am I going to talk about continuation fair value gaps, I'm also going to show you how to avoid losses within the market. In this example, you can clearly see here that price creates this bearish fair value gap. And a typical guru or someone who basically teaches how to trade but doesn't actually trade, probably tell you, okay, the market's in a downtrend, create this fair value gap, put a limit order here, stop loss like back up here, frame a short to continue going lower. And if you were to do that, this is exactly what's going to happen to you. You get cooked. Like I mentioned, you never want to take a fair value gap trade immediately as price taps into a fair value gap. You always want to wait for confirmation. In this case scenario, what happened? Yes, price was in a downtrend, but you have to be aware of where you are within the range. The market is not bearish, because you have to understand where is the strong high, where is the strong low. The strong low was right here. Bang, came lower to take out this original low point. Boom. Then we had this break to the upside. Bang, sweep, break to the upside, strong low. What did price do? I simply pulled back into fair value gap. Wow, into a fair value gap perfectly to the upside. Have to be aware of where you are within the range. This was simply just pulling back into this bullish fair value gap to find support to go higher. As well as, if you took note, there's also a fair value gap up here. But what's the difference between the fair value gap up here versus a fair value gap down here? Fair value gap up here never gave you a confirmation. The price simply just came down into it, and then the next candle just broke through it. Compared to this fair value gap right here, you can clearly see it came down into it, and then the next candle was a nice bullish engulfing candlestick. Based upon this confirmation, it tells us that once price came down into this level, found a level of support, and immediately ran away from it. Like I mentioned, when there's a level of support or resistance, you want to see one of two things. Price come down into it, find a level of support, immediately run away from it, or come down into that level in a consolidation, basically struggling to break through it, and then eventually it has to break higher. Those are the two confirmations that you want to look for when price comes into your bullish or bearish fair value gaps. Case scenario, came down into it, found support, push higher. But this specifically would be a reversal fair value gap. Now let's trade a continuation fair value gap. So we let these candles play out here, and you can clearly see here that the market has been in an overall uptrend, and it created this little fair value gap up here. When it comes to trading continuation fair value gaps, the main lever that you want to pay attention to is A, order flow, and B, draw on liquidity. Order flow is pretty simple. When the market is pushing higher, it should break above levels of resistance, and it should support levels within the market. In this case scenario, as the market pushed higher, we can take note of this bearish fair value gap. Came to this bearish fair value gap, price should have reversed from it, right? This is a bearish fair value gap. It gave this drop to the downside, but you can clearly see here that it gave this drop to the downside, but it quickly found support to go higher. This is why context matters, because a lot of people probably would have shorted here within the bearish fair value gap, but you have to understand the market is still bullish. Even though, yes, price did give this drop to the downside, price had came off of this support level and we're still continuing higher. Let's see, right? Price gave this low drop to the downside, held here, and then we see this push to the upside. Price is now coming back into that same bearish fair value gap for a second time. Here you see the signature. We have a fair value gap here. Price comes back up into it once, breaks lower, and it comes back into it for a second time. It's gonna break through it. The moment that it tapped into it the first time should have been the reasoning to reverse and continue going lower. The fact that it's coming back into that same level for a second time right here means it's going to break through the whole thing. This gives us a clear silver lining that the order flow is bullish. The reason why the order flow is bullish is because it's finding support. It's struggling to continue going lower. Even though it saw this drop to the downside, it did not reverse. Found support here and it pushed back high. Now we're clearly seeing that it's breaking above a level of resistance. And this is the best indication that you can get to identify whether you're in a bullish market or a bearish market, simply by just utilizing fair value gaps. We didn't talk about market structure, didn't talk about liquidity. All we talked about was fair value gaps, and it gave us an indication for why the market should be bullish. Breaking above a level of resistance, and instead of finding resistance here and then continuing lower, price found support here and is now pushing back higher. Price is struggling to continue going lower, it's breaking above resistance. The overall order flow is bullish. Next was the overall draw on liquidity. Obviously, this is a reversal, right? Price reached a high here where, you know, it started to see a pullback take place to come down into these fair value gaps. Now that it came down into these fair value gaps, it has the support that it needs, and now we should see price create a new high. These would be overall draws on liquidity, right? Higher prices, bang bang. Once price comes back within this bullish fair value gap right here, if we can see the right confirmation, price holding within this fair value gap, we can then frame along to get back up here. That's how you would trade continuation fair value gaps, right? It's not just prices in the downtrend, create a bearish fair value gap, I can frame a short here. You're gonna get cooked trading like that, taking just any fair value gap trade. You have to understand where you are within the market. Taps into that level right there, down a little bit, staying patient, boom, really nice push to the upside. Came down to that level once, twice, three times, and then we get this break up here. At the moment you see price break structure, right, break back above these highs after consolidating like this is where you framed along right here off of that break of structure. It basically tells you price came down into that fair value gap, held, break of structure, entry back up there. You can frame along here, stop loss back down here, right, because this is the low of the fair value gap. First candle, second candle, third candle, low is right here, stop loss down there, reaching back above these highs, bang. And we can let this play out here. Price finds support, gets up there, and even continues. Bang. And one of the questions that you guys may be asking is, okay, Arkham, we understand fair value gaps. Now, how did you trade them and make $2,000 this morning? Well, it's pretty simple, right? Before we start trading, we have to do a top-down analysis. Specifically, I trade the New York session between 9:30 to around 11:30 a.m. EST every single morning on the S&P 500. I trade live in front of tens of my students every single morning. I've been doing it for the last year and a half consistently. Every single morning with my students between 9 a.m. to 9:30, I create a bias with them. Basically, where have we been, where are we at, and where I'm anticipating price to go next. And this basically creates a plan, so when we start trading, we're not blinded, but we already have a plan in play and we know exactly what we're looking for and exactly what we're doing. You never want to trade blindly. So this morning, right, the first thing that I took note of was this bullish fair value gap right here. We have a clear bullish fair value gap on the 4 hours time frame, right? We start on the 4 hour, then the 1 hour, then we trade on the 15 minutes, right? You don't need 10 different time frames, you just need these three. So on the 4 hour time frame, I'm basically identifying where is my levels of support and resistance, as well as I'm utilizing fair value gaps in context of my overall order flow. Are we in a bullish market or are we in a bearish market? We're in a bullish market. The reason why we're in a bullish market is, if you guys were paying attention, you guys would probably know, but if you don't, that's okay. The reason why we're in a bullish market is because price is breaking above levels of resistance. If you got that right, great job. If you didn't, that's okay. Just keep watching. You can clearly see here this was a bearish fair value gap and price easily broke above it and is pushing higher. This gives us the overall indication, right? Whenever price is breaking above levels of resistance, that's a great indication that price is respecting higher prices than it is lower prices. You can clearly see here price is respecting those higher prices, breaks above a level of resistance, so that's where we're coming from. So right now we're in a bullish market. Where are we currently at right now? Now we are within a bullish fair value gap. And a neat trick when it comes to fair value gaps, especially on the higher time frames and even on the lower time frames, is quadrants. Instead of just marking out this box here on the fair value gap, you can get a little bit more precise. So what we want to do here is we want to grab a Fibonacci. We want to go from the low here to this high, and the specific levels on this Fibonacci is 25, 50, and 75%. You want to mark out the 25, 50, and 75%. So usually when it comes to these fair value gaps, it tends to always comes back within 25 to 50%, and sometimes the 75%, but preferably 25 to 50% of the fair value gap. You can clearly see here in this example, price came down into the 25% of that fair value gap there perfectly before we're seeing this nice swing to the upside. So bang, right? So when it comes to identifying where to buy within a fair value gap, the 25%, I always look to buy around that area. It's just a really consistent level that price tends to always come back into. That's just a little pro tip right there. So we understand that we're within this bullish fair value gap. Now, where are we going? During this morning, where I marked out in terms of where I was anticipating price to go was back up here into this bearish fair value gap. Like I mentioned, you have to take note that fair value gaps are like magnets. When price creates these fair value gap, right, let's say your fair value gap up here, once it finds support, price tends to come back into those fair value gap levels. So this fair value gap up here, you can clearly see price never came back into it. So obviously, if we can find support right here, this is an easy level we're anticipating price to come up into. That was the entire daily bias this morning. We're in a clear bullish market because price is breaking above levels of resistance. Obviously, we've seen a reversal at these lows, right? We had this sweep of liquidity followed by this break of structure to the upside. Obviously, this would be a strong low. We're not anticipating price to come down here. This gives us a clear indication the market's going from lower to now higher prices, right? We're clearly in a uptrend. And then the next thing is, where are we currently at? We're currently within this bullish fair value gap right here. And where we anticipate price to go next, anticipating price to come up here into this bearish fair value gap up there. Only thing that we used was fair value gaps throughout this entire segment. I'm going to go down to the 1 hour time frame. On the 1 hour time frame here, we get a little bit more information, but not really too much. The main thing that I took note of this morning on the 1 hour time frame was this 1 hour bearish fair value gap up here. So even though I'm bullish on the day, I do want to take note that we do have a bearish fair value gap right here. So my main emphasis this morning is I want to see price find support here within, right, this bullish fair value gap to break above the bearish fair value gap right there. Like I mentioned in the last example, right, we had the level of resistance. It came up into it and then came lower, and then I want to see it come back up into it for a second time. When it comes back up into it, let's say for a second time, it's going to break through it. So I want to see price make an effort to break through this bearish fair value gap. That was the only thing I marked out here on the 1 hour time frame, as well as some areas of liquidity like this high up here, area of targeting, as well as this high up here, area of targeting. Now I'm gonna go down to the 15 minutes time frame because 9:30 is just about to open up. 9:30 is just about to open up, and I'm down on the 15 minutes time frame. The main thing that I want to see is I want to see price hold within this level, and I want to see price break above that bearish fair value gap. As the ultimate confirmation of higher prices is if price is struggling to continue going lower and it's breaking above resistance levels. Exactly what I was looking for this morning. Here 9:30 opens up, ends up coming lower right there, holds within this level, comes back into that fair value gap, breaks through it perfectly. Okay, now that we've seen this push to the upside, we want to see a pullback. Where are we pulling back into? This gets us into a third fair value gap, which is inversion fair value gap. So this right here was a bearish fair value gap, and this right here was also a bearish fair value gap. So you see here, price broke above the bearish fair value gap 1, bearish fair value gap 2. But when it comes to bearish fair value gaps that were broken or bullish fair value gaps that were broken, they can be used now as support or resistance. Say price seen a push to the upside and we create a reversal. Say price created these bullish fair value gaps, right? Since these bullish fair value gaps were then broken, once price comes back into those bullish fair value gaps, this is a inversion fair value gap. So once price comes back within this once support level, it's now a resistance to go lower. Thing in this scenario, this was a bearish fair value gap. The moment that price finds support here and breaks above these levels, should come back into them to find support to continue going higher. My main emphasis is I want to see price come down into either this first one or come down into the second one, find a level of a bounce, and then I can take longs to get up here. Here, the market then opens up down into that second fair value gap right there, staying patient because I want to see is price going to hold here, and it does, right? The market ends up coming down into the second right here, basis rejection, and then we see this break to the upside. When I framed my long setup, like back up here, put my stop loss back below this low, and then I framed a long getting all the way back up here. We can clearly see here price doesn't find support and gets all the way back up there. This case scenario, this did yield me around 15 points, but I definitely do wish I could have held a little bit longer back up into this high or even back up into that fair value gap up here. This is a much larger fair value gaps. Remember what I told told you, the quadrants, the high of the fair value gap to the low, we're targeting within this fair value gap. You want to target 25% right there. So you would have seen price come back up into the 25%, even 50%. That was the exact high of the day. Perfectly. This is the exact executions. Bought right here, and I sold my position back above that high, just like I mentioned. Perfectly. Everything that I teach you guys in these YouTube videos, I use in my own trading. That makes me anywhere from $10,000 to $20,000 per month. And just last month, I made a little over $12,000 trading. So nothing that I teach you in these YouTube videos, I don't use in my own trading. That keeps me consistent on a consistent day by day basis, week by week basis, month by month, year by year. Last month, I made $12,000. And just reviewing my journal, something that I noticed is during these big days, like $4,000 in a day, $4,000 in a day here, and even these smaller winning days, like $2,000 and $1,800, I noticed a specific pattern every single time. Every single one of these trades incorporated the breaker. If you're watching this video, you're probably completely new to what even is the ICT breaker, or you've heard of it, but you don't know how to trade it. So in this video, I'm not only going to teach you exactly what the breaker is and how to trade it, I'm also going to give you guys some pro tips plus risk management to help you catch those really big days and maximize on your rewards, so you can go from becoming an inconsistent trader or break even to becoming a consistently profitable trader. When it comes to a breaker, it looks a little something like this. Basically a three-step strategy. It's when price creates this initial low, price comes lower to take out that initial low, then we see a push to the upside. Obviously, when price takes out this original low, that's the liquidity sweep, and this break to the upside is our break of structure, basically validating that a reversal is taking place. So once price comes back within this once broken level of structure, it should hold as support and then go higher. So within this depiction, we can clearly see here that the market was in a downtrend, creating consistent lower highs and lower lows, lower low, lower high, lower low, lower high, lower low. The moment that price takes out this lower low, instead of creating a lower high, you can clearly see here price creates strong displacement, going higher to break above this lower high. So from this liquidity sweep to this breaker structure, basically validates that price is in a reversal, and our breaker can be identified by this right here, this last up close candle. So you want to grab a rectangle from the low to the high of the body here of that breaker. You can extend it forward. Right here is our breaker. This is basically a market structure pattern, right? This lower high was a level of resistance. It was the pullback. Obviously, when price comes back within this last up close candle, this should hold as resistance, right? To continue going lower since we're in a downtrend. The fact that price did not hold this as a resistance, but instead it broke through it, means that this level right here, this last up close candle, this is now a support level. Breaker is simply broken level of resistance that is now turned to support. The main emphasis is we want to see price come back within this once broken resistance level, hold as support within this level, now see a reversal taking place, targeting opposing levels of liquidity, basically reaching back above this high right here and reaching back above these highs up here. Basically, you want to see price pull back, which you can clearly see back within that last up close candle. You want to see price hold. Up seeing a consolidation here, that's completely fine. Main emphasis is you don't want to see price break back below this low. You can see here, even though we did pull back, price held, and we're seeing a push to the upside. This basically gives us the confirmation that once price pulled back within this level, it was not willing to continue going low. Basically means that when the market was going lower, sellers were in control. The moment that we are starting to see a shift, every single time that sellers try to push the market lower, it cannot break lower, meaning that buyers are now in control. So whenever you see price pull back and hold within this specific breaker, and we start seeing an incline to the upside, this is our validation that price is supporting within this level. We go put our stop loss back below this low, we can reach back above higher prices. So you see here, price does end up holding within this level very nicely, and we eventually get all the way back up there. Super solid. This is the exact setup that I've seen happen multiple times within the last month, that every single time I was able to capitalize on it, created the biggest moves, hence making me the most money. And now that you understand what a breaker is, how can we put this into a trade plan to where we can trade it consistently, make money from it consistently every single time that it shows up? Let me break down. Specifically, when identifying and spotting breakers, you have to understand that they don't happen every single day. A lot of times they happen either 2 or 3 times maxed out of the week. Sometimes it might only happen once during the week. This is why when you see in my P&L last month, even though I traded every single day, I did not have a big win every single day. So you have to understand the best moves within the markets are not consistent. They show up a few times during the week, but if you can be there for when they show up, you can make a lot of money. But obviously, we don't just want to be coming into a market and looking for this pattern at any time of day, right? We want to be looking for the breaker between during the Asia session or the New York session. The AM session can stem between 8 p.m. to 12 a.m. EST. The New York session is basically between 8 a.m. to 12 p.m. EST. These two specific times is when I see the breaker take place. So for the Asia session, what can happen is the Asia session will create a low, and then it will create that breaker to then propel us higher for a continuation during London and a continuation during New York. So that's why it happens during the Asia session. And the reasoning for why it happens during the New York session, sometimes the Asia or the London session will come lower and create a low, and then the New York session will give a reversal to reverse what London and Asia session did, creating that breaker. Asia session can create the low of the day, continue going higher throughout the rest of the day basically, and for the New York session create the low of the day that reverses the entire move created during London Asia session. Vice versa can be said for a bearish breaker, which would simply be the opposite. Asia session will create a high, reverse lower, and then London session would continue lower, New York would continue lower. Times the Asia session plus the London session will come higher, and the New York session will create the breaker to reverse entirely what London and Asia session did. These are the two specific times that we want to be looking for the breaker to take place. Start off, I'm on the 4 hours time frame. When we're doing a top-down analysis, we're going from the 4 hour, the 1 hour, all the way down to the 15 minutes time frame for our entry. And on the 4 hour time frames, simply just marking out areas of support and resistance as overall market structure from where have we been, where are we currently at, and where do we anticipate price to go next. On the 4 hour time frames, we can kind of see here the price has been in an overall uptrend. We've been making consistent higher highs and higher lows within the market. You see here that price had came up into a high point and it reached a level to where it could no longer continue going higher. And this is basically what you call exhaustion. It reaches a high, it struggles to go past it once, twice, 3 times, and even 4 times, and then ultimately, right, if it reaches a point where it can no longer continue going higher, it obviously has to come lower to create a pullback, hold that structure before continuing higher. Look at the 4 hour time frame here. It basically just tells us that the market is in an uptrend. We can possibly expect higher prices reaching back up into, right, possibly back above these highs right here and reaching back above the all-time highs all the way back up here. And just before the Asia session opens up here, we can clearly see price is creating this bullish engulfing candlestick. Obviously, once price came lower to create this pullback, we are engulfing entirely of that last down close candle. So this basically tells us that once price pulled back, it was able to hold within this level. Buyers were able to step in, breaking back above that last candle. Overall, on the 4 hour time frames, it basically just tells us where have we been. We've been in an overall uptrend. Where are we currently at? Currently, it looks like we are seeing a pullback. That pullback was able to hold, and now we're seeing a break to the upside. And where do we anticipate price to go next? Next, we possibly would anticipate, right, as long as this pullback will hold and continue higher, we can definitely see price reach back above these highs and make newer highs. So when you're on the higher time frame, you're simply just marking out the overall market structure, potential support and resistance levels. That's pretty much about it here for the 4 hour time frame. Now I'm gonna go down to the 1 hour time frame to see if I can get a little bit more information. On the 1 hour time frames, we're simply just doing the same thing that we did on the 4 hour, but we have a little bit more candles on the 1 hour to give us a little bit more information, making us a little bit more precise. So the first thing that really catches my eye here is this liquidity sweep. So we can clearly see here that price had came lower to create this low and initially saw this pop to the upside. It saw this initial pop to the upside, and then we came back lower to take out this low level. Once it came back lower to take out this low level, we're seeing this push higher. Whenever you see this particular pattern where price comes lower, creates a low, then comes lower to take out this original low, and then we see this pop to the upside, it usually indicates a trap. A lot of traders probably took buys down here when their stop loss back below this low. When it came lower, it simply came lower, take out those early buying traders. So those traders end up getting stopped out, and then it usually sets up for the real move. So on the 1 hour time frames, this is a very key indicator here that tells me that we could possibly see a reversal taking place, as well as we are within a level of support. Within the last video, I talked about fair value gaps, which is basically a separation between this candle's high and this 30 candle's low. So obviously we can see here that price does also come down into a level of support. If you want to learn more about fair value gaps, it's my previous video, pretty good area of support within the markets. Not only did price take out an area of liquidity, but we are also within a higher time frame support level. This is what you call stacking confluences. Basically, multiple things on top of each other give you a reasoning for why price should go a certain direction. Only did price take out area of liquidity, we're also in a support level. If we can see a push to the upside away from it, that would be our confirmation reversal taking place. We can trust that price is going to hold within this level to reach back above these higher prices. And if you're wondering where is the breaker is right here, right? So on the 1 hour time frames, we can see we have this last up close candle right here. Reasoning why this is the breaker is pretty simple. We have this low and price creates this high, which is basically that lower high, and then price creates this lower low. But once we can see the market break out of this level, if we can see it pull back within this breaker, it should hold as a level support to get back up here. And that's the overall emphasis that we're looking for today. Though price did come lower, that does not mean it's a reversal taking place, right? It's simply just coming lower to tap into levels of support. And once it gets the support that it needs and it can run away from this level, we can then frame the buy to continue going higher. It's very important that you stick to the trend. Trend is always going to be your friend, and you want to continue to trade in alignment with it. Now that I created my daily buys, which was pretty simple, we're going to go down to the 15 minutes time frame, wait for 8 p.m. to open up, and then frame our setup. The 15 minutes time frame here, we can clearly see we had that liquidity sweep like we mentioned. Then we had this push to the upside right here. Now 8 p.m. is just about to open up, which is the Asia session. I basically want to see price break out of this range, and I want to see price pull back within that breaker. If that pullback will hold and expand, I can then take some buys, reaching back above these higher prices. Clock is about to open up. I'm gonna let this play out. You can see nice strong push to the upside here during 8 o'clock. What we want to see is price going to pull back within this level, hold within it, then break out. Sees a nice push down into that same breaker level that we just mentioned perfectly, and we see this reaction right here. This basically tells us that once price tapped into this breaker level, found the support that it needs, now it's seeing a breakaway from it. So at this point, I think this is a pretty good area to then frame along. I'm gonna put a stop loss back below this low here, right? This is the low that tapped into that breaker level, followed by this push to the upside. So obviously this is a pretty good low here to kind of validate that once price came down into this level, it found a level of support, and now we want to see that breakout. Price breaks out of this range, seeing a push to the upside. Some areas of targeting that I can mark out is obviously this high right here. This would yield me about a 0.8R, not really the best. Let's aim a little bit higher. We have this high right here, about a 1-to-1, pretty solid. We have this high all the way back up here at a 1.65, and then a 2-to-1R all the way back up here. So we're going to reach back above these high points here for a 2-to-1R, seeing that reversal take place. So I'm going to let this play out here. You can see price ends up coming back, holding within this specific level, really solid, gets all the way back up there for a 2-to-1R. Perfect. Really solid trade, as you can see here. Support back within that breaker, reaching all the way back up into all of those take profit levels for a 2-to-1R. Super solid. Look at our next example here. We're going to be going over the New York session. So right here, the New York session is about to open up, and we can clearly see here that during the Asia session plus the London session, we had seen a drop to the downside. But don't worry, this drop is not a reversal. This is simply a correction move. You can clearly see here that the market was in an uptrend, and it simply reached a level to where it can no longer continue going higher. So obviously it has to correct itself, find a level of support before continuing higher. So it's very important to understand where you are within market structure, not get faked out. You're seeing a correction, thinking it's a reversal. 4 hour time frames, not really much we can lean off of. Something that I can take note of is this low right here. So we can kind of see here we came lower to take out that prior 4 hour low, and we're kind of seeing a little bit of rejection to the upside. So this gives us an idea that if price can take out this low and see a push to the upside, right? And if this push can hold, we could possibly see higher prices, and this could be the low. Areas of targeting we could reach back up into is this high up here, and obviously right some highs right here, and even all the way back up here. So where have we been? We've obviously been in a trend, and we're simply in a correction. Right? Where are we currently at? Like I mentioned, we're in a correction, right? Anticipating a pullback to continue going higher, but we also took out an area of liquidity that could possibly be a liquidity sweep or that reversal. Where do we anticipate price to go next? Price can hold within this level and see a pop to the upside. It would be very great to get back above these highs. So that's basically the 3-step pattern that you can look for on a consistent daily basis to create yourself a daily buy. So now I'm gonna go down to a 1 hour time frame to get a little bit more information. On the 1 hour time frame here, we can clearly see that price had came lower to take out this original high point. And right here, I'm gonna mark out this last up close candle because these are kind of like really tiny. So I'm gonna mark out this big last up close candle as my overall breaker. So this specific level was a level of resistance, but you can clearly see the market was in a downtrend, pull back, to continue going lower. So if the market can break above this level, this would be a great identification to reaching back above those higher prices. We do have a level of support here, order block. This is basically last down close candle before this big pop to the upside. So we can clearly see here that the market was in a correction to come down into that order block, and now that's down into this order block level. It's not only inside this level of support, but also took out this liquidity pool. Whenever you see this pattern, it's in a level of support plus it takes out liquidity. That's one of the best patterns that you're going to look for in all of trading, right? It's very consistent. This is a really good signature anticipating overall higher prices. And if you guys are paying attention, during the Asia session, we did create a bearish breaker. You can clearly see here, this is when the Asia session opened up at 8 p.m. Seeing this drop to the downside, right? But what do you see? High, low, higher high, drop lower. Last down close candle right here. This came back within it right there. Found a level of resistance to go lower. So Asia session saw this drop lower from that breaker. London session saw this drop lower. Now that we're in the New York session, are looking like we are creating a new breaker here. So if we can see price pop out of this, we could see a reversal taking place, reversing back up into London highs and possibly back up into Asia session highs as well. If you guys saw the bearish breaker at the highs, great job. Now at this point, I'm gonna go down to the 15 minutes time frame and wait for my entry. 15 minutes time frame here looks pretty solid. 8 a.m. is just about to open up. What we want to see is we want to see price break out of this level, pull back within that breaker like I mentioned, hold within this level to continue to go higher, back above these highs right here, these highs up here, and even the London session highs all the way back up there. So 8 a.m. is just about to open up for the New York session. So we're gonna let this open up and see what happens. Open up and come lower, right? Stay patient. We see a nice pop to the upside. Perfect. Closing back above that breaker level. So now what we want to do, we want to wait for a pullback within that breaker, hold within that pullback, and off the next push higher, we can frame the buy to get up there. I'm gonna let this pull back here. Nice. Ends up pulling back and get a nice bullish engulfing candlestick, which we do right here. Bang. Nice bullish engulfing candlestick. We can frame a buy here. Stop loss back below this low and reach back above higher prices. So a 2 to 1 R would be back above this high right here, which is perfectly fine. So I'm gonna let this play out here. Price ends up holding within that level perfectly, respects that low, gets all the way back up there for a 2 to 1 R. Let's see if it gets back up here for the London highs and possibly Asia session highs. Let's see. To get up there, comes close to London highs. Oh, it takes out the London highs. Let's see if it reverses the whole day. Not really, just takes out those London session highs. That's perfectly fine. So that's gonna be it perfectly. Microstructure to the upside. You can see that pullback held. Nice push to the upside, back over these highs, continuation higher. Perfect. You've probably seen something like this, where price finds support at these lows, and we see this push the upside, creating a absurdly long wick. Just looking at price action, you've probably seen that price came back down into this wick, find a level of support, and then continue going higher. This is actually a level of support within the markets that not a lot of people talk about. That's one of my favorite that makes me thousands of dollars trading. This right here is called a rejection block. In this video, I want to break down everything that you need to know when it comes to understanding, mastering, and even trading rejection blocks so you can become a much more consistently profitable trader. When it comes to rejection blocks, there's two specific ways of how you can mark them out. First way that you can mark out rejection block is pretty simple. You can see that this is candle number 1 and this is candle number 2. Clearly see here that for candle number 1, the body is much lower than the body to the right. You can see that this is the first body right here and this is that second body right there. So this is much lower than the one to its right. But you can clearly see here that the wick for the right is much lower than the wick for the left. So usually in this example, this would be classified as a bullish rejection block. So you would aim from the lowest body, which is this right here, compared to the right, to the lowest wick. So from the lowest body to the lowest wick of these two candles, this separation right there creates the rejection block. This tends to be a level of support that you'd anticipate price to come down into, which you can clearly see right here, find support to go higher. So that's the first way that you can mark out a rejection block. The next way that you can mark out a rejection block, which is personally one of my favorites, is by utilizing the long wick rejection. And it's pretty simple. It's whenever the market creates a long wick, it basically puts emphasis on the wick and the quadrants within that wick, right? You can clearly see here that the market creates an absurdly long wick, much longer than this wick, this wick, this wick, like really long wick. Most people would discount this wick like it doesn't even matter. It's actually very important because this wick, just like how people utilize fair value gaps and they call them inefficiencies, this long wick is also an inefficiency, meaning that if price goes one direction very quickly, it leaves imbalances. So what happens is price comes back down into those imbalances to fill them in before continuing high, right? This is the general concept of fair value gaps, where the market goes extremely high in one direction, so it comes back to pull back before continuing. And the same can be said when it comes to these very long wicks. Candlestick opens up and comes lower, and then it quickly goes in the opposing direction, meaning that this long wick right here, there's imbalances within that level. So whenever you spot like a very absurdly long wick inside of the markets, and let's say you're anticipating higher prices, you want to grab a Fibonacci tool. And what you can do is you want to go from the high of the wick right here to the low of the wick. You want to mark out the specific quadrant, the 25%, the 50%, and the 75%. When it comes to these specific levels, price will come back down into the 25 to 75%. So this area right here within this absurdly long wick, this would be a level of support that you want to see price come back down into, find support, go higher. This would be referenced as a long wick rejection. Rejection part comes from when you see price come down into this level, you want to see price reject from it. So don't immediately just buy when price come down here. You want to see price come down into either the 25, 50, or sometimes at the very last case scenario, sometimes but not always, the 75%, and then you want to see it run away from it. That's the rejection that confirms price has found support there, and then you can take the buy to continue going higher. You want to see price come down into at least the 25 to 50%, which you can clearly see price comes down into that 50%, followed by this rejection to the upside. It stops its track right there at the 50% once, right there twice, and then we see this push to the upside. This right here is the long wick rejection, which we can frame our buy, anticipating a quick scalp higher back above these highs. Putting our stop loss just back below this low right here, anticipating higher prices back above these highs. You can see that the market ends up holding within this level to reaching back above those higher prices. So this right here would be referenced as a long wick rejection, which is the same classification as a rejection block. These are the two ways that you can generally classify rejection blocks within the markets. The main reason that I like rejection blocks, even though they don't happen all the time, is because they happen at points of extreme. Rejection blocks are typically the highest wick or the lowest wick within a range. And if you can frame an entry within a rejection block, this gives you the best R multiple, because instead of shorting here in the middle, like within this fair value gap right here, where you have to have a stop loss all the way back up here, you're essentially shorting at these exact highs, having a very tight stop loss. So this gives you some of the biggest R multiple trades. The one main thing about rejection blocks is they don't necessarily happen often. Whenever you do spot them within the markets, they can create some really big moves, right? And this is the general gist of how you need to be trading. Not trying to trade every single day or catch every single move. You want to catch the moves that are essentially the best, that gives you the most amount of money. My trade personally, I only need 2 trades per week to win, to be profitable on the week. I don't need to win every single day. I don't need to win every single trade. I just need to win 2 times per week, because the 2 times per week that I do win, it gives me a really big R multiple, and I make a lot of money on those 2 trades. So rejection blocks, even though they don't happen often, less is more in trading. The times that they do happen gives you the biggest move in the tightest stop losses, offering you the best R multiples. In this next example, we're going to create a top-down analysis, and we're going to go from the higher time frames down to the lower time frames and put this into a actionable step-by-step plan. So starting off, I'm on the 4 hours time frame. You can clearly see right here on the right here, I'm trading XAU USD. So I'm on the 4 hours time frame, and before you start trading within the day, you want to create a day bias. Like, where have we come from? Where are we currently at? And where do we anticipate price to go next? Like, these are the 3 things that you need to be looking for on a consistent day-by-day basis to create a plan before you start trading. So where have we necessarily come from? So we can see here that price has came from a bullish rejection block at these lows. This right here would be a bullish rejection block, because you can clearly see here that these bodies are equal, yet this wick is much longer than the wick to its right. It's the exact same classification like I mentioned during that first example. Get out as a rejection block. When it comes to rejection blocks, you don't just immediately buy when price comes down into them, because you may find yourself in this position where you may take a buy here because this is technically looks like a rejection block, and it stops you out. You want to look for the rejection where price comes down into that level, finds support, and then leaves it. That's what you typically want to look for when it comes to rejection rejection block, and I'm going to break down everything from the higher time frames all the way down to the lower time frame executions. You can clearly see here that we have been in an uptrend where the market is seeing consistent higher highs and higher lows, right? We can see here the market came lower to take out both these lows right here. Once it took out those lows, it used them as liquidity to see this push to the upside. Clearly see here that the market creates a breaker structure right here perfectly. Right, we're seeing that the market is clearly in an uptrend. Oh, we're anticipating price to go up because we have been in an uptrend. Now the main focus is where are we currently at? So currently, right, as the market is about to open up here, we can clearly see here that we are at these extreme highs up here, right? Obviously, if you're looking to buy within the markets, you don't want to be buying up here. You want to be buying either at the lows or within the middle. I would rather you not take a trade at all rather than trying to buy up here. You want to focus on choosing trades that are quality. Focus on where you're buying, focus on where you're selling, right? Don't just buy because the market's going higher or sell one just because it's going lower. If you miss a trade, you miss a trade, right? Where are we currently at? Currently, we are at higher prices. So meaning that as we're above these highs, I'm not looking to buy, except I'm looking for possible shorts within the market. I'm looking for shorts does not mean I'm anticipating a reversal. Sometimes the market, as it creates an uptrend, right? It creates a higher high right here. Market has corrections where it pulls back. Problem is, a lot of you guys think because the market is coming lower, it's going to reverse, and you guys try to short anticipating a reversal. Not every single time the market comes lower is it going to reverse. Sometimes you can frame a short for a correction and then take profit at these lows, and then as it goes higher, you can buy once again to create a new high. Because it's very important to understand where you are within market structure. As we're above these highs, I'm not buying up here because we're too high up. Instead, I'm looking for shorts because I know that when the market reaches a level to where it can no longer go higher, it has to come lower. So if the market can reach a level resistance where it struggles or takes out a level of liquidity and it starts to struggle and we see it go lower, then I can frame a short for a correction. As the market corrects itself, I can take profit before it continues going higher. And I hope that made sense. So where are we coming from? From higher prices where the market is obviously bullish, creating higher highs and higher lows. We're currently we're at these highs where we're not looking to buy up here, but we're looking for short, as well as we do have a bearish rejection block above us. You can clearly see here that these bodies are equal, yet this wick is much longer than the wick to its left. This right here, from the equal bodies to the longest wick, this right here creates our rejection block perfectly. I mean, the emphasis is I want to see price come back up here to find a level of resistance to now get into our third step is where do we anticipate price to go next. I'm anticipating price to find resistance here to come back lower into areas of structure, which would be around this level right here. Whenever the market is creating higher highs and higher lows, if it reaches a level to where it can no longer continue going higher, will come lower for a correction. Usually when the market corrects itself, it corrects back into prior area of structure. So this right here was once a level of resistance right here. Now as price has broken through it right here, when price comes back down into it, it should now act as support, continue the market higher. And this is general market structure. Am I anticipating price to go next? I'm anticipating price to reject from this rejection block here as a level of resistance, come back down into this area of structure right here. I'm not expecting it to completely reverse because we have to understand we're still in an uptrend, but we can still catch a short opportunity at these highs, come back lower or quick move. Now that I have those three things marked out, I'm gonna go down to the 1 hour's time frame to get a little bit more information. The 1 hour time frames here, we're simply just refining everything that we just saw on the 4 hours. You can see here that on the 4 hour, we had a rejection block up here. On the 1 hour's time frame, you can clearly see here that the rejection block is up here. We're in this situation to where the rejection block on a higher time frame is like down here, but if on a lower time frame, it's like up here, which in this case scenario, you can clearly see the rejection block is a little bit lower than it is on the 1 hour. You want to refine it down to the 1 hour. You know, I've just found that 1 hour, if you have a PD array, which is in line with like a 4 hour, 1 hour makes it a little bit more precise. In this case scenario, I'm taking the 4 hour rejection block and refining it down into this 1 hour rejection block. So you can clearly see here that these bodies are equal, yet this wick is much longer than the wick to its right. So right here, you can clearly see this is a rejection block. See here that the market created this push to the upside and we're reaching back above a level of resistance. As the market opens up, if we can see price come back within this rejection block level, you can obviously frame a short to then go lower down into this level of structure. So now I'm going to roll down to the 15 minutes time frame because the AZ session is just about to open. open up. So I'm down on the 15 minutes time frame here. Like I mentioned, we create our plan. If the market opens up, comes higher within this level, we can then frame a short at rejection to come back down here. That's our plan A. If the market opens up and comes down into this level, if it can hold support, can take longs, reaching back above into that rejection block. Are the two main scenarios that we want to look for as the market opens up. Ends up pushing higher, back up into that rejection block up there. Perfectly. Now that we're back above into this rejection block, we want to see a nice breakaway from it. Ends up seeing another pop to the upside, staying patient, and then we see a nice rejection lower. What you want to look for is you want to see price creating consecutive lower lows and lower highs. You can see price came back up into this rejection block once, right? Stayed patient right here, end up pulling back up here for a second time, and then since then we can see that the market has been creating lower lows and lower highs. This gives us the emphasis that once price came back up here, could no longer continue going higher. So at this point, I can frame my short here. My stop loss back above this high right here, anticipating lower prices back down into, like I mentioned, that structural level right there. We can see here markets ends up respecting us and all the way back down there perfectly. We're aiming for just about a 1.14R, which you could have easily gotten a 1.5R of this trade. So very simple, very easy, really solid. And trading can really be this simple. You have to stop overcomplicating it and making it more difficult than it really is. It's just creating a plan, waiting for the market to open up. As it opens up, trading in alignment with that plan, and just having good psychology and risk management. Don't try to overtrade, don't try to over leverage, risk within your parameters, and just focus on doing this on a consistent daily basis, man. I make $15,000 to $20,000 per month. I only trade for like an hour to 2 hours per day. Don't overcomplicate it. I make it as simple and easy as possible for you guys. You can do it. Anyone watching this video can do the same. I want to help as many of you get to that point and able to help well over 500 traders become consistent within the last 2 years that I've been teaching. So if you've been watching this video and you got a lot of value from it and you want to learn from me personally, one-on-one, helping you become a consistent profitable trader, make sure to click the first description, book a free call to talk to me personally. Let me see where you're at in your trading journey. Let me see what you're struggling with and how I can create a plan to help you become consistent in the next 90 days. It doesn't have to take 2, 3, 4 years and be very quick as long as you have the right mentor like me to hold you along the way. Let's create another data bias just to make sure that you guys are understanding it and you guys have it down packed. So currently we're on the 4 hours time frame. Like I mentioned, it's a 3-step series. Where have we been, where we're currently at, and where do we anticipate price to go next? Start off, where have we been? So we can clearly see here that price has been in an overall uptrend on the prior day. Price did see this drop to the downside, and so far we did see kind of like this pop higher. As well as I do want to take note of, not necessarily talking about fair value gaps in this video, but it does have a bearish fair value gap up here. But we are within a level of resistance, and it's very important that when you're trading, you have to have awareness of understanding where you're currently at. So since we're inside of a level of resistance, pro tip that I want you guys to take note and learn from is do not take a buy unless these two things happen. Either price breaks above the resistance to pull back into it to go higher, or price comes lower, finds support, and then comes back into that resistance level. These are the only two situations to where you want to be buying within a resistance level, because too many times a lot of you guys may take a buy here not understanding you're buying within a resistance. So unless price shows you that's going to break through it and you can capitalize on it, or it comes lower and comes back into that level, then do not take a buy. Instead, be patient and sit on your hands. That's how a lot of this, I'm telling you guys, sit on your hands, be patient. Sit on your hands, be patient, right? A lot of trading is just being patient. A lot of you guys just try to force things out there. That's why you're not really as consistent. You should just stay patient, wait for price to come to you, and have control over the markets and not have markets have control over you. You will be consistently profitable month after month after month and make a full-time career from it. Just be patient, choose those high quality subs, and play in your trades. This case scenario, we can clearly see we're within a resistance level, and since we're within a resistance level, we could possibly anticipate price to pull back from it, because obviously if price wants to break through this resistance, either it will break through it or it will pull back, find support, and then break through. If it were to pull back and find support, where would it find support from? Like we can see here, we have this rejection block, equal bodies here, but this wick is much longer than the wick to its right. But not only is this kind of like a rejection block, but this is obviously a pretty long wick. Like I mentioned, when it comes to these long wicks, set them up in quadrants, right? From the high of the wick to the low of the wick, we have the 25, 50, and 75%, right? If you're anticipating a pullback within the markets, not a lot of people know about this, you can actually use this wick as a pullback area. So if you can see the market come to at least the 25% and then leave it, this would be the same as in a fair value gap trade or an order block trade or whatever. This would be the same thing. If you can see price come back to at least the 25%, this would be a level of support to then take above higher prices. So we're anticipating higher prices. As where have we been? Currently, where are we at? We're within a level of resistance, so we're not buying here. Even though we're anticipating higher prices, we're not buying here. Want to see price pull back to buy down here, right? Don't buy here. And you may be asking, what if it doesn't come down there? Then you wait. You simply just don't take a trade. The problem is you guys will create a plan, wait for it to come down here, go higher, and you guys chase it. No, you wait. And if it doesn't happen, you don't take a trade. You gotta focus on choosing trades that are in alignment with your plan. Create a plan, trade in line with your plan, prevents you from having losses. It's to be comfortable missing out on setups. Prepare for everything. You get those great setups, maximize your reward, you become extremely profitable, right? I'm not trying to be a little bit profitable. Best R multiple, the best win rate. I just want to be very good at what I do. I want to teach you guys very well so you guys can be very good as well. Now I'm gonna go down to 1 hour's time frame and refine it. On the 1 hour's time frame here, you can see we marked out that long wick there on the 4 hours. Really solid. Like I mentioned, you want to focus between 25 to 75% of that long wick. 25 to 75%. Bang, right there. You can see that we had a push to the upside, anticipating higher prices to possibly come back up into this upper fair value gap up here, well, as we do have a rejection block up here. You can see how this body is much longer than the body to its right, but this wick is much longer than the wick to its left. So from the highest body to the longest wick is a rejection block. My main emphasis for today is I'm anticipating higher prices to get up to here and up to here. I'm gonna go down to a 15 minutes time frame. The market is just about open. Down on the 15 minutes time frame, like I mentioned, my plan is I want to see price come down here, find support to get up there. Nothing else, nothing more, simple. So we can see market opens up right there, coming down into the 25%. Let me see. It's actually pretty crazy. It comes down to 25% there. Just so you know, I didn't see this beforehand. I simply just went back to the charts on a random area. Comes down to that 25% there perfectly, and we want to see price break away from it. Push to the upside right here. We create a higher low right here. So this tells us once price tapped into this low, price is now leaving it. So perfect. Obviously you can see this is the low, this is the higher low. Don't want to see price make an effort to break back below this low. See price run away from it, taps into the level. At this point I can frame a buy up here. My stop loss just back below this low right here. Let's reach back above this fair value gap all the way back up here, because this offers us a 2 to 1 R, which is still pretty solid. There's a fine support right there perfectly. Let's back up into this bearish fair value gap right here. We should anticipate price to break through it. In this case scenario, and you're up, let's say 1 to 1, you can definitely take it off. Before this video, let's just reach back up into fair value gap just to see if it'll get up there, and it does. Back up into that fair value gap, even gets back up into that rejection block right here perfectly, and that's how I do it. Within the last 2 years, I've talked to hundreds of students, and the same problem comes up time and time again. You may be understanding order blocks, fair value gaps, liquidity, market structure. You understand all these concepts. How can you put it into a structure where you can come to a market on a consistent day-by-day basis and know exactly what you're looking for? In this video, I'm going to go over daily buys. You can come to a market on a consistent day-by-day basis, know exactly where the market is going to go, frame a better entry, as well as other technical things like risk management, psychology, and everything that you would need to go from just showing up to charts or gambling to now you're coming to markets with more structure, you're more prepared, leading you to make better decisions, increases your win rate and the quality of your trades. When it comes to creating daily buys on a consistent day-by-day basis, you have to look for these 4 specific frameworks, right? First is going to be time, second is going to be the overall market structure, third is going to be liquidity, and fourth is going to be inefficiency or points of interest within that particular market. Now let's get into the first step, which is time. Whenever you're taking a trade within the market, you can't just take a trade at any random point. You have to have a set time that you're allowed to trade, have to stick within those parameters. The market is very vast. It moves up and down throughout the entire day, 23 hours throughout the day. And if you're looking to trade for all 23 hours, you're just taking a bunch of low quality trades. You don't want to be that person sitting at their desk for 3, 4, 5, 8 hours a day trading, trying to chase every move higher or lower. You want to be trading through a specific time. 1 to 2 hours per day, max 3 hours. And within that specific time, that's when you could look for opportunities. And you don't want to go before that, and you don't want to go after that. That's when you create structure within your trading, when you have a set system that you follow on a consistent day-by-day basis. And when it comes to time, there's 3 specific time zones that you need to pay attention to. The first specific time zone would be referenced as the Asia session. So this would stem between 8 p.m. EST, 12 a.m. EST. So this right here would be the Asia session. The next session, which would be the London session, would stem between 2 a.m. EST to 6 a.m. EST. This would be the London session. And then we have the New York session, which would stem between 9:30 a.m. EST to about 4 p.m. EST. But within the New York session, it's split up into 2. First, you have the AM session, and then you have the PM session, being 9:30 to around 12. Then the PM session would be from 1 p.m. to 4 p.m. Based upon your current schedule or when you come into markets, you want to trade between a time that allows you to be in front of the charts for 1 to 2 hours throughout the day. Obviously, from the United States, the session that I would be trading would be the New York session. So between 9:30 to about 12 a.m. EST is when I look for opportunities on a consistent day-by-day basis. If you're unable to trade the New York session, you could possibly trade the PM session, right? It doesn't give as many opportunities, but at least a couple times out of the week, it will provide opportunities. Same thing for the London as well as the Asia session. It may not present an opportunity every single day for those other sessions, but it will present, at least 1 to 2, a lot of the times 3 opportunities throughout a week-by-week basis. So if you're unable to trade the New York session, there are other sessions that can give you a viable opportunity. Something else that I do is I dash out the 12 o'clock hour on a day-by-day basis. Using a vertical line, I go from Monday 12 a.m. EST, Tuesday 12 a.m. EST, to Wednesday 12 a.m. EST, or Thursday, and then obviously Friday down to 6 p.m. EST. So basically these dashes gives me structure to know this is Monday, this is Tuesday, this is Wednesday, Thursday, and Friday. You see, just by identifying time and creating these brackets, it makes our trading a little bit more structured, and it's not just random. Imagine you did not have the brackets and you didn't understand the times. This is how you would be trading. It's all over the place. There's no separation. You don't know where Monday to Tuesday is. Is today Thursday? Am I trading on a Thursday? Right? That's the position that you're in on trading, and you wonder why it's so confusing, right? You don't have any level of structure that keeps it in place step by step. When you come to a market, you're confused. By the end of this video, I'm going to remove that confusion for you and make things a little bit more easier to understand. Now that we got time out of the way, let's create our daily buy. So whenever we're creating a day buys, we want to start off on the 4 hours time frame. The first thing we can take note of is the overall market structure. Market structure is pretty simple. It's simply identifying where have we been, where are we currently at, and where would we anticipate price to go next. When it comes to market structure, there's 2 specific things. The first would be order flow, and then second would be premium to discount. Order flow would be pretty simple, right? If we're bullish, we want to see price support bullish levels and disrespect bearish levels. Premium to discount is even simpler, right? If we're very high up, we most likely don't want to be buying up here because we're likely overbought. But if we're very low down, we don't want to be selling down here because we're oversold. So it's very important that on a consistent day-by-day basis, when you're identifying market structure, you want to take these things into account. Looking at the depiction for this day specifically, we can see that price has been in an overall bullish order flow, right? We've been respecting levels of support. Came down into this last down close candle right here. Price found a level of support within this what we call order block, the last down close candle, followed by this pop to the upside. So obviously once price come down here, it found support to go higher. So looking at this depiction tells us that we're in bullish order flow. Even though price is going higher, it would not be high quality to take a buy position. And the reason why we want to take a buy position is because we're at a level of premium. We can see here that price is all the way up here. Very important to look at where the move starts and where are we currently at. The move started down here where it came down into support. This is where we're currently at. If you want to be buying within the markets, you want to be buying, let's say, at the low right after the move started, basically right after we found support to push higher, or you want to be buying within the middle, a few points higher or a few inches higher from where the move started, right? If the move started down here, you want to be buying at the low or a few points away from, right? These would be higher quality opportunities. When the market is all the way up here, it creates a lower probability environment. And when we're looking for specifically daily buys, we don't want to be taking lower quality trades. We want to be taking trades that are high quality. And given that price is all the way up here, it would not make sense to be buying up here because we would essentially be chasing. The overall market structure, it tells us that price is bullish, right? We have bullish order flow, but we're very high up, meaning I don't want to be buying up here. So there's one of two things that we can do whenever you're in this situation, right? If you're still anticipating higher prices, right, there's nothing wrong with that. The problem is you can't be buying up here. One thing that you can do is you could look for a short at these highs for a pullback, because you have to understand the market cannot just continue going higher forever. It has to eventually reach a point where it pulls back. The first thing you can look for is taking a short for a pullback, or if you don't want to take a short, wait for the market to pull back to find a level of support before continuing higher. Coming to our marketplace on this specific day, that's exactly what I was anticipating. Overall order flow was higher prices are too high up, so I don't want to be buying up here. I want to see the market come lower. Whether I take a short to get down there or whether the market come lower and I buy down here, those are the two viable opportunities that I can look for on this day. Next, we're going to be talking about liquidity. And when it comes to liquidity, it's very important that you take note of prominent areas of liquidity. And a prominent area of liquidity is basically a original high or a original low that has a specific specification. Why is this high important? This high is important because it is a previous daily high. Usually when it comes to previous daily highs and lows, there are areas to where the market can reverse off of. Thing with equal highs and lows, and same thing with session highs and lows. Whenever we're marking out liquidity, we want to be referring back to these three specific levels on a consistent day-by-day basis: previous day highs and lows, equal highs and lows, and session highs and lows. Looking at the overall liquidity, we can see here price has came higher to take out this previous daily high, as well as we do have this high from last week's Friday, which would be referred to as equal highs. So not only do we have equal highs within this level, we do also have a previous daily high. It's very important that you don't want to be buying after price has taken out an area of liquidity, because most likely price can be coming higher to take out this liquidity and then reverse from it. If you're buying after price has taken out liquidity, you are subjected to a position to where price can reverse on you, meaning that the trade that you take is lower probability. If you guys are understanding how we are validating a high quality trade, it's not about taking every single trade within the market, but it's about taking a trade that's high quality and avoiding those low quality trades. So something that would make this low quality not only price in a level of premium, which we're all the way up here, which is low quality, we also just take out an area of liquidity above us, meaning if we're buying up here, price can reverse on us. So this simply adds to the already emphasis that I don't want to be buying at these highs. On the 4-hour time frames, that's the main emphasis that I got. I'm gonna go down to the 1 hour's time frame to get a little bit more information. The 1 hour's time frame, it gets us into our third step, which would be inefficiencies. Inefficiencies are levels of support and resistance. Primarily for this video, let's focus on order blocks and fair value gaps, right? I went over order blocks on the 4 hour, the last down close candle for a massive rally in the opposing direction. So obviously this would be a support level right here. You can see price came down into to find support to continue pushing higher. Right here would be a bullish fair value gap. Fair value gap is the separation between this candle's high, this third candle's low. This separation right here creates a gap within the markets, and this is referred to as an inefficiency, right? When the market rallied higher here, this level, it was left inefficient. So if the market wants to continue going higher, it has to come back down into this level to make this level efficient before continuing, right? Think of it like price rally too high up and it can no longer continue going higher. If it wants to continue going higher, it has to come lower, find support, and then continue pushing higher, right? That's the main emphasis of fair value gaps, right? They're like magnets within the markets that price usually come back down into if it wants to either continue going higher, or you can use it as a frame of targeting. So let's say I was shorting up here, this fair value gap would be a area that I would target. So looking at time, we're trading the New York session. Looking at the market structure, the overall order flow is bullish, but we're at a level of premium. We're too high up, we don't want to be buying up here. The overall liquidity, taking out the previous daily high, this is an area that price can reverse from. Looking at the overall inefficiency, we have levels of support below us, like this fair value gap as well as this order block. Piecing all of this together, it would make sense. So piecing all this together, we have one or two scenarios. Either either we frame a short up here, come down into this fair value gap, or let's say the market opens up, comes lower, maybe once price taps into this fair value gap, we can frame a buy to continue going higher. Right, we understand that the overall order flow is bullish, and my main emphasis at the moment is we have a level of support, which is this fair value gap. To see the market come down into this level, I take a short to get there, or whether price gets there and I buy down here. Those are the two ideas that I have on the day. So you can clearly see how I went from the 4 hour, clearly see here how I congested everything. I'm not looking at everything that happened up here. I don't care. I'm focusing on what is happening right here. We're too high up. We don't want to be buying up here. We have a level that we want to see price come down into, whether we short up here to get there or price gets there and we find support to go higher. Those are the only two things I'm looking for. You create a daily bias. It's simply just identifying, have we been, where are we currently at, where do we anticipate price to go next. Been in an overall uptrend, price is going higher, we're at a premium level, we don't want to see price continue going higher, we're anticipating price to come down into this fair value gap. And you want to give yourself two scenarios: either we frame a short to get down there, or price gets down there, we buy to go higher. That's it. We didn't need to mention standard deviations, Fibonacci, any of this, right? We simplified it into just two things: either we take a short to get down there, or either we find support down there to go higher. That's it, right? And you can clearly see how simple it is once you just focus on creating a structure from where have we been, where are we at, and where do we anticipate price to go next. Just outline that structure on a consistent day-by-day basis. It allows you to take the trades that are the highest quality. The highest quality trade right now would be either framing shorts to get down into his fair value gap, or price come down into his fair value gap to frame buys to continue going higher. Now I'm going to go down to the 15 minutes time frame and get my perfect entry. The 15 minutes time frame here, the 9:30 is just about to open up, and it's very important that if you have a set time for when you're about to trade, you only want to be trading within that set time. I know a lot of you guys, maybe having your timer on saying I might trade at 9:30, so you're placing entries within 8:45, right? You don't want to do that. You want to have a system of what you look for and what you do on a consistent day-by-day basis, and you want to allow that system to play out for you. You want to be a consistently profitable trader. You cannot allow yourself to break your rules, because a lot of the times most traders blow up because they don't follow the rules. They say they're going to take 2 trades, they end up taking 3, 4. They say they're going to trade at this time, they're trading a session. Whatever rule that you have in place, it's there to protect you. You want to be a consistently profitable trader, you have to focus on the consistency, following your system and following your rules on a consistent day-by-day basis, and allowing that to pan out for you. So I said that I was going to trade at 9:30. So as 9:30 opens up, that's when I'm going to allow myself to take a position. Before 9:30 opens up, we obviously just created our daily bias, right? We understand where have we been. We've been in a overall uptrend. Where are we currently at? We're currently at these highs. We don't want to be buying up here. Where do we anticipate price to go next? We have this 1 hour fair value gap. Well, as just to get a little bit more precise, fair value gap is a little bit large. Something that you can do is you can split up in quadrants. So from the low to the high of this 1 hour fair value gap, you get different quadrants. You have the 25, 50, and 75%. This is how the Fibonacci kind of looks like. Typically, price will always come down to the 25%. So if I were to frame a short up here, or let's say if I were to buy within this fair value gap, I typically want to be buying within the 25 to 50% of this fair value gap level. On a consistent day-by-day basis, before 9:30 opens up, it does one of two things. It either breaks out or it fakes out. I want to see price come down here. A breakout would be price opening up, coming lower, finding support to then go higher. This would fit my narrative of I want to see price come down here to find support to continue higher. It would fit my narrative. Can also happen would be a fake out. If the market opens up and rallies higher, I want to see price stall up here to take a short to come lower. That would be a fake. So at 9:30, the market can either break out or fake out. So it's very important that you have a predistinct plan of where you want price to go. I want to see price come down here. The market opens up and rises higher. I'm not buying up here because this is not in alignment with where I want price to go. So this avoids that situation to where the market opens up and rises and you chase it. If you have a predistinct plan of where you want price to go, you know that this is a fake move. If the market opens up and rises higher, I know it's a fake move because we have a fair value gap down here that I want to see price come down into. into. If you want to avoid those fake outs, you have to create a pre-distinct plan before you start trading on a consistent day-by-day basis. If you don't have a plan in place, you simply don't know what the market's going to do. If it opens up and rises higher, you buy it. If it opens up and goes lower, you sell it. You won't know anything because you're trained blind. You don't want to be trained blindly. You want to have a pre-distinct plan and system in place. See here that the market opens up, sees a nice pop to the upside. We then chase it up here because we understand this is not in alignment with the plan that we wanted. And see here the market sees a drop to the downside. Given that our plan was to come down into this fair value gap, we were already anticipating the lower prices. Anyone who bought as soon as the market opened, they most likely got stopped out. We want to avoid getting stopped out situations to where the market opens. Important to create a pre-distinct plan. The market seen this drop to the downside, it created this inversion fair value gap. This right here was a level of support, but you can clearly see as price breaks through that support level, this would now be a resistance. Usually whenever we're shorting at the highs or I'm buying at the lows, I'm never just going to chase it lower off of the first candle. A lot of times what I'll do is I'll wait for this candle to close and then wait for price to pull back. There's some situations to where you can be anticipating lower prices. Price will give this initial pop lower, and sometimes it'll come higher to take out this original high and then go lower. Well, how to avoid those situations to where you get stop hunted is you never just short off the initial pop lower. Always wait for price to either pull back, or let's say it takes out this high and then goes lower. That's when you can frame the real move. Just a quick tip there. I've taken hundreds of turtle soup trades, catching the buys, catching the lows, on the highs, buying the lows, and this is just a pro tip that I look for every single time that prevents losses. Here price comes back within that inversion fair value gap right there perfectly. It's another pop to the upside. Staying patient is a down close candle right here. We want to see price leave it. Perfect. Off of this right here, we can then frame our short stop loss just back above this high point. Oh, this basically tells us was that inversion fair value gap comes back within this level, finds a level of resistance, breaks away from it. This is exactly what you want to look for. It basically tells us that the market has reached a level to where it can no longer continue going higher. Off of this drop to the downside, we can then frame our short to come down into this fair value gap. And like I mentioned, price usually tends to come down into the 25% of the fair value gap. I let this trade plan out. Price ends up coming back to us break even. That's all right. And it eventually comes down to that 25% perfectly. This is how you want to trade on a consistent day-by-day basis. You have an underlying structure. When are you trading? I'm trading between 9:30 to 11:30, 12 o'clock EST on a consistent day-by-day basis. Market structure is simply order flow, premium to discount. We understand that the market is bullish, but we're too high up. We don't want to be buying up here. I'm anticipating a correction to take place. Liquidity is prominent areas. So prominent areas would be previous day highs and lows, session highs and lows, and equal highs and lows. Above us, we have equal highs and lows plus previous day highs and lows. Given that we just taken out liquidity, it makes it low quality to buy up here because most likely these prominent areas are areas that price reverses at. Given that this is an area that price likely reverses at, for buying up here have a high chance of getting reversed on, which makes the trade low quality. And inefficiencies, fair value gaps, and order blocks. Seeing price break through this bullish fair value gap up here, back into it as an inversion, a one support level now turned resistance, broke lower, coming down into an opposing fair value gap, which is this 1 hour fair value gap right here, 25% perfectly. Instead of getting confused every time you come to markets with all the jargon and everything you have to understand, you put it into a way to where it's structured, to where you know exactly what you're looking for on a consistent day-by-day basis. Probably heard of this strategy. Wait for price to create a liquidity sweep, then you wait for price to create a break of structure, then we have a fair value gap probably within the first 30 minutes of the market open, or whatever time they say. Put your stop loss back above these highs, anticipating a full-on reversal, only for the market to then reverse on you. If you trade like this, it's not your fault. Most of the videos out there on YouTube and most of the traders out there cannot trade themselves, and they're leading you down the wrong path, right? You will never become consistently profitable trading like this. The reason I can be honest with you is because I've been a full-time trader for the last 3 years. The month of March particularly has been a struggle for most traders, but within our community, we've actually been killing it, and it's just like any other month. So being profitable is completely different from being consistently profitable. Right? We're not just winning here and there, we're winning on a consistent month by month basis. And in this video, I'm going to show you the exact strategy that I look for on a consistent day-by-day basis, and how I prepare and structure my trades consistently every single day to keep me consistent at the highest level. And winning on the highest level looks something like this. On one of my 5 funded accounts, you can see I started this account around February 23rd. It is currently March 25th, and within the last month, we've been able to grow this account well over $10,500. $100. I wish I could just tell you, oh, here's this 5-step strategy, 6-step strategy to make money, but that's not how trading works. If you want to be consistently profitable and having results that exceed 99% of trading, the only thing that I ask you is that you watch to the end of this video, because I'm going to take you throughout the exact thought process that I make on a consistent day-by-day basis to get me these type of results, where I'm able to flip any account, investing, $100 into 5 accounts, flipping up into 10,000, or making $20,000 per month. From that, I see most traders struggle with, especially my students before they joined the university. They didn't have any proper preparation before they start trading. They simply would wake up, come to a market, trade, win or loss, and then go about their day. Problem with that is trading is not about more time on the chart. It's about making constant iterations. If you're someone who's been trading for 3, 4, 5 years and you're still unprofitable, it's not because you have not spent more time on the charts. It's because you are stuck in a trap of doing the same thing over and over and over again. I've spoken to traders who've been trading for 8 years, 10 years, still unprofitable. Unless you're able to constantly improve and create preparation within your trading, you will continue to stay in the same exact situation that you are in. If you want to get out of that trap of being a unprofitable trader and reach to the point where you're consistent and able to adapt and trade in any market environment, then you have to create preparation within your trading. And before you ever take a trade, you have to do confluence stacking. First thing that we do on a consistent day-by-day basis is we do a top-down analysis, preparing us before the trade day starts. This is basically assessing where have we been, where are we currently at, where would we anticipate price to go next. And starting off on the higher time frames, we're on the 4 hours. On the 4 hours, we're basically taking note of points of liquidity and then points of inefficiencies, and we'll talk about that throughout this entire video. The first point of liquidity that I want to take note of is previous daily highs and lows. This is a previous daily high, and right here would be our previous daily low. When it comes to previous day highs and lows, these tend to be a point of liquidity that price tends to take out 90% of the time on a day-by-day basis. And usually, sometimes what can happen is price can take out a previous day high and then reverse in the opposing direction, or maybe take out a previous day low, then reverse in the upper direction. But just because these are points of reversal does not mean you immediately short once price takes out a previous day high, when we get into the confluence stacking later into the video. But for now, let's just take note of the previous day high and low as a point of liquidity. Next thing that we want to take note of is inefficiencies. 3 inefficiencies that I look for on a consistent day-by-day basis are fair value gaps, order blocks, and rejection blocks. The rejection block will look something like this. So you can see here how these bodies remain equal, but this wick is much longer than the wick to its right. From the equal bodies here to the highest wick, this would be a level of resistance. And since this is a massive wick here, right, this wick is pretty long, something that you can do is you can split it up into quadrants. So you can go from the low of the wick to the high here. You get the 25, the 50, and then the 75% within your Fibonacci. And the 25, 50, and 75% tends to act as a resistance level. And confluence stacking is basically multiple things stacked on top of each other to give you an idea for where price is going next. Looking at this example here, you can clearly see you've taken out a previous day high, which is a level that price can reverse from. Not only have we taken our previous day high, but we also have a level of resistance above us, which is this bearish rejection block. See, given these circumstances of where we're at, would you say that we're most likely anticipating higher prices, or would you anticipate lower prices? Most likely you would be anticipating lower prices. We have resistance above us, thus we've also taken out a level of liquidity. So this would create an emphasis as to why you should anticipate lower prices. And this is what you call confluence stacking, putting multiple things on top of each other to give you a high likelihood of why price should go a certain direction. And whenever I'm trading on a day-by-day basis, I'm looking for the easiest setups. I'm not looking to predict the market. I'm not looking to be better than the market. I don't have all these steps and rules. Gotta wait for this, gotta wait for this, gotta wait for this. No, I'm looking for the easiest trade. At resistance, we've taken out liquidity, we've done this, we've done this, we've done this. This is so no-brainer that it's gonna go lower. Those are the A+ steps I look for on a consistent day-by-day basis. As you finish this video, you'll be in the same position where trading will just be a lot simpler. Below us, something that I took note of as well was this order block. So this right here is the last down close candle before this pop to the upside. Below this order block, we do also have this rejection block below us. And since this order block is a little bit larger, we want to split this up into 50%. Go into settings here and mark out the middle line. So this ties into creating a story. We've been seeing higher prices, but we're at a level of resistance. Let's see, when the price reached back above this resistance, it couldn't break higher following this push to downside. We're seeing this push to downside where we can anticipate price to come down into, well, we can anticipate it to come down into these levels of support below us, like this order block, as well as possibly continue lower down into this rejection block as well if it were to continue lower. You can clearly see how we didn't just come to a market guessing, but now we have a pre-distinct plan of what we're anticipating to happen next. So this is just on the 4 hours time frame. I'm gonna go down to 1 hour's time frame to get a little bit more information. 1 hour's time frame here, we're basically doing exactly what we did on the 4 hours, but we're getting a little bit more information. So we took note of the 4-hour bearish rejection block above us, as well as we took note of the previous day high, which was right here, as well as we do have the 4-hour order block plus the 4-hour rejection block below us. So obviously when we were creating our story, it was basically we're at a level of resistance and we want to see if price struggles to break up here, we can see lower prices come down into this level of support. Something else that also I can take note of is session liquidity. So this right here would be the ASA session between 8 p.m. EST to 12 a.m. EST. So you see we have these ASA session lows, right? ASA session highs and lows, these are points of liquidity that price tends to take out 70% of the time. So if we're anticipating lower prices, most likely price will be reaching down into these ASA session lows, as well as we do have these London session lows between around 5 a.m. EST. So this right here would be our London session low. Clearly see here that we have points of liquidity from the prior session below us. So this would be a frame of targeting, as well as within that 4-hour order block, we can also take note of this 1-hour order block right here. It's a possible level of support, right? Just to make things a little bit more precise, instead of just coming to our markets and just willy-nilly buying when the market's going higher or buying when the market's going lower, we have a pre-distinct plan of what we're anticipating to happen, right? More so often than not, it makes sense to look for lower prices, take out a previous day high at a higher time frame level resistance, and we have multiple points of liquidity and inefficiencies below us to target. If we take a short here, we can anticipate price to take out the Asia session lows and these London session lows, as well as we do have a level of support like this bull shorter block below us, as well as above us we do have this last up close candle right here. So this last up close candle, or this massive drop to the downside, is a bearish order block. This right here would be a 1-hour bearish order block, which you can clearly see that price has come back into it once, broke lower, came back into it twice, broke lower. So obviously this is telling us that there's strong resistance up here, and just like that, it makes trading a lot more easier. When we have multiple confluences, we have the liquidity sweep, we have the resistance above us, we have levels of targeting below us. When we have multiple confluences on top of each other, it gives us a high probability identity to tell us it wants to go lower, man. Like, so why are you trying to force the market? Stop trying to force the market. If it's telling you it wants to go lower, you have to be in alignment with it. This is how I trade on a consistent day-by-day basis. It's not about creating step by step. It's not about trying to predict the market or catching these 10R 20R trades. You'll never be profitable trading like that. It's about trading in alignment with where the market wants to go. Like, too many people are trying to chase the market or be better or ahead of the market, when if you simply just trade in alignment with what the market is telling you, you'll just make money. And this takes your trading from becoming complicated or confusing to becoming very simple, to the point to where you're just doing the same thing every single day in and day out. I do the exact same thing, almost like a job, and at the end of the month I get paid $20,000, $30,000. It can really be simple, but you have to simplify it, and I've been able to simplify the process for hundreds of traders. Watching this video and you're getting value and you need my help, the first in the description, book a free call, talk to me personally, let me see where you're at, and let's build out a game plan. For now, let's go down to a 50 minutes time frame. Now that we're down on the 15 minutes time frame, I tend to trade between 9:30 to 11:30 a.m. EST on a consistent day-by-day basis. Coming into our marketplace this morning, it's pretty simple. We have levels of resistance above us, taking out the previous daily high, as well as we have areas of targeting below us, like this Asia session, this London session, and then this order block, as well as we do have this bearish fair value gap right here. And this is where a lot of traders get messed up. See the liquidity sweep, they see the resistance, they see the fair value gap, and they take the trade here, predicting that it's gonna go lower. Now what we do, we don't predict the market, we wait for the market. So instead of just taking the trade when price comes back into this fair value gap, we want to see price not only come back into a fair value gap, but we also want to see market synchronization, which I'll talk about that later on. As the market opened up, this was my exact plan. I'm anticipating price to find resistance within this fair value gap, go lower. I'm not just going to take a short within the fair value gap, I'm going to wait. You need to see the market come back into this fair value gap and then leave it, because the market can easily create a fake out where it can can open up, see a massive spike to the upside, and then go lower. So if you try to be ahead of the market or predict the market, you will get fate. So 930 is about to open up right here, and you can clearly see it opens up, sees a massive push to the upside, takes out this high right here, as well as takes out this high right here. And like I mentioned, you want to wait for the market synchronization. I wanted to see a breakout setup initially. As the market's inside this fair value gap, I want to see it open up and come lower. But the reason why I didn't take a breakout setup is because if we look at the correlated markets to the S&P 500, which is the Nasdaq and the Dow Jones, it did not do that. So you can see here that the Nasdaq opened up, saw a massive route to the upside, followed by the Dow Jones. It opened up, seen a massive route to the upside. If I want to be looking for lower prices, I want to see price hold within this bearish fair value gap, and I want to see all three markets go lower. I want to see the S&P go lower, the Nasdaq go lower, and the Dow Jones go lower. None of the markets opened up and went lower. All three markets opened up and went higher. So what I do, I stayed patient. The problem is you guys will see a fair value gap, you guys will see a liquidity sweep, you guys will see a break of structure and immediately take a trade, when you have to be a little bit more patient, because the market is not revolved around patterns. The market is revolved around order flow. And if all three markets are rallying higher, does not mean you short it trying to predict it. So I was patient as the market opened up and went higher. Now, something that happened here that added to my confluence stacker was a SMT divergence. So you can clearly see here how the S&P came higher to take out this original high right here. But look closely to the Nasdaq. Nasdaq did not take out that same high. That is a clear SMT divergence where one correlated market took out a high, but the other one didn't. This right here is another confluence added on top of it. You can see the Nasdaq came higher, gave this nice rejection to the downside. The Dow Jones came higher, gave this nice rejection to the downside. S&P came higher, SMT divergence, nice rejection to the downside. Not only did we take out a previous day high, only are we within a resistance, not only is there an SMT divergence, but we also have a nice rejection at these highs across all three markets. So at this point, I framed my short, put my stop loss just back above these highs. Now the market is ready to go lower. And where am I targeting? I'm targeting the area that I know price is going to hit. Like I mentioned, the A's and lows will usually be hit 70% of the time on a day-by-day basis. So my take profit was just below the Asia session lows for around like 22, 23 points. And you can see within the next candle, price sees a nice drop to the downside, eventually taking out the Asia session lows, my exact take profit perfectly. You can see here on my trading journal, made about $982 across all 5 accounts, close to about a $5,000 day, as well as showing the broker statements for added transparency. You can see made about $982, just like you've seen on the dashboard. Go over the performance for the day here. See $982 performance for the week here, about $1,200 for the week performance for the month here. These are the exact broker statements, by the way, about $9,160 for the month, split across 5 accounts, $50,000. If you're a beginner trader or you've been trading for some time and you're still not consistently profitable, I'm going to give you the exact 4-step roadmap that you need to becoming a consistently profitable trader within the next 90 days. The problem with most information on YouTube is everyone talks about strategy or the next model, and you'll probably find yourself in a position where you're going from strategy to strategy and you have a hard time when it comes to coming to markets and putting it all together. You understand all the concepts like fair value gaps, order blocks, liquidity, but how can you put it into a routine to where you can come to a market consistently every single day, know whether it's going to go higher or lower, and make money consistently? Not just have a big payout here or a small payout here, but consistently make an income every single month to potentially add additional income or replace your 9-to-5. This is the exact same roadmap that helped me make over $12,000 last month's trading. For the month of January to February, I'm up over $30,000, and towards the end of this year, my goal is to make anywhere from $200,000 to $300,000 per year trading, and this is something that I do consistently. Now, obviously, it's not easy, but it is possible. Through this 4-step roadmap, I'm going to show you exactly what I do step by step to achieve these consistent results. So the only thing I urge you to do is watch till the end of this video if you want to get the most value in becoming a consistently profitable trader. Now, let's get on to the first lesson. Our first lesson is developing our strategic edge. And your strategic edge is basically how you interpret the market. It's basically your strategy that you look for on a consistent daily basis that gives you an advantage over everyone else. The problem with most strategies is there's too many steps. Some people are like, oh, I'll wait for a liquidity sweep, then I'll wait for a break of structure, then I'll wait for fair value gap, then this and this and this. The problem with trading like that is it relies on probability. Sometimes you might get all of the steps that you have, like the liquidity sweep, like the break of structure, like the fair value gap, and it can still lose. If I want the biggest advantage, I don't want to be trading like that. I want to be trading in alignment to what makes the most sense. That's the highest probability. That's your strategic edge. It's the highest probability trade that you can take that day that's above all else. And this is the exact trade that I took this morning, which you can clearly see here. I was able to buy at this exact low and I was able to sell at this exact high. And a trade like this made me over $2.6 thousand this morning, as well as a trade like yesterday, which you can clearly see I was able to buy within this fair value gap right here and sell at this exact high. I bought right here and I sold back above this high. This trade yesterday made me over $4,000. So just 2 days into a month, I'm already up $6,000. And I'm looking to make anywhere from $20,000 to $30,000 this month, and I do this consistently utilizing this one strategy. Whenever I come into a market, I create my daily buys. Basically, I start off on a higher time frame and make my way down. I'm basically assessing where I'm at within the market. Are we going to go up or are we going to go down? And I try to find the highest probability setup. My way of trading is I try to find the easiest trade or the highest probability trade. If it's not high probability, I will not take it. This is how I'm able to be in a position to where I take less trades, but even though I take less trades, I make a lot more money. I focus on not only having a high win rate, I also have a high R multiple. And whenever you're creating your day buys, you have to understand that the market revolves around these three things. First would be market structure, and it would be liquidity, and last but not least would be inefficiencies. The 4 hours time frame here, the first thing that spots my eye is this low right here as a area of liquidity. So we can clearly see here that during the Asia as well as the London session here, right, Asia is between 8 p.m. to 12 a.m. EST, London is between 2 to 5 a.m. EST. So between those two time periods before the New York session, price had seen a push to the downside and it took out an area of liquidity. And following taking out this area of liquidity, also take note of this low right here. Price did not take out this low. Taking out that liquidity, we see a slight push to the upside. Right, this is pretty good. Thing else that I can take note of is this gap. You can clearly see here how the market opened up and created this gap to the downside. So I'm going to take note of this gap level as a possible inefficiency. And there's a multitude of inefficiencies within the markets. One of the inefficiencies would be gaps. So when price creates these gaps within the markets, the price tends to come back into them. This would be a potential area of targeting. As well as just looking at the overall market structure, you can see that we have been in an overall downtrend, creating consistent lower lows and lower highs up until we took out this area of liquidity. Whenever we're creating a day buys, we're simply just assessing where are we currently at within our trading range. We're marking out areas of liquidity. We're understanding the overall market structure. We're taking note of any inefficiencies that we see within the market. So the three things that I took note of is this low right here. I took note of this liquidity, which we then swept, as well as I took note of this gap above us. So now I'm going to go down to the 1 hour time frame, get a little bit more information. On the 1 hour time frame here, it basically gives me additional context that I may not have seen on the 4 hour. So on the 4 hours time frame, the only thing that I saw was price coming lower to take out this area of liquidity, price having this low below us, as well as this gap above us right here. So these were the three things that I took note of on the 4 hours time frame. But on the 1 hours time frame, I get a little bit more information. Right here, as the market is opening up, we do want to take note of this bullish fair value gap. Right here is a level of inefficiency, which is also a higher time frame support level. So the separation between this candle's high versus this candle's low basically creates a gap within the market. So this would be a level of support. So as below us, we do also have this order block. This is essentially the last down close candle before we see this push to the upside. Only do we have this fair value gap plus this order block below us, but above us, we can take note of this Asia session high. The Asia session highs and lows are areas of liquidity price tends to take out 70% of the time. So if the market is bullish and price has yet to take out the Asia session highs, this would be an area of liquidity, meaning that this could be a level that if price can find support here, we can come back up into. So we took note of this fair value gap, took note of this order block, and we took note of an area of liquidity above above us. And some other things that we can also take note of just to mark them out would be this bearish fair value gap up here, tiny fair value gap, which you can see price did tap into following this drop to the downside. And you could possibly technically say this last up close candle would be a bearish order block. Looking at the 1 hour time frame, it's pretty simple. Price came lower during the Asia and the London session to take out this prior weekly low, right? This was the low of the prior week. Price took out this prior weekly low. We seen this push to the upside. Very important to note that price had a level of resistance up here. So once it came higher once, came higher twice, it could not break above resistance, right? It's very important that if price has a level of resistance that it cannot break above, it has to come lower. If price comes lower and finds support, it comes back up into that same resistance, it would most likely break through it. See here, price could not break above this resistance, which is that order block plus fair value gap. So we're seeing a push to the downside. And the problem where a lot of traders mess up at is they don't have situational awareness. Right? A lot of traders would see a rejection at these highs and they would most likely place a short here thinking that the market is going to go lower. And even though this isn't a bad way of trading, you have to be aware of where you're at to understand that we are within a higher time frame support level. Like this right here is a bullish fair value gap, and below us we have a bullish order block. The only way that we would frame a short within this market is if we could see price make an effort to break through these support levels and then pull back into them as resistance to then go lower. As long as you're within a support level, you have to continue to remain bullish, especially since we're on a higher time frame. My main emphasis coming into the markets would be if the market can find support here within this bullish fair value gap, or maybe come lower into this order block and we find support to go higher, I would frame a buy to reach back above this high point and reach back above these Asia session highs. You can clearly see here how I had no rules. I didn't say I was look for this one thing and then this next thing and then this next thing and then this next thing and then look for an entry. No, don't want to limit yourself to all of these crazy rules that you probably can't remember before you place a trade. Whenever you're looking at the market, you assess what is currently going on now. As well as I'm not relying on any indicators. I'm trading based upon what's currently happening right now, what I anticipate to happen next. Now I'm going to go down to the 15 minutes time frame. Whenever I'm live with my students, I start my live at 9 a.m. and I create my bias or my plan with them every single morning. The reason why you're not in a position to where you're consistent in your trading is because you do not have a routine or a plan before you start trading. You most likely just hop onto your charts, maybe mark out a couple things and anticipate. I create every single morning detailed structured plan, just like how I just did with you guys, of what I'm anticipating to happen. Like, this is how you turn your trading from simply just a hobby or something that you do on the side to now you're treating it legitimately and you're actually putting in the effort to become better. A lot of people just trade, but they aren't making any improvements, right? You're probably in a position to where you've been trading for 3 months, 6 months, maybe a year, and you feel like you're still in the same spot. Well, it's because you are, right? It's very easy to fall into the trap of being on a hamster wheel in your trading journey, where you're just doing the same things over and over and over again, making the same mistakes over and over and over again, not understanding why you made those mistakes or why you're not improving. By the end of this video, I'll help you get out of that hamster wheel. If you remember our daily bias, we were anticipating higher prices, and whenever the 930 opens up, it does one of two things. Since I'm anticipating higher prices, I want to see either a breakout or a fake out. I want to see the market either open up, see a rally to the upside to where I can take buys to reach back above these high points, or I want to see the market open up, come lower, find a level of support here to then go higher, right? These are the two main things that the market does every single time that it opens up, right? This is why it's important that you create a plan. So since I'm anticipating higher prices, if the market were to open up and go lower, thousands of traders would probably chase it lower. But I understand that there's a level of support here. So instead of chasing it lower, I'm already seeing that this is a fake move and will eventually reverse. This is how you need to be trading on a consistent daily basis, creating a plan before the market opens up. You don't fall into bad psychology of chasing trades, getting faked out, and so on and so forth. So my main emphasis for this day was higher prices would either open up, break out to the upside, or if it opened up and came lower, come down into its order block, find support to go higher. And the reason why I'm anticipating higher prices is because we are within levels of support from this 1 hour fair value gap and this 1 hour order block. As long as we're within this support, I want to be continuously looking for long, unless price were to break through these levels and pull back to find resistance to go lower. You can see here that 930 opens up, actually opens up and comes lower. Remember what I said, I'm not going to chase it lower because I understand we're at a level of support. The market initially opens up and comes lower, and then it comes right back higher into my entry. So this right here is where I was able to frame my long, my stop loss back below this low, reaching back above higher prices for 21 points right up into this fair value gap. Something that I do within my trading is I scale in, and if you don't know what scaling in is, it's basically adding to your winning position. So whenever I'm scaling into my trades, I want to scale in when price either breaks structure or price breaks above a level of resistance. Since I'm buying here, this right here would be a level of resistance, which would be a bearish order block, right? If you're bullish, you want to see price break above last up close candle, and vice versa could be said for bearish. To be bearish, you want to see price break below last down close candles. So seeing how price found support here and broke above this last up close candle right here, I scaled into my trade. And my new entry was right here. And what I do when I scale in is I trail my stop loss. Instead of having my stop loss all the way back down here, I trail my stop loss higher. So if my initial stop loss was 15 points and I was risking $300, my new stop loss would be 10 to 12 points, risking $400. But when I went on this trade, instead of just making $400, I made over $860 on this trade. So basically, I'm risking an additional $100 to make $400 whenever I scale in. This is my exact risk management system that I use on a consistent daily basis that gets me a 4R, meaning for every dollar that I risk, I make $4 back, meaning I can have as low as a 25% win rate and still make money trading. This is what I teach to all of my students. You don't need to be perfect and you don't need to be chasing these high win rate models. You simply just need to choose higher quality setups, and when you get that great trade, you maximize on your reward and you keep your losses small. An average loss for me would be anywhere from $200 $400 max. An average win for me would be anywhere from $800 to $1,200 max. This is how I'm able to be consistently profitable even if I take losing trades, is because my wins are so massive that I don't even notice my losses at all. As well as, since I'm only choosing high quality trades, I have a very high win rate. So not only do I have a higher multiple, but I also have a high win rate, and both of these together makes me incredibly profitable. Step we're going to be going over is overcoming your psychological problems. And if you're someone who is in a position to where you keep making the same psychological mistakes, it's likely due to a lack of preparation or a lack of patience. And I'm going to break down today's trade because it's a great representation of what true self-control and discipline looks like. So I'm currently on the 1 hour's time frame, and for this morning when I was trading live with my students, I was anticipating higher prices, right? We can see here that the market was seeing a steep decline to the downside, and obviously having situational awareness, I'm not going to be shorting down here at these lows. It just would not be the highest quality setup, but I'm also not going to be just buying here either. This was my exact plan. So what I wanted to do was I want to see price open up, and I wanted to see price come lower to take out this low right here. And if it can take out this low and see a push to the upside, I can possibly take longs, reaching back above higher prices. This was my exact game plan this morning. So as we do have areas of liquidity above us, this high as a potential area of liquidity that price can then take out, as well as I took note of this fair value gap up here as a area of targeting that we can come back up into. So now that I'm down on the 15 minutes time frame, one of the psychological problems that you guys may be struggling with is FOMO, basically chasing trades. How to overcome FOMO is simply by creating a plan. Since I'm anticipating anticipating price to come down here to find support to go higher. If the market were to open up and rally higher, I'm not going to chase it because that's not in alignment with my plan. The problem that you guys have when it comes to psychology is you allow the market to control you and dictate your very actions. If the market were to open up and rally higher, you would chase it higher. If it were to open up and rally lower, you would chase it lower. You're allowing the market to have control over your every decision. You have to shift your mindset from allowing the market to chase wherever you're going to you having control over the market. Basically, if the market were to open up and just rally higher, I would not take a trade because it's not in alignment with my plan. Because the original plan that I had marked out was I want to see price open up, come lower, find support down here, and then push higher. If it were to just open up and rally higher, it's not in alignment with my plan, and I'm perfectly fine with not taking a trade. The problem is you guys come to markets every single day expecting it to give you something. The market will give you what you're looking for. You don't chase what the market does. You allow it come to you and trade what you want it to do. You have to take control over the market than the market having control over you. The market opened up here. You can clearly see it opened up and it rallied higher. A lot of people seeing that the market's seen this big drop to the downside, a lot of people took buys here, most likely thinking it's going to go higher because the market opens up and rises higher. Yeah, it's going higher. Let's chase it higher. Let's chase it higher. All of those shares got stopped out. Prevent yourself from chasing the markets. You create a plan and you wait for price to come to you in alignment with your plan. And if it doesn't, you are okay saying, not coming in alignment with my plan, I'm going to be patient and I'm going to wait. The problem is you guys want every single move. Market goes up, you want to go up with it. It goes down, you want to go down with it. It goes sideways, you want to go sideways with it and blow your account. Don't chase every single move. Chase the move that you planned and you waited for. Or you'll find yourself chasing every high and low, high and low, high and low until you blow your account. So you can clearly see here the market rejected and it eventually got down into that low. But just because it came down into this low does not mean I'm going to take a buy just yet. I want to see price establish itself. Basically, I want to see price come down here, hold within this level, and then leave it. See here, this next candle opens up. See price, see this initial pop to the upside. It's this doji candle, still remaining patient. Price ends up seeing one more push to the downside. I'm still remaining patient. I'm still looking for longs, but I'm being patient. I want to see price create a nice bullish engulfing candlestick or give me some type of signature that it's found support. And see here, the market ends up seeing a rally to the upside. Bang. Like I mentioned, wanted to see price come back below this low and I wanted to see it hold support. So once price seen this big drop to the downside, it created this really nice bullish engulfing candlestick. At this point, I framed my long and I put my stop loss back below this low. And I usually permit myself 2 trades per day. So you always want to have rules and systems within your own trading. On an average trade, I risk anywhere from $200 to $400 if I scale in. So on this trade specifically, I was risking about $250 to make $500 on this trade, about a 2-to-1 R. Since I allow myself 2 trades per day, if price were to come lower and let's say stop me out and then go higher, I would take my second trade. And since I always have at least a 2-to-1 R, if I win that second trade, I'm up on the day. So you can clearly see here how I don't need to be perfect or win every single trade to make money. I only need to take 2 trades per day. In the last 3 weeks, I've been on a consistent winning streak where I have not taken a single loss within the last 3 weeks. Right now, even though I take 2 trades a day, lately I've only been taking 1. That just comes from years of experience being a very good trader. So you can see here, market opens up. This point this morning, I did want to scale into this trade, but if I would have scaled in, if you remember, I have to trail my stop loss. So I would have my stop loss be from down here to up here. I didn't really feel comfortable doing this. So for this trade here, I didn't scale in. Instead, I aimed for more profit. Saying that this is the exact bottom, instead of aiming for 20 points, I aimed for 25 points, making me $500 on this trade. So even though I don't scale in on this trade like I usually do, I still made a lot more money compared to what I risked. Here, price ends up finding support, gets all the way back up to my take profit, and even continues even higher. On average, I have a 3-to-1 R to 4-to-1 R, but sometimes on days like these where it's a little bit profit, it's at the very least a 2-to-1 R. Whether I have a 25% win rate, 50% win rate, I will consistently make money. Our third step is our risk management structure. My specific risk management structure is I scale into my trade. So if you remember in the first example where I took the buys at these exact lows, took my first entry right here within this candle, and I had my stop loss back below this low. Like I mentioned, I scale in once either price breaks structure, like let's say it breaks above this high, or it breaks above a level of resistance. So this last up close candle right here would be a level of resistance. So as price breaks above this level, I would then scale into my trade. So my new entry would be up here, and I would trail my stop loss from back below this low to anywhere from 10 to 12 points, aiming for the exact same amount, which is 20 points. Usually within my first trade, I start off with 4 contracts with a 15-point stop loss, basically risking $350. And when I scale into a trade, I adjust my stop loss from 15 to 10 points. So I go from risking $350 to risking $400. My average take profit is anywhere between 20 to 25 points. When I scale in, aiming for the same 20 to 25 points, I make anywhere from $800 to $1,000 per trade, but I only scale into trades that are high quality, meaning that since I bought down here and price broke above this last up close candle, this is a A+ setup. It's telling me that price wants to go higher, meaning that this is a A+ setup trade. And usually when it comes to A+ setup trades, I have over an 80% win rate. So me finding myself in a position to where I have a stop loss trade of losing $400 is very low, meaning my average stop loss trade or my average loss within the markets is $315. If my average loss is $300 but my average win is $800 to $1,000, that's a 3-to-1 R. For every dollar that I put into the markets, I will make $3 back, meaning that I can have as low as a 25 to 33% win rate and still be consistently profitable at the end of the month. And this is exactly what I teach my students within my trading university. I don't teach my students to be perfect, to win every single trade, to have a high win rate or stress them out. I teach my students to be patient, to be calm, to allow the markets to come to you and focus on good psychology and good risk management to carry you forward. It's very easy to build a career trading when you're not trying to be perfect. Not everybody can have a 70, 80, 90% win rate. Not everybody can have that, but anybody can have a 30% win rate. It's not hard to lose. But what if you had a 30% win rate and still made money? You're not perfect. You didn't win all the time, but you still made money. That's what I try to give to all of my students. You don't have to be perfect to make money consistently. This is my exact risk management structure that I utilize on a consistent day-by-day basis. And since I take 1 to 2 trades per day, my average loss is about $300. On a really bad day where let's say I take 2 losses in a row, the max that I will lose is $600. That $600 loss is made up in just one day of hitting 20 points with no scaling. Or if I had a day where I scaled in, I made $800 to $1,000, that loss is completely made back. General gist of trading is you want to focus on the next day. If you have a losing day, don't try to make your money back that same day. You have to understand that in the long run, you will make the money back, whether it's the next day, the next week, or the next month. Your mindset from short term, you took a loss, or long term. On my system, I take 1 to 2 trades a day, I risk within my risk parameter, and I focus on A+ quality setups. Missing trades, I'm not revenge trading, I'm not over leveraging, I'm allowing my system to do its work. And this is how I make $20,000 per month consistently as a full-time trader without needing to be smart. It's simply just math. And last but not least would be journaling. In my trading university, I built out a personalized software for my students to keep track of everything, right? I'm someone who's very analytical of everything that I do. My winning trades, my losing trade, the end of the week, the pre-market routine, everything that can be tracked, I am tracking to improve upon my trading. You're probably in a situation to where you're making the same mistakes over and over and over again, and you don't understand why you're making these mistakes. It's because you're not tracking them. You don't know why you won. won. You don't know why you lost. You don't know why this week was so good and you made so much money. You don't know why this week was so bad and you blew your account. And if you don't understand these things, you will continue to make the same mistakes over and over and over again until you make real progress. When it comes to trading, even though you can be trading or looking at the charts for 3 months, 6 months, a year, 2 years, 3 years, that does not mean you're making progress. I've had students who come to me and tell me they've been trading for 5 years and they're still unprofitable, while I've been able to coach students and take them from complete beginner to consistently profitable in 3 months. The difference between someone who's been trading for 5 years versus someone who's been trading for 3 months and became consistent is not about the time span or if one person is better than the other. Friends, is the person that I was helping for 3 months, we tracked everything. Why was this person winning? Why was you losing? Did you create a plan before you start trading? What happened at the end of the week? What notes, lessons, insights did you learn this week to get better? If you're not constantly improving as a trader and keeping track of everything and journaling, you will remain in the same situation month after month after month, and you will be in a situation to where you can easily find yourself trading for 2, 3, 4, 5, 6, 7, even 8 years and still not make a single dollar. And that's the harsh reality of it. Until you can start looking at the analytics, how you can improve, seeing how you can get better, seeing where you're struggling at, seeing your mistakes, seeing where you're good at and do more of, you will continue to remain in the same loop. My journal that I've built out for my students, keep track of everything. So pre-market routine basically looks something like this, and you can see this goes over what news we have today, what's the draw on liquidity, what's your daily bias probability or low probability day, before and after screenshots. Same thing, what's your draw on liquidity, what's your daily bias, is today high probability or low probability, as well as did you make any mistakes during the prior session and what improvements can be made to not repeat it. Something that you guys will do is you guys would blow your account on Monday and then come into Tuesday not knowing why you blew your account and never learn from it. So let's say we traded Monday and we blew our account. Into Tuesday, what mistakes did we make during the previous market session? We would say we blew our account, and what improvements can be made to not repeat that would be, I blew my account yesterday. I understand the main key point as to why I blew the account was due to over trading, was due to FOMO, and due to over leveraging. So since blowing my account, I have learned from these mistakes. So coming into today, I am not going to repeat those same mistakes yesterday. Instead, I'm going to create a plan to stick to 2 trades today. And if it's not in alignment with my plan, I'm able to walk away. This is the stark difference between someone who just trades willy-nilly, comes to a markets Monday, Tuesday, Wednesday, Thursday, just trading. Oh, I don't know why I won. I don't know why I lost. I don't know why I blew the account. To someone who is, okay, I won because of this, I blew my account because of this, and this is how I can get better. Until you start making progress, you will remain in the same situation. So this would be the pre-market routine. It would be a end of week review. Basically name something you did well this week, what could you have done differently, challenges do you overcome this week, did you show up prepared, observations, notes, insight. It just goes over what happened this week, why did you win this week, why did you lose this week, what lessons can you learn this week to take in the next week that you can be better. Constantly want to be looking at where you're struggling at, what mistakes are you making, or what are you good at, and constantly improve from it, right? If you're not making constant improvements, you remain in the same position. Generally, you can keep track of winning trades. Why did you win? What setup was there? And how can you win more? Keep track of losing trades. Why did you lose? What permitted you to take that trade? What were you thinking at the time? And what can you put in place to prevent yourself in the future? Keep track of your charts, like back testing when it comes to weekly profiling, tape reading, breakdowns, as well as keeping track of your psychology. If you have a situation to where you had a greedy day, basically come in here and you talk about it, right? What influenced you to feel greed? Maybe you had $100 left on your funded account. Maybe something caused you to just, want to get more than you would chew, and price then reversed on you. Everything has a psychological trigger, and whenever you're in a situation to where you blow your account, it's most likely due to a snowball effect. Let's say you're $100 from passing your funded account, you got greedy, and then price came back on you and you lost $400. That was the psychological trigger. Is you were up on the account, you only needed $100 left, and now you're down $400. Now you're angry, so you take another trade, it loses, you take another trade, it loses until you blow the account. So your outcome from the trigger was blown account. So now that you blew your account, you understand exactly what happened. I got greedy. I wanted $100 because it would pass my funded account. The trigger was I lost $400 due to my greed, and I kept trading and revenge trading, and the outcome was a blown account. Now what can we put in place to stop ourselves in the future? Instead of taking profit based upon how much money I want to make, I have to take profit based upon what the market gives me. Meaning, if I'm $100 away from passing my funded account, doesn't mean I need to hold for that additional $100 if I see the market is reversing. Meaning, I have to focus on what is the market telling me and not try to force myself onto the markets, because if I allow myself to get triggered, I will go on this spiral effect or this snowball and eventually blow my account. Every single blown account is based upon a snowball effect that comes from an initial trigger. So a trigger would be greed. Another trigger would be over trading. You took 2 trades, they both lost. You took a third one, even that lost. Oh man, I took 3 trades now, YOLO. And then you blow your account on the 4th trade. Overtrading would be a psychological trigger. So what you could put in place for overtrading is you would have a rule that lets you take 2 trades per day. If both those trades lose, you have to walk away, because you understand that if you take a 3rd trade, you're more likely to go into that snowball effect and eventually blow your account. So how to prevent yourself from going on these snowball effects and blow your accounts is by understanding the psychological trigger puts you in that position where you blow your account. And whenever you experience that trigger in the future, you know, last time I took 3 trades, I blew my account. I took 2 trades and they both lost. I know that if I take a 3rd trade and it loses, I'll blow this account. I'm not going to take a 3rd trade. That's how you make progress with your psychology, slow and steady. Identifying your triggers and stopping yourself the moment you realize it. Within the last month, I've made well over $11,000. So you can see this is when I started this funded account at around February 23rd, late February, and it is currently March 26th. I've had this account for well over a month now, and on this one channel, we've made $11,000, not taking into account the other 4 accounts that I own. And just to quickly refresh here, you can clearly see $11,000 net profit on this funded account. As well as this morning, you can see this is the exact executions that I took, being able to short at these exact highs and buying my position back at these exact lows. And in this video, I'm going to give you the exact step-by-step framework that you need to understand if you want to make your first $10,000 a month trading. It's not as simple as people make it out to be, right? Most strategies out there is literally just wait for this to happen, wait for this to happen, wait for this to happen, then take a trade. Oh, you know, a lot of trading, especially at the high end level, revolves around more than just strategy. Strategy is something that you look for on a day-by-day basis. In this video, I'm going to uncover the things that nobody is talking about, how to be more patient, talking about risk management as well as overall psychology towards the end of the video. So the only thing that I ask you throughout this video is that you watch till the end. If you want to become a consistently profitable trader and be at a position to where you're making consistent $10,000 a month, if you cannot watch till the end of this video, I don't necessarily know what to tell you, because this video is going to be step by step by step, showing you guys the exact blueprint that you should do on a consistent day-by-day basis if you want to be consistent. I've spoken to hundreds of traders, and whether you're a beginner trader or you've been trading for some time but you're still inconsistent, these tend to be the 5 problems that come up within your trading that by the end of this video I want to help you fix to help make your first $10,000 a month. One of the most common problems within traders is inconsistency within a system. Probably in a situation to where you're on YouTube University, right? One week you're learning about the orb, next week you're learning about this strategy, next week you're learning about that strategy. One day you're trading gold, then you're trading Nasdaq. Inconsistent within a specific system, and every single week you jump from strategy to strategy to strategy to strategy. And what you don't realize is every single time that you learn a new strategy or learn a new way of trading, you actually reset your progress. So you can be a position to where you've been trading for 6 months, but if you have switched your strategy 3 or 4 times, every single time you're starting over from scratch. So in this video, I'm going to give you a exact strategy that I want you to trade on a consistent day-by-day basis, as well as a specific pair that you should be trading on a consistent day-by-day basis, and focusing and locking in on that and staying consistent with it, so you no longer have to consistently switch strategies or switch how you trade, right? Focus on one thing and get very good at it over a long period of time, because every single time you switch, you reset your progress. Next would be a lack of understanding technicals, right? There's a thin line in trading between something being too simple and then something being too complicated, right? You don't want to be trading in a way that's too simple, right? You've probably heard, generic advice. Market is creating higher highs and higher lows. When it pulls back, you find support to take it higher. Simple to the point to where if there's a situation to where the market changes, how are you able to adapt from it? Because the market isn't always going to look like higher highs and higher lows. Sometimes it may create higher highs and higher lows, come lower, take out this low, take out this low, find support down here, and then push higher. If you do not know how to trade in that type of market environment, you'll most likely find yourself in a situation to where you think the market reversed, only for it to then go in your favor. Advice like higher highs and higher lows you buy on a pullback is too simplified advice. As well as another simplified advice would be trend lines, right? If the market breaks below trend line, you should look for shorts, only for the market to break above you. You don't want your trade to be too simple, but you also don't want your trade to be too complicated either. This is a common problem that traders struggle with when it comes to learning ICT concepts, is it was a little complicated to where they could not piece it together. That's exactly why I created my YouTube channel and started teaching, because there's a part of trading that's too simple that no one becomes profitable because the advice is too simple. Then there's a part of trading that, even though it works, it's a little too complicated for the common trader to learn and master. But when it comes to creating these videos and teaching you guys, I try to be in the middle, very simple, step by step, and easy to understand, but not too simple to where a lot of those complexities that happen within trading are missed. So I try to keep it between the middle of not too simple but not too complicated, so you guys will learn. And throughout this video, I'll go over my exact strategy and how I trade consistently. The third is entries and executions. I have a lot of traders come to me when it comes to, okay, I understand ICT or SMC or how to trade, but I don't get the best entries, or I don't know what to look for when I'm coming to markets on a consistent day-by-day basis. So in this video, I'm going to cover how to get those precise entries, how to avoid fake outs, so you can position yourself in a way to where you're no longer getting faked out. You have a predistinct plan every single time you come to a market, and you become consistent. Towards the end of the video, we're going to go over risk management, psychology, and adaptations, right? Everybody on YouTube loves to talk about strategy, this strategy, that this is the new hottest 80% win rate strategy, but that's not what's going to keep you consistent. What makes you a consistently profitable trader is the risk management aspect of it. Are you able to keep your losses small and maximize your rewards? Are you able to have good psychology to not chase the market or make irrational decisions? And are you able to adapt? March has been a difficult month for a lot of traders given to the war uncertainty, but as a consistently profitable trader myself, I've made well over $20,000 this month. Last month made $20,000. Even as the market changes and it gets more difficult, I'm able to adapt and still have the same exact results, right? These are the little things that goes into your trading that nobody talks about, that keeps you consistent if you want to make that first $10,000 a month and hit $10,000 every single month. Last but not least would be constant iteration. Iteration is being able to consistently improve or get better. So if you're able to take a win and understand why it won, then obviously you've made an improvement. So in the future, if you see that same exact setup, you can make the right decision. Or if you have a situation to where you've taken a loss, or you're able to learn from that loss, in the future you can avoid making the same mistake. The thing a lot of traders come to me with is they're still in a position to where they're making the same mistakes over and over and over again. If you're not constantly improving or making those iterations to not make those mistakes in the future, you can easily find yourself in a situation to where you've been trading for 3, 4, 5 years still unprofitable. So towards the end of the video, I'm going to teach you guys how to make those constant iterations so you don't repeat those same mistakes and you can get out of that loop and start being consistent. So these are the 5 common patterns that you may be struggling with or holding you back within your trading, that towards the end of this video I'll help you navigate so you can hit your first $10,000 a month and start being being more consistent. It's important that if you're looking to becoming a consistently profitable trader, you have to be consistent in terms of the routine that you do on a consistent day-by-day basis. So me personally, I pretty much only trade the S&P 500 during the New York session on a consistent day-by-day basis. So between 9:30 to 11:30 a.m. EST, this is the specific routine that I do consistently on a day-by-day basis. Instead of trading 5 pairs, 6 pairs, 7 pairs, 10 different strategies, stick to one specific strategy that you look for on a consistent day-by-day basis and stick to one pair that you trade on a consistent day-by-day basis. This helps you narrow your focus to one thing, so as you trade consistently every single day, you can improve upon it. If you have to focus on 5 different pairs, that's 5 different things that you have to focus on, which can leave you scattered. So the first rule of consistency is to stick to one thing, become very good at it. And before I ever place a trade, I create a top-down analysis or a daily bias, basically a planning for what I'm looking for that specific day. You never want to come to the markets and just immediately take a setup, immediately buy or immediately short, or just be guessing. You want to create a predistinct plan in terms of this is what I'm anticipating to happen, and you allow the market to come to you. A lot of you guys are chasing the markets when it opens, when instead you need to create a predistinct plan, allow it to come to you, and then trade alignment with it. On this specific day here for Thursday, I'm on the 1 hour's time frame. On the 1 hour's time frame here, I took note of a couple things. First thing I took note of is this area of liquidity below. This right here would be a previous low within the markets. So you can see here that price comes close to taking out that low, but it doesn't right there. So this right here would be an area of liquidity. Basically, if we're bearish, this would be an area that price would obviously target or take out. Just looking at the overall market landscape on the higher time frames, we can clearly see that we're in a downtrend. Yesterday we had a reversal. In the previous video, I talked about the trade that we made on this day, which we were able to short at the exact high. So yesterday we had a full-on reversal aiding this down trend. Obviously, we can see here price breaks back below this low, in consistent lower lows and lower highs. So obviously, given that we're in a downtrend, we want to see a continuation to the downside. So whenever you're creating a plan within the markets, you want to focus on these 3 things. Where have we been? Where are we currently at? And where do we anticipate price to go next? Been in an overall downtrend. Yesterday, we had a reversal from where price took out this original high point, followed by this break to the downside. We are making consistent lower lows and lower highs. Where are we currently at? We're currently at these lows. If you know anything about trading, right, you don't want to sell low, buy high, right? You want to buy low and sell high. Obviously, given that we're at these low points, we don't want to be shorting down here. We're anticipating lower prices. Should that mean we should be buying here? Not necessarily. The reason why I don't want to be buying here is because the higher quality setup would be shorts. Given that we're in a downtrend, it would make more sense. I would want to see the market pull back and then go lower. I don't want to be buying down here because my main emphasis is lower prices. It's important that you stick to the overall plan that you had for the day. Where can I potentially sell at? And there's 2 specific entry patterns or entry techniques that the market revolves around on a consistent day-by-day basis. First would be order blocks. The second would be a fair value gap. Above us right here, this would be a fair value gap. Here, the separation between this candle's low was this candle's high. This creates a gap within the market. So this right here would be referenced as a fair value gap or a bearish fair value gap. That would be a fair value gap. Next thing that we can take note of is an order block. We can see here that price created this initial drop to the downside, created this up close candle, followed by this continuation lower. This right here, this area, utilize the body here, would be an order block. Between this fair value gap as well as this order block, this would be a level of resistance within the markets. So my overall emphasis is understand we're in a downtrend. I want to see a continuation lower. But where are we currently at? Currently, we're at these lower prices. We cannot short down here. So what do I want to see? I want to see the market open up, rally higher to come into these resistances. Then if we can see price run away from it, then we can take a short to go lower. Now the last part is where can we anticipate price to go next? The area that we can anticipate price to go next would be this low right here. This right here would be referenced as equal lows. You can see within the same level we have this low as well as we have this low right here. If we can see the market open up and rally higher into these resistances and then break away from it, we can take a short right here, get all the way back down, back below these lows. You can see how we simplified our trading. It's simply where have we been, where are we currently at, and where would we anticipate price to go next. And this is what you want to look for on a consistent day-by-day basis. Trade one pair, trade one session, or trade one strategy. Notice how when you keep it to just one specific thing over a long period of time, if you just narrow your focus, you will consistently improve upon it. I didn't mention anything about no orb strategy. I didn't mention anything about this hidden fair value gap, secret, no whatever strategy, right? It's simply just identifying where have we been, where are we currently at, and where would we anticipate price to go next. We identified the market structure, we identified the liquidity, we identified the entries. Market structure would be we're in a downtrend, we want to see lower prices. Is liquidity is down here. Inefficiencies or entries would be this order block plus fair value gap above us as levels of resistance. That's what we're looking for on a consistent day-by-day basis. Keep your focus narrowed and simple. You will be consistent long term. I'm gonna go down to the 15 minutes time frame here to help you guys when it comes to the overall entries and execution. When I'm on the lower time frames here, I trade the 15 minutes time frame. And you may be asking, right, am I not on the 5 minutes or the 1 minute? No, not necessarily. And the reason why I'm not on those lower time frames is because I don't need it, right? A lot of you guys, when it comes to lower time frames, you guys get confused, right? On the 1 minute time frame, all these different candles together, you know, 1 second it could look bullish, 1 second it could look bearish, 1 second it looks bullish again. A lot of you guys find yourself in a position to where you chase it higher, you chase it lower, you chase it back higher. No, it's actually going lower, let me chase it. You know, you guys find yourself in these positions to where you're ping-ponging the market, and you don't necessarily want to be trading like that because it's inconsistent long term. Like, we want to be focusing on things that are consistent long term, not short term. And when it comes to consistent trading long term, you have to have a plan and rules in place. So my specific emphasis on the day was lower prices. I want to see the market open up, come higher, back up into this resistance level to then frame a short up here, go lower. That was the overall emphasis that I wanted for this day. So as the market opens up, this is exactly what I want to see the market do. This is what I do on a consistent day-by-day basis with my students. Before we ever take a trade, we create a daily bias 30 minutes before the market opens. And if you want to trade live with me every single morning, then you guys can click that first in the description, book a free call, talk to me personally, and become a student. This is what we do on a consistent day-by-day basis. So before you ever come down to the lower time frames, you want to have a pre-distinct plan from the higher time frames. So whenever you go down to lower time frames, you're not confused. When the market opens up and it rises higher, you're not chasing it higher, right? Because you understand, want it to go higher because we have resistance up here. And whenever the market is up here, you're not buying it up here because you understand there's resistance up here. I can't buy up here, right? The problem that a lot of traders lack is situational awareness. They don't understand this is a low point within a market. They simply just see this big drop to the downside and they short down here, and then the market reverses on them. You have the other traders who see the massive rise to the upside and they buy up here, not knowing that there's resistance up here. If you don't have a pretty distinct plan in place or understand where you are within the markets, you can easily find yourself in these situations where you get reversed on consistently. So having that clear understanding of where you are at within the markets and creating a pre-distinct plan on a consistent day-by-day basis is what's going to help you become consistent long term. As the market's about to open up here at 9:30, you can see it opens up, becomes lower. I'm sure there were thousands of traders who probably shorted down here that got stopped out, so as I'm sure there are probably thousands of traders who by the time price got up here, they're probably buying. But we don't want to be those traders. We want to be those traders that have a pre-distinct plan, that are patient, and allows the market to come to us. See here, the market opens up, rises higher, gets back up into that level of resistance. But what we want to do now is we want to stay patient. Like, we don't want to just immediately short because we're at a resistance. If price comes into a resistance, you want to see price struggle within that specific level. Is I want to see price struggle here and make an effort to go lower. And see here, the next candle opens up, it makes an effort to come lower a little bit. And whenever you're catching reversals, it's important that you don't immediately just chase it. Very rarely will price ever see a big push to the upside, then immediately reverse in the opposing direction. A lot of times this is what happens. So you'll see a big push to the upside, initially come lower, come back higher to take out that original high, and then consolidate for a little bit and then go lower. So whenever price comes back into a level of resistance, you want to stay patient and wait for price to give you some sort of bearish engulfing candlestick. But we can see here the next candlestick opens up, it sees exactly what I said it was going to do. It opens up, comes higher to take out this original high, and then we see this bearish engulfing candlestick, right? This exact pattern right here in the level of resistance is what you want to see. You want to see price come back within the resistance, and you want to see it struggle. It came higher once, came higher twice, came higher 3 times, could not break above it, followed by this push to the downside. That's exactly what I want to see when it comes to proper execution. At this point, this is exactly where I framed my short, and I had a stop loss back above the fair value gap. Whenever you're putting stop losses within the markets, it should always be above areas of structure, or like original highs, original lows, or above or below areas of resistance. So this right here is a bearish fair value gap. I want to put my stop loss above the high of this resistance. This is not a large stop loss either. It's only 11 points on the S&P 500. It's more than enough. Perfect. So this is the exact stop loss I had within the market, and I was anticipating lower prices for about a 2-to-1 arm. And whenever you're targeting within the markets, you want to target opposing areas of support and resistance or opposing areas of liquidity. So below us, we have a bullish order block. So this right here was the last down close candle for this massive rally to the upside. So if I'm shorting within this resistance level, I want to be buying my position back either at levels of support below us or levels of liquidity. Right? If you want to put your take profit all the way back down here, you could, but I'm perfectly fine just taking a 2-to-1 arm, quick and easy scalp back within the level of support. This was the exact trade idea that I took this morning, and right here, this is where I scaled in. It's very important that whenever you're in a situation to where you have a great setup, you want to maximize your reward. This right here was a bullish fair value gap, thirdly supposed to be a support level. The fact that price is breaking through the support level gives you the emphasis sellers are in control, gives you added confidence within your trading. If price is not holding within support, it tells you which side of the market is winning, which is currently lower prices. So the moment that you get confidence within your trading, you want to scale into your trades. So whenever I recognize price breaking fair value gaps, breaking order blocks, I want to scale into my position. See here, the market opened up, saw a nice rally to the upside, stopping out any traders who put their stop losses here. Right, it's very important where you put your stop loss, because if it was right here, you would have gotten stopped out by this break to the downside below this fair value gap. So at this point right here, once price broke below the fair value gap, I scaled into my position, basically adding to my already winning position. So instead of having, let's say, 4 contracts in this trade, I scale in or add another 4. So my new entry becomes down here, and whenever I scale in, I trail my stop loss. So instead of my stop loss being up here, my stop loss is now up here. So I trail my stop loss tightly. So when you scale in and you trail your stop loss, what happens is you end up risking a little bit more to make a lot more. So if my original stop loss with the original entry was $300, let's say, if it stopped me out, I lost $300, my new stop loss would simply be $400. But since I scaled into my trade, let's say I adjust my take profit just a little bit lower, instead of making just, let's say, $500 on this trade, I make $800 on this trade. What I did was I risked an additional $100 to make an additional $300, right? You always want to have at least a 3 or 4 hour difference within your scaling in. So whenever I'm scaling in, I'm risking an additional $100 every single time to make an additional $300 to $400, sometimes $500-$600 when I get those killer setups. If I can identify setups to where I have confidence in and I make an additional 3 or 4% on that setup, that means that for me to lose the money that I made on this particular trade, I would have to lose 3 or 4 times in a row. So I don't need to win every single day or every single time to make a lot of money. So you can have a 30% win rate or 40% win rate and still make a lot of money trading. Don't try to promote people to have a win rate, 80%, 90% win rate, right? Not everybody can trade with a high win rate. Everybody can trade with a high R multiple. I teach my students that whenever they get it right, they want to maximize their reward. And whenever they feel like they got it wrong, they want to keep their losses low. As long as you can maximize your reward and keep your wins high, high, as well as keeping your losses low. You can have as low as a 30% win rate. You'll make $10,000 a month trading. And this was the exact trade setup that made me over $3,000 this morning. Very easy, very straightforward, bread and butter. And throughout this video, you've seen I was able to create a plan. So this avoided bad psychological things like I didn't come to a market chasing the market, I didn't have FOMO, I didn't hesitate, nothing. I had a predistinct plan that the market was going to open up, rally higher, find resistance to go lower. I had that plan in place. Right, when you have a plan in place, you avoid situations to where you're inconsistent, you avoid situations to where you're bad with psychology, and it helps you to where you're anticipating and allowing price to come to you rather than chasing it. Focused on risk management. Once I realized I had a great setup, price was breaking through support, I added to my winning position, maximizing my reward while keeping my losses small. Remember when I was able to trail my stop loss from up here down here, I actively kept my loss small while massively increasing my profits. That's the focus of risk management. Being consistent is about narrowing your focus on one thing and getting better day in and day out. I only trade the S&P 500, only trade this strategy, and I only trade the New York session. As long as you can narrow your focus to a few specific things and you constantly improve, you constantly get better, over time you will get exactly what you're looking for. If you have just 5 funded accounts making $400 each day within those accounts, 400 split across 4, that's $1,200 a day. You generally only need to win 10 days out of the month to make $10,000 per month. So I try to make it easy and simple to understand for you guys, and if you trade like this on a consistent day-by-day basis, you will easily get there. While most traders struggled during the month of March due to tougher price action with the war and everything like that, was still able to make well over $20,000 for that month. The exact same thing for the month of February. Starting off with February, I was down $7,000 during the third and last week. I was able to take that negative $7,000 all the way up into $20,000 for the month. Same thing, while a lot of traders were struggling during the month of January because of lower volatility, was still able to make well over $12,000 that month. I haven't been trading for the last 6 years. I've had the opportunity to talk to well over 1,000 traders. One of the main problems that you guys are struggling with is strategy. Week you're trading this strategy, next week you're trading that strategy. To understand all these different models and strategies, you have a hard time putting it all together in a way to where you can come to a market every single day on a day-by-day basis, be consistent. So in this video, I'm going to give you my exact boring strategy that I've been trading for the last 6 years that's able to make me consistently $20,000 per month. Towards the end of the video, I'm going to give you a step-by-step train plan as well as checklist to look for on a consistent day-by-day basis if you want to achieve similar results with this strategy. In this lesson, we're going to be going over kind of journaling winning trades. So whenever you take a win inside of the market, it's very important that you necessarily understand why that trade won, right? Because it's important that as traders that want to keep collecting data, right? If you had a winning trade, why did it win and how can I win more? And next, we're going over losing trades. So if you had a losing trade, what did you lose and how can you prevent it in the future? This helps you when it comes to continuously getting data from your trades, and in the future you'll be in situations to where you'll see the same setup, whether a trade that you won before, and you understand, since you journal it, I've been in this situation before, I know how to come across the setup. Or maybe you take a loss and you journal and you know how you can prevent it in the future. Well, in the future, when that same setup presents itself and last time you lost, you know exactly why it lost, so you can prevent it in the future. So this is why journaling is very important, just understanding why you won, why you lost for those future scenarios and building that experience. A strategy that you have within your chain is the experience. Those situations to where you say, I've been there before, I've won before because of this, or I've lost before because of this, I know how to avoid it, or I know how to approach it. Right? That's the best way to trade on a consistent day-by-day basis, is based upon your experience. When it comes to building that experience, you have to keep track of what you're doing right now. When it comes to journaling, right, you want to come to the winning trade section. Go over here to the comments. We want to type in first, time, and direction. Well, we'll go over this as we progress through the video, but first is time to direction. Second would be higher time frame point of POI. It basically means point of interest. Our time frame support and resistance slash liquidity, higher time frame point of interest / liquidity. A point of interest is basically like support and resistance, rejection blocks, survey gaps, order blocks, breaker blocks, stuff like that. Now we get into the entry. So this is the specific entry that you took. Then confluence, right? This is the something that give you confidence within the trade. We'll go over it later on, but yeah, so confluence there. Then last but not least, exit. Where did you exit the trade specifically? And then last but not least, we can have like a summary. Basically, what did we learn from this? All of this is important because it all goes into why you took the trade, right? It's not always as simple as you just buy when it's going higher or sell as it's going lower. You want to create a plan within the markets as to why you took with as much logic as possible, because this prevents you from taking low quality setups, right? The trades that you want to take, it has to be high quality setups that you pre-planned for, and there's reasons for why you took it. Forces you to kind of take less trades. Those less trades that you take are much more high quality. We're not trying to take every single move higher or move lower inside of the market. We want to take the move that makes the most sense, that had the most reason for why we should take it, and just the ones that spoke the most to us. So I'm gonna put the picture here of today's trade that we took. So on my Tradingview here, right, you just go here on the copy image up here, download the image, and you just paste it here. This is basically the trade that we took this morning, right? I was able to short at these exact highs, was able to add to my position right here. I was able to basically sell back down here. When it comes to our first thing, which is the time and direction, right? What was the time that you took the trade, and was this trade a continuation or was it a reversal? A continuation would be where the market's obviously in a uptrend, market pulls back, you take a buy down here, anticipate a continuation higher. That would be a continuation trade. A reversal would be something like we took this morning, right? The market was going higher, but we saw a reversal at these highs and we framed a short to go lower. What was the time that you took the trade and what was the direction? We took it at around 10:15. Usually it's every 30 minutes. So there's 9 o'clock continuation or reversal, 9:30 continuation reversal. We start trading at 9:30, but 10 o'clock continuation or reversal, 30 continuation or reversal, 11 continuation or reversal. So since this is like 10:15, it will be a 10 o'clock, 10 a.m. reversal. So it'd be a 10 a.m. reversal. You can just leave it as 10 a.m. reversal, but you can add additional context, like we started trading at 9:30, stayed patient, as it went higher. Moment I seen rejection at the highs, I framed a short for a reversal about 45 minutes from the market open. So today would be fake out, would be a fake out. Basically, the market opened up, it initially went higher, but then eventually it found resistance to go lower. So, this would be like a fake out. 10 a.m. reversal / fake out. This would be kind of like the time and direction. So the time would be, we took it at, 10:15. So I'm at 10 o'clock to 10:30 time. So 10 o'clock reversal, fake out. So this was a fake out. 9:30 opened up, it went higher, consolidated, and then it reversed lower. So this would be like a fake out. So we started trading at 9:30, stayed patient as it went higher. We'll break down the entire trade, but we stayed patient as it went higher. The moment we saw rejection at the highs, we framed a short for reversal at 45 minutes after it opened. It would be a fake out, right? This would be a reversal. So now let's get into higher time frame points of interest. For every single trade, you're anticipating, reversal, continuation, higher prices, lower prices, right? There's a starting point for why that trade did what it did, right? What did it reverse from? Doing a quick top-down analysis here. So this morning, right, we took note of a few things. On the higher time frame, so I'm starting off on the 4-hour time frames. On the 4-hour time frames, I took note of this rejection block up here. You can see how these buys are equal, but this wick is much longer than the wick to the right here. So obviously this is a rejection block. This is a level resistance up here. Take note of previous day highs and lows. See here, this came lower to take out the previous day low. From taking out that previous day low, we can see price seeing a reversal to the upside. Took out previous day low, seeing a reversal higher. I also took note of the previous day high as well. This on the 4-hour time frames, right? It's very easy to understand that we're at a level resistance up here. Price came lower, took out the previous day low. We saw a push to the upside, but we're reaching resistance. So let me go down to like the 1-hour time frames, get a little bit more information. On the 1-hour time frames, we also have this bearish order block up here, just below that rejection block. So this is the last up close candle here for this massive drop to the downside. Use the replay tool here just to replay back before 9 o'clock. Into a marketplace this morning, just creating our plan. We have to understand that we have resistance up here. I have this bearish order block right here. I have the rejection block up there from the 4-hour. We have a bearish fair value gap down here. Boom. bearish fair value gap. It's very important to understand that we're within levels of resistance. It wouldn't make sense to be buying up here, right? Knowing that this is resistance up here wouldn't make much sense to be buying up here. If the market were to open up and go higher, right, I'm not chasing it higher because we're so high up, right? I wouldn't necessarily be chasing it higher. More so now that there's resistance above us, if we can see price consolidate and break away from it, then this would be a short opportunity. Going back to like the market structure lesson when it comes to premium to discount, so this is from the start. This is kind of like the low. If you're buying within the markets, you want to be buying kind of like the low here or down here, right? This would be good buying opportunity. When we're all the way back up here, the market has already seen a nice rally to the upside pretty sufficiently. It would be lower quality to be buying up here, given that the market already seen a massive rally higher. Of course, the market can always continue going higher, but low quality, right? We want to take trades that make the most sense. What makes sense right now is we have levels of resistance above us from this fair value gap, from this order block, from this rejection block. As we're within this resistance, we're not just immediately shorting, right? But we have the idea in our head within resistance. If we can see the right signatures of price rejecting from this, can then look for a short. On the 4-hour time frames, I simply just marked out the 4-hour rejection block up here. It's taking out this previous day low, right? If you join the lives every single morning, stay consistent for a period of time, you notice that every single day I mark out previous day highs and lows. There's areas of liquidity that price tends to take out. Price is going to take out a previous day low and reverse higher, or it's going to take out previous day low and continue lower. Either it's going to take out previous day high and reverse lower, or maybe take out previous day high and continue higher, right? If you join the lives enough, you'll notice I always mark them out every single day as points of areas to where price can reverse at, or points of targeting. On the 1-hour time frames, we simply just mark down we got resistance above us. If the market were to open up and go higher, I'd be looking for shorts up. Below us, we can see we have some support. We have this fair value gap right here, boom, as well as we kind of have this order block down here, right? This last down close candle before this nice pop to the upside. Pretty solid. We have some support below us. If the market were to open up and come lower, we understand that this is a support level. This isn't a bad pullback. So if the market's bullish, you want to see price pull back. You don't want to be buying up here. Even though the market's bullish, you don't want to be buying up here. Because you have to understand the market just, rallied higher. It has to pull back. So it'd be low quality to be buying up here. If the market opens up and comes lower, now that it's down here within this fair value gap or down here within this order block, this could be pretty good opportunity to buy down there to reach back above higher prices. That was the plan this morning. The plan this morning was I want to see either the market open up and come higher, back up into this resistance level, maybe find a level of resistance to then, if we can see price struggle up here, talk about that when we get down to entries. If we can see price struggle up here, and go lower, we can frame a short and then, come down here. Right? So that was the plan. Or if the market were to open up and come lower, we understand that we have support down here. Price can find support at to go higher. Whenever you're trading on a day-to-day basis or creating a plan, you're simply just creating a story based upon the information you have in front of you. You have resistance up here. We're not buying up here since we have resistance and it's already gone higher. It comes down here, then we got some support it could bounce off of to go higher. Now it's just allowing the market to open up and come into alignment with your plan. This takes your trade from just chasing any move up or down. Now you're taking calculated moves that you've already planned for. As the market comes up higher and comes up here and starts struggling to go lower, I already planned for that. When I get the right signatures, I'm able to be confident taking that trade. That was the overall emphasis for this morning. A resistance above us, some support below us. Let's see how the market opens up. We trade, at 9:30. S&P 500 here. Stock opens up. 9:30. Eventually opens up, sees it, push the upside. So you're taking a buy up here just because, right, like I mentioned, we got some resistance above us. Already so high up. Wouldn't make sense to buy up here, right? Pretty much be chasing the markets, right? You want to take quality setups, just because the market's going higher. Right? You gotta learn patience and not take anything. The market can give 10 20 moves throughout the next hour, but if you try to chase all of them, you'll end up chasing anything. You want to focus on not just taking any trade or chasing any trade, taking the trade that makes the most sense to you. Right? We're already at these highs. We got resistance above us. It wouldn't make too much sense to be buying up here. We're simply just be chasing. Boom, market continues higher. Just stay patient. You gotta be a mindset where you kind of just don't care. You understand your plan. You understand what you're looking for. You can't, force anything or chase anything. We can see here's that price, eventually comes higher, back up into rejection block up there. Right, plus the order block we mentioned here. Price starts to struggle here, creating this like doji candle or right, kind of like this wick up here. And next we can see price ended up seeing this drop to the downside. So price opened up, came higher a little bit more, and then it came back lower. Right, this is exactly what you kind of want to see. Right, it comes to levels of support, resistance. Right, this would be a resistance. You want to see price kind of come back up here, reject from it, come back again, sometimes and reject from it. We have this resistance up here, which is that rejection block. that we talked about. Price came back up there once, came lower, came back up there again, came lower, basically telling you that price is, you know, struggling to continue going higher past this point, right? It was very easy for price to push higher here, very easy for price to push higher here. The moment it got all the way back up here, you can see it's kind of struggling a little bit. When it comes to points of, you know, higher time frame support and resistance, you want to see price struggle, and this was exactly where I framed my short. She had a stop loss back up here, about 15 points, a bit less than 15 points right there. And I was anticipating lower prices to this fair value gap down here. So typically I try to aim for 15 to 20 points per trade, right? 15 points is always going to hit. 20 points is, you know, no, if it blows past that 15-point target, no, my final take profit will be that 20 points. Was the first trade idea here. Then as the next candlestick opened up, seeing a drop to the downside, I scaled into the trade. So basically I shorted up here, and I shorted even more right here. So I started off with 4 contracts up here. As price, you know, blows lower, added 4 more contracts. So I scaled into this trade here. I trailed my stop loss from this high, and I moved it down to up here. So my stop loss went from 15 points to now 12 points. So as you scale into your trades or add more to your trades, right, you gotta have confirmation. I was already expecting lower prices once price got back up into this resistance level. So my first trade was obviously just, you know, we're at resistance, it's rejecting once, it's rejection twice, boom. So I just took the first trade. The scale in is the confirmation. Once this candlestick opened up and just saw this massive drop to the downside, just tells you, okay, yeah, this, you know, some selling is coming into our markets. I can trust this. So as we did have this bullish for value gap, which you can see price does break past. So when it comes to scaling in, you want to see price break through levels of support resistance. So this right here is a bullish for value gap, a level of support. Good confirmation is if you're bearish, you want to see price breaking through support, or if you're bullish, you want to see price breaking through resistance. So this right here is a bullish for value gap. But as price sees a nice drop to the downside, breaking through that fair value gap gives you that confidence that, hey, I did this is good, breaking through support. I can add to this position and trail my stop loss, anticipating a nice push to the downside. Able to take the trade off down here for about 15 points. So like down here, like 15 points. And this was a super solid trade. It was a trade idea, you know, kind of trade breakdown. And, you know, now let's, you know, get into the journaling. What was the higher time frame point of entry, point of interest slash, you know, liquidity scenario? It was a higher time frame point of interest. When it comes to journaling based upon liquidity, it'd be like a reversal. So something like this, where price came lower to take out this previous day low and then seen this pop to the upside. So if you took a buy here, the reasoning for why you took a buy was based upon a liquidity sweep. Price came lower to take out the previous day low and then found this push higher. For this scenario, price came higher, took out this original high, saw this drop lower. The reasoning for why you sold here is because price came higher to take out liquidity followed by this drop lower. The higher time frame point of interest for liquidity is the reasoning for why you took the trade. Higher time frame narrative for why the trade panned out. The reason why this trade panned out was because this was within a H4 rejection block plus H1 bearish order block above us. We had areas of resistance above us, and obviously, you know, since we are within resistance, we don't want to be looking for buy opportunities. We want to, you know, look for the market to slow down, to look for shorts. The higher time frame point of interest for this trade was we had a 4-hour rejection block. On the 4-hour time frames, you can see here we had the equal buys but long wick 4-hour rejection block, also in alignment with this 1-hour order block up here. This last up close candle followed by this massive drop to downside, bearish order block right here. This was our higher time frame point of interest, or the reasoning for why price went lower, right? What was the reasoning for why price went lower? There's always a specific reason, and if some situation you feel like you don't see it, keep looking. There's always a specific reason for why price goes higher or lower. It doesn't just do it by itself, right? You know, it doesn't do it by itself. So the reasoning for it based upon the 4-hour rejection block plus 1-hour order block. The entry based on the rejection of the resistance. So when price came back into the H4 order block and rejection block, H4 rejection block and H1 order block, this came up once. You stayed patient. Price came up again before then seeing a drop lower, right? If the market is, you know, consolidating at a resistance, tries to go higher once and then again can't break higher, it really tells you it's struggling. It really tells you that it's struggling. Rejection within the H4 rejection block and H1 order block, the lower time frame rejection was able to frame that short looking for lower prices. The specific entry for this was obviously my price was within that 4-hour rejection block plus 1-hour order block. It came higher up here and then it rejected lower. So during the live I stayed patient, and so it opened up, it came higher, and then it ended up coming lower. I stayed patient, price ended up coming higher again right here, and then you see it came lower. So that's why I framed the short. When you see price come into a level of resistance, right, don't just immediately short at that level. You want to see price respect it. Basically it struggled to break past it. Came up higher, rejected, came up higher again, rejected. Gives you really good confirmation price can't break to this level. So I took that first entry there. Boom, boom. So that was the entry. Now confluences, you can also say, you know, confirmations. So this is basically just things that gave you additional confidence in terms of going to trade or adding to the position. Confluence that I like to look for is, you know, market synchronization. If I'm looking for lower prices on the S&P, I want to see the Nasdaq and the Dow Jones also go lower. So if you look at the Nasdaq here, at the time, right, when 1015, right, it opened up, it came higher, gave a level rejection, and then pushed lower. Nice. And then obviously 1030, big drop to the downside. You look at the Dow Jones, right, it was initially going higher, gave a level rejection, end up coming lower at 1015, continue lower at 1030. Right, this is market synchronization where all three markets are all going lower. This gives you a confidence, right, a confluence. This is good, right? If you want to see the S&P go lower, you want to see the Nasdaq and the Dow Jones also go lower. This is a confluence that I look for on a consistent day-by-day basis. So all three markets going lower once price tapped into the resistance, right, which is the H4 rejection block plus H1 order block. Another confluence you can look for is SMT divergences. It was a tiny SMT, it wasn't a lot. As you can see here, the S&P failed to take out this high right here. You can see the Nasdaq did take out this high right here. When it comes to the SMTs, it's a little bit more. That fails to take out this high, but the S&P ends up coming higher to take out that high and then going lower. But this was like a tiny SMT here that gave you no confluence or confidence. So SMTs are something that if you're already anticipating lower prices, which I was, in that SMT, there's additional confluence in terms of giving you another reason for why maybe lower prices should work. So confluence was obviously all three markets going lower. SMT right here, my super solid. So small SMT with the NQ. Small SMT with the NQ, that was a confluence. And let's say another confluence was the rejection, right? Price opened up, came higher once, rejected lower, came higher again, rejected lower, right? That was the reasoning for our entry, right? It could not break through it. Multiple rejections at those highs. Confluence would be three markets going lower, SMT with the Nasdaq, and it gave multiple rejection at the highs, indicating that it can't continue higher. These are just all the reasons that add on to why the trade won, because in the future when you're in this situation, the more confluences that you can have for the trade, the more confident that you get. So this will eliminate those situations to where you're in a winning trade but you take the trade off early or you don't know. How you get confidence in the trade is by stacking confluences, more reasons for why the trade should pan out. Why should this work? Why should this work? Why this should work? The more confidence that you can have, the more you can be confident within your trade, breaking through the fair value gap. Plus we had a bullish FEG that price broke below, right? Which gave me confidence to hold, to add to the position. When scaling into trades, right, the best confidence you can get to scaling in trades is as price breaks through support resistance. So if you take a short up here, right, there's a bullish value gap here and price breaks through it, that's a good confirmation that price is respecting it and you can add to that position. So that's why we scaled in. This price broke through a level of support. Another reason for scaling in can be break a structure. So let's say you bought down here and price, you know, breaks back above this high here. So price breaks structure up here, or, you know, just sees a nice big push to the upside, pulls back, holds, break structure. Maybe you can scale in here. If your first entry is like down here, maybe you could like scale in here as price break structure to like, you know, take it higher. So breakup structure plus breaking through support and resistance can be reasons for why you can scale into a trade. Those were all the overall confluences, right? All three markets were going lower, you know, as price tapped into resistance. Small SMT with the Nasdaq, multiple rejection at the highs, indicating that it can no longer continue going higher. Plus, we had a bullish value gap that price broke through. All of these gave me confidence for why the trade should pan out. So whenever you have a winning trade, you want to look for all the reasons for why the trade panned out and learn from it. And what was the exit? Right? The market, right, you want to be selling into the same thing, right? Higher points of interest or liquidity, right? So in terms of the exit, we typically aim for 15 to 20 points. This is what we aim for on a consistent day-by-day basis within the S&P 500. So we're looking at support and resistance levels or liquidity within this range. So our 15 points, right, our entry was like right here as we scaled in. This fair value gap right here was in alignment with that 15-point target, as well as you can say, you know, this last not close candle was an order block as well. But I primarily like this fair value gap right here was in line with the 15-point target. If you want to aim for more so 20 points, you could say like this low was kind of like in that 20-point target. So if you were anticipating price to take out this low, you could possibly like put take profit at this low and be like liquidity, which price does end up taking out. But we just took it off there at the fair value gap. 15 points is more than enough. And usually when we get that 20 points, it's usually as price breaks through the 15 points and gets to 20. I see price kind of consolidating a little bit at 15 or maybe comes down to 16, 17. I'll take it off there. But sometimes price will blow through that 15, you get straight to 20, and it'll just take off for 20. Usually that 15-point target is always something that hits. So whenever you're having a take profit, you want to have a base hit that you know hits every single time. 15 points is always going to hit, right? And then you want to have that goal, which is 20 points. 20 points is when price breaks past that 15 points. Now then next is 20 points. In some situations, you might have a great trade, might hold it for like 25 points, but you don't want to get greedy or anything like that. You want to stay consistent, getting those base hits every single time, or you'll find yourself in this position where should have took it off here and then it reverses on you, right? You want to know those base hits that price hits every single time. It always hits 15 points. Sometimes if it blows through 15, I can hold it for 20, but usually that's it. And you always want to set your take profit based upon price action. So this is also in alignment with this fair value gap. The exit would be, right, we typically aim for 15 to 20 points. The bullish M15 fair value gap offered the 15 points. As price came down to it started to slow down. Whenever I'm aiming for 20 points, usually price blows past 15 points and gets down to 20. In terms of today, it got to the 15 points. It went lower a little bit and then it started consolidating a little bit. So whenever I see that, I kind of just take it off for that 15 points. Following it consolidating a bit, took the guaranteed 15 points. Boom. I took the guaranteed 15 points, right? Super solid for today. So that was the exit there. I have a guaranteed target that price usually hits, for the S&P it's 15, 20 points. If you're someone who trades like the NASDAQ, guaranteed is like 60 points. Sometimes you can hit for like 80, 90, it's always going to give you that 60, so if you have like a 40, 50 point stop loss, that 60 is always nice. Sometimes it'll get down there for 80, 90. So you want to really be good at understand your market. That's why it's important to just trade one market, because you understand little stuff like this. Always know it's gonna always hit that 15 points, because I've been trading this market for a long time. The more you can just trade one thing, the better at you understand it. We took our base hit of 15 points within the fair value gap. Price did end up the low for 20 points, but that's okay. Price did end up coming lower for the 20 points, but we took our 15-point target. High time frame point of interest was the 4-hour rejection block plus 1-hour order block. The entry was based upon the rejection within the resistance, right? When it came higher, rejected. Confluences where all three markets were going lower. Small SMT with the NASDAQ, and price broke through a level of support, which was that bullish fair value gap up here. Confluences are basically just reasonings for why the trade panned out or why you had confidence in it. And obviously the exit, where did you exit at, right? If you are framing a short, you can exit at levels of support below you or levels of liquidity below you. If you're framing a buy, you exit at levels of resistance above you or liquidity above you. So if we could buy down here, let's say we were buying down here, sitting our position within that 1-hour fair value gap right here, or let's say you hold it a little bit longer, let's say you buy up here, you'd be exiting your position back up into that 1-hour order block up there. You want to be exiting at areas of support and resistance or liquidity pools in alignment with the targeting. So I aim for 15, 20 points, came down here 15 points, got it. Now the summary is basically just going over, the trade. What did you learn from this trade that in the future, it can be beneficial? When price came into resistance, it struggled, couldn't go higher, right? That was the framing for the entry. So you understand that once price, reaches a level of resistance, you don't just immediately sell or immediately short, right? You're trying to predict the markets, right? You want to see price come into that level and show that it's struggling to continue going higher. I rejected higher, came lower. It's showing you that it's not willing to continue going higher. It's very important to be patient. Even though this is a resistance, you want to still be patient. Don't just immediately try to be ahead of the market. The entry was good because, multiple rejections. Confluences were, seeing all markets start to go lower. Following the resistance, it was good. right? When price came up here and Nasdaq started going lower right here, and Dow Jones started going lower right here, you know, it gave me confidence that, you know, okay, it's finding resistance here. All three markets are going lower. I can trust this, meaning I can hold the trade a little bit longer. For those, you know, traders who maybe be in a trade but not know whether they should hold it or not, or maybe take trades off early, right? The more confidences or the reasonings you add behind why it should work, the more confidence you'll have towards holding the trade. And then exit was good. You know, always, you know, don't look for home runs. You know, stay consistent with your base hits, 15 to 20 points, right? Don't look for home runs. Stay consistent with your base hits on a consistent day-by-day basis. So based upon this trade here, we learned that price stems from higher time frame points of interest and liquidity. The entry was great because, you know, we learned, you know, when it comes to those great entries, you want to see price reject from those higher time frame levels. Gave multiple rejection at the high. You know, something that we learned from confluences, or something that we learned that gave us confidence, is we're seeing all three markets go lower, following tapping into resistance, right? That gave us confidence. And the exit was good because we learned that we don't want to be looking for home runs. We want to stay consistent, because if we were in a situation to where, let's say we're aiming for all the way down here, my price would have just reversed on us, you know, hit us for break even or consolidate on us. We always want to be grabbing those base hits within areas of support or areas of liquidity. 15 points was within that fair value gap. 20 points was down into that liquidity pool. We took it off, you know, at the fair value gap. Price did start to consolidate once it tapped into that 20 points. So it came lower, tapped into that 20 points, started consolidating a little bit. So we took it off. Look to go for home runs every single trade. Stay consistent with your base hits, 15 to 20 points. And then for here would be ES. So the S&P 500, this would be a 10 a.m. reversal. If you remember, 10 a.m. reversal. And this is the higher time frame point of interest. H4, just H4 RB. H1 OB. So RB is rejection block, dash the entry, and 15 rejection. So basically price rejecting from 4-hour rejection block plus 1-hour order block. So the entry is the 15-minute rejection. The next would be confluence. You can call it market synchronization plus SMT with NQ. This is the confluence. You know, market synchronization is basically all three markets going lower, plus the SMT with Nasdaq gave you the confidence or the confluence for why you were confident within the trade. Then last but not least is the exit, which is M15 FVG slash, you know, order block, right? There was a down close candle here as well. So the exit was the M15 fair value gap plus order block. Or if you held the trade a little bit longer, it would be like the specific low. This would be like a 930 low, start of the stock market open. So the stock market open is 930, it would be like a 930 low. Maybe if you were targeting back below this low, this would be like an Asia low. If you remember, say you take a buy and you should take it off at the previous day high, the exit would be like a previous day high or previous day low. For this case scenario, let's say 930 low. So boom. So the exit was within the 15-minute fair value gap slash order block. Let's say if I held it a little bit longer for the 20 points, I don't necessarily recommend, you know, holding trades a little bit longer. If you feel confident with the 20 points, definitely take it. Don't try to be like, oh, I should have gotten the 20 points. But just, you know, in case if I held it a little bit longer, then the 930 low would have been a level of targeting. Just remove it there because, you know, we took it off at the M15 15-minute order block. And that would be it. So you can see here, this is how you effectively journal. First is the time and direction, 10 a.m. reversal. So we reversed, you know, at 10 a.m. Our time for point of interest was the 4-hour rejection block plus 1-hour order block. The entry was the rejection once price tapped into that resistance. Confluence is market synchronization plus the SMT. Exit was within the 15-minute fair value gap. Summary, what did you learn from this? Basically everything that you learned from this that made this a winning trade. So now you went from just taking a trade and winning and not knowing to now you know pinpoint exactly why the trade won. So if the same pattern happens in the future, you know exactly what happened last time and you know exactly what to do in the future. So the best thing that you can do at this point is just gathering more and more data, winning trades, losing trades, why did it win, why did it lose, gathering more of that data and building that experience. The majority of, you know, this section now throughout the course is just building experience trading, right? Experience, joining us live every single morning, every single day, building that experience, continuously learning over and over and over. If you're someone who finds yourself in a situation to where you keep making the same mistakes over and over and over again, and you want to get over that loop, then this video is for you. After coaching hundreds of students, I've realized that becoming a consistently profitable trader does not mean spending more time on the charts. I have people come to me, they've been trading for 5-10 years and they're still unprofitable. While I had students within my coaching, I've helped them become consistently profitable and reach their first payout within 3 months. And it does not mean that the person who got the payout in 3 months was any better than anyone else. The only difference was the iterations that were made. An iteration is the ability to improve. Unless you're constantly able to learn from your winners or constantly able to learn from your losses and make adjustments to avoid them in the future, you can find yourself in this situation, especially when it comes to trading, that you keep making the same mistakes over and over and over again. And you would think, you know, after trading for 3, 4, 5 years, you'd be making progress, but actually you haven't made much progress at all. In this video, I'm going to give you the exact step-by-step process that you need to do on a consistent day-by-day basis to get out of this loop, but create a routine to where you can start making progress on a consistent day-by-day basis, and you'll realize that becoming a consistently profitable trader is a lot closer than you think. So the only thing that I ask you to do is that you watch to the end of this video, because it's probably one of the most important videos you'll ever watch on trading, right? It's not a strategy video. It's not an 80% win rate video. It's a legitimate video that you need to learn if you have any chance of becoming a consistently profitable trader. I wish I can just give you guys a secret strategy to making $20,000 to $30,000 per month, but it doesn't work like that, right? These type of videos are the videos that you need to watch if you want to become a better trader. And by the end of this video, guarantee that when you go back to the charts, you will become a lot better. It's very important that you remove the mindset of a loss as being a bad thing. Loss can be a good thing because it can give you insight into what you could possibly be doing wrong, and if it were to happen in the future, you can avoid it. So if you ever take a loss in the market, instead of seeing it, oh, I lost money, see it as more so, okay, this is what I did wrong. Maybe this is what I could have done differently. If this happens in the future, this is what I can do differently to not make the same mistake. And within the journal here that I shared with you guys want to go over to the missed trades section. So a missed trade can be either you taking a loss on the day, also be something dealing with psychology. Let's say you were up $500 and then you closed the trade off at break even. That was a missed trade. You were up $500, but you allowed greed to get in front of you, so you missed out on that potential setup, like impatience, like hesitation, and everything like that. So you want to be constantly learning and improving within your trade. If you're not constantly improving upon your trading, you can find yourself in a situation to where you keep making the same mistakes over and over and over again, and unless you can learn from those mistakes and prevent them in the future, you'll most likely make them. So this is just a way to navigate that problem so we can stop making those mistakes, understand what's holding us back, put things in place to where if they happen in the future, we're a lot better to not repeat them. I'm gonna break down Friday here because Friday was a good example of me having a losing day, but I don't necessarily see it as a losing day in terms of lost money, but I see it as an opportunity to learn from it, and if it were to happen in the future, I can prevent it. So for Friday, I was anticipating higher prices. So we can see here that the market, you know, before we opened up at 9:30, we saw a massive drop to the downside, right? A nice drop to the downside for about 80 points. It's very important that whenever you see a massive move before the New York session opens up, price will go into a consolidation phase. You don't want to be that person to just think, okay, the market saw a big move lower, maybe I can just buy here because we're so far down. Because a lot of the time, following a big push to the downside, what can happen is price can open up and consolidate, or sometimes price can open up, come lower a little bit more to take out anyone who went long earlier, and then find support to push higher. So whenever you're coming into a market and we saw a massive move from the overnight session, don't immediately come into a market expecting a reversal to take place. Be a little bit more patient. For the most part on this day here, I was anticipating higher prices, but I wasn't going to just immediately buy when the market opened up. I was anticipating the market to open up and either consolidate, or maybe the market can open up, come lower, and once the market comes lower, if it can establish itself at these lows, then I could possibly take some buys to go higher. I'm gonna go down to the 15 minutes time frame here because I want to show you guys the execution that I basically took on this day, the 2 trades that I ended up taking, and I'm going to take you guys through the process of, you know, the things that I did correctly, as well as some things within this trading that I could have done differently. See here, 9 o'clock is about to open up here, and then 9:30 opens up, right? 9:30 opens up, sees a drop to the downside, right? Immediately as we were kind of expecting. Very rarely is the market just going to open up and see a full-on reversal. Everyone is thinking the same thing, sometimes the market will do the opposite. When coming to a market sees we had a massive drop to the downside, everyone is probably thinking higher prices. So if everyone's thinking the same thing, what's the market gonna do? A lot of people probably bought here off of this push higher, and any trader who ended up buying here, they most likely got stopped out. Very important that whenever the market sees a big drop lower, don't immediately be the person to take a buy. You want to be a little bit more patient. Which is actually something that happened to me later on that, you know, I could have avoided, was just a little bit more patient. 30 opened up, seeing this drop to the downside. I'm staying patient. The market opened up, sees another push to the downside. Still staying patient because I don't necessarily want to short down here because we're so low, but I'm not going to buy either, right? Because I want to be patient and wait for the market to consolidate and give me that pattern that it wants to go higher. I'm not going to chase the market, you know, higher or anything like that. I'm staying patient here. We see this initial pop to the upside. When it comes to reversals within the market, I talk about this a lot during the live sessions. Price will give an initial pop higher, and you don't always want to chase that initial pop higher, because sometimes what can happen, right, is price will give this move higher. Next candle can open up and pull back, maybe find support and then push higher, right? And this ends up being the low. Or some situations, what can happen is next candle can open up, lower to take out this low, find support, then push higher. You never want to just immediately buy off of the first pop higher, because sometimes you might find yourself in a situation to where price can come back lower, stop you out, and then go in your favor. At this point, I was patient off of that initial pop higher, and this was kind of the first trade that I took. So as this candle was forming, it looked pretty good, right? It opened up, it initially went lower slightly, and then it followed this stab to the upside. Trade idea, it gave me kind of like the emphasis that price pulled back a little bit and held a little bit, followed by this push higher. This first trade idea, it wasn't necessarily bad at all. So this was the first trade I took it around this level right here, and I pretty much had my stop loss just back below this low, anticipating higher prices back up into this last up close candle. So this was not a bad trade idea at all. And eventually price did, you know, come lower and then stop me out. This would have been the first missed trade on the day. What I'm going to do here is I'm going to copy this image, go over to the, you know, missed trade section in the pair, put in the specific date, which was that Friday, put in the gain, right? When it comes to the gain, you want to be in alignment with your funded account. So since I trade basically 100K accounts, the max drawdown is 3,000, and on this specific trade, I only lost 160 bucks. Percent would be $300, so that's 0.05. The R multiple was, you know, basically negative 0.5. The model for this trade was basically kind of like a turtle soup, right? A reversal. Also AM session, right? New York Open is like 9:30 to 10. This is more so like 10 to 12 AM session. I'll go over here and we want to put basically the image of what happened. When it comes to learning from your losses, I have a couple questions, right? What was the reasoning for this missed trade? I think it was more so missed price action, right? Could have been a little bit more patient, because I definitely felt like price was going to come lower and stop me out. So, and I'll talk about that a little bit later on, but I definitely felt like he'll be a little bit more patient. Give more detail on the reasoning. So I was a little impatient, jumped the gun a little bit when I could have been a little bit more patient, because I definitely felt like price was going to come back lower, take out the low, and then go higher. So what was your feeling at the time? I wasn't too confident. Can you put in place to, you know, make sure this doesn't repeat over and over again? So something I could have done differently was market can do one of two things. It can either pull back and hold to go higher, or it could, you know, come lower, take out this low, and then push higher. I definitely felt like it was going to come lower and take out the low before going higher, but I was a little impatient on the specific trade to where I took it there. So something that I can do differently if this were to happen in the future, instead of impulsively taking the trade higher, I have to be more comfortable waiting for price, you know, to give me additional information, because I definitely jumped the gun on this trade when I could have simply, you know, as it was pushing higher, I took it because I was, you know, anticipating this to be a low, and I should have been a little bit more patient and said, okay, I'm gonna wait for it to pull back again, and if it holds, then I'll take it, just in case if it does pull back for another time, maybe it will probably take out that low. In the future, if I find myself in this situation to where I'm taking a reversal and we get that initial pop higher, instead of just buying as it's going higher, I want to wait for price to possibly pull back and hold and then see a big push to the upside, but then just taking it impulsively as it's going higher. This price can, obviously come lower, take out this low, and then go higher. So these are kind of like the little things in trading that you don't even think matter, but they make the biggest difference, right? Because trading is like a puzzle piece, and there's 1,000 pieces to our particular puzzle, and every single win that you take, you want to learn from it and get a puzzle piece. Every single loss that you take, you want to learn from it and get a puzzle piece, and the more pieces of this puzzle that you get builds that experience to where you can come to a market and just trade kind of like how I trade, right? I just come to a market, so it's gonna go higher, oh, it's gonna go lower, oh, I know when to buy here or sell here, right? Just because of the years of experience that I've built. So you want to constantly be able to improve, iterate of what you already know, and constantly get better. That's what I could have done differently. When it comes to give more detail, something that I did right with this trade is I didn't scale in. When it comes to the feeling, right? What was I feeling at the time? When I feel like I get confidence or this is a good setup, I'll add more contracts to my position. So I start off with low risk and then I add more to it. But in this particular trade, since I did not have that confidence, I never scaled into the trade. So that's why I only lost $160. So since I didn't have the confidence in the trade, I didn't scale in, which is great because I ended up losing a lot less. Never want to just immediately jump the gun in a particular trade, because you'll end up in a situation to where you may get a low quality setup, and since you go in with max contracts, you lose off a lot of profit, basically take a huge loss. Basically, I didn't scale into this trade, so once price came back on me, basically lost the lowest amount, which was $160. So this was a great trade idea. A little bit more patient, I didn't scale in, which is great, end up losing a lot less. I didn't scale in, a small loss. Right, this is less than 1%, practically break even. Next trade that we took was right here. So followed when price took out this low, following by this push to the upside, we took our second trade about right here. When it came to this trade, my original stop loss was down here, and when price the next candle opens up, sees a push to the upside, I ended up scaling into my trade for about a second time, about like right here. Whenever I scale in, I trail my stop loss, right? Because I'm anticipating a breakout to take place, so I don't need my stop loss down here. I can keep my loss smaller, trailing my stop loss like up here and eventually up here. So when I scaled in for a second time, my stop loss was right here. So this was where my stop loss was, 4 contracts at the time, right? I didn't risk much on Friday just because I felt like it was low quality, pretty low risk for this particular trade here on Friday. I made the mistake of scaling in not 1 time, but I scaled in 2 times. So when I took my first scale in, which was right here, my stop loss was down here, right? This is perfect. Right? This is a perfect stop loss right back at this liquidity sweep. But I felt very confident in this trade, and I felt like I could trail my stop loss a little bit more. But what I did was I scaled in for a second time, and since I scaled in again, I had to move my stop loss from down here to basically right here. So basically, I was trusting that this last stock close candle right here was a bullish order block. I was basically trusting that my stop loss was pretty much below the bullish order block and price wasn't going to come down there. So that was kind of like me trusting, okay, this is a support level that price wouldn't come down into. And you can see here in the next slide, price ends up coming lower, stops me out perfectly before going into my full take profit. This was the exact trade idea right here. The mistake that I made on this setup was I scaled in too aggressively. So on this particular trade here, I'm pretty sure I lost around 500 on 572, negative 0.18. It was the same thing, swoops trade, AM session. So over here, be the image, then go over here, put it right here. Was I say misprice action, and more detail on this trade specifically. So on this trade specifically, everything was great, but this was a minor mistake in terms of stop loss placement. But your stop loss is key, because you find yourself in these situations. And when it comes to these long wicks, you can see here that this is a pretty long wick. Sometimes they can act as fair value gaps, kind of like how price will create a fair value gap, come down into it, find support to go higher. These wicks can kind of be the same. So when you're putting your stop loss, you got to be aware of these long wicks. You want to have your stop loss at least below the 50% of the wick. Fibonacci here, like 50% is right here, so like below 50%, like right here, below here, or or at the low of the wick. You don't want to put your stop loss up here between the opening of the wick or like the 25%, because you can find yourself in a situation to where it could stop you out before going higher. When it comes to learning your losses, it's like little stuff like this that you don't even recognize or even know that'll make kind of like the biggest difference. So if this were to happen to me in the future, let's say in the future the exact same trade setup is going to pop up, I understand that last time I put my stop loss at the opening of the wick. Next time that this happens again in the future, I'll understand since I lost here, my stop loss goes down here or down here. And these are like the key insights that you need to make consistently if you want to improve as a trader, right? These are like the little tiny mistakes that you've probably never seen or didn't even recognize were, you know, mistakes that happen within your trading that now you're able to recognize. You can make the, you know, conscious, you know, decision when they happen in the future to avoid. So if you're able to make these constant improvements and avoid them in the future, you'll find yourself in a position to where you're making less and less mistakes. You'll be a little bit more patient, and you kind of have that awareness to be like, okay, I want to take a trade here, but I lost here doing this in the past. Maybe I can avoid it. So that's where you kind of get that, you know, insight, or kind of like that third eye in a way, is by recognizing these mistakes that you made or these losses that happen, being able to, you know, be in a position to avoid them in the future. So in this trade particularly, I had the wrong stop loss placement. It was a little too tight. So what was I feeling at the time? So great setup, but you know, the only mistake was, you know, when it came on me, I felt I filled in too quickly. Can put in place to stop this, you know, in the future or not repeat it. Stop loss placement is huge, right? It's good to scale in, but do not scale in if you feel like your stop loss will be at risk. Something that I can do in the future is, right, when I scale into trades, scaling, I have to trail my stop loss. So if I take a trade up here, and if I scale in and I have to trail my stop loss from down here to up here, in the future, if I feel like my stop loss is not safe, I'm not going to scale into that trade. So being in this situation to where I had a great setup, everything was perfect, stop loss down here, due to me scaling in and having to trail my stop loss, it gives me insight that where you know, when you scale in and you trail your stop loss, you want to prioritize where your new stop loss is going to be. So if you feel like your new stop loss is not safe compared to where you put it originally, don't scale into that trade. So I definitely should have just kept the trade with the 2 to 4 contracts rather than trying to scale into 6 to 8, because scaling in aggressively like that means you have to trail your stop loss, means the tightest or the slightest, you know, stop hunts is going to take you out before going in your favor. So me taking both of these losses and losing about $700 on the day, even though yes, I lost $700, you know, I'm still up $1,100 on the week, so it doesn't really matter. But these two losses were great because they give me key insights about the little stuff in trading, right? I'm at a point now in trading that it's not the big stuff, right? It's not strategy, it's not nothing, you know, psychologically, but it's kind of like the little stuff, right? You know, you could have been a little bit more patient on the first trade, right? Scaling in and having the wrong stop loss here, right? It's the tiny little things that, you know, make the biggest difference, and you want to be aware of all of those, right? From the big things like if you have an overtrain problem to the little stuff to where like where you put your stop loss. You know, there's a minuscule of, you know, a lot of things within your trading that you want to constantly improve upon, constantly learn from. Every single win that you take, you want to learn from those wins. Every single loss that you take, you want to learn from those losses and how to avoid them in the future. Now we're going to go over a situation to where I had a winning trade, but I allowed psychology to mess with that winning trade and it ended up being a loss. Last week here, I was up about $700, close to $800 on a particular trade, but you know, greed getting in the way only closed the trade for about $200. So when you're in that situation to where you have a psychological event take place that prevents you from, you know, capitalizing on a move or profits, that can also represent as a missed trade. So we'll go over here, and this was about last week's I forgot which day this was. I think it was like last week's Wednesday, so like March 18th. I made profits on this day about, you know, $250 on this day. Multiple 0.027. No, this was same thing about turtle soup kind of, and this was opening range breakout. On this particular day here, we can see the market was, you know, in a downtrend before we opened up, and I wanted to see higher prices, right? So for 9:30, right, 9:30 is about to open up, 9:30 opens up, right? I'm staying patient, right? Because obviously you don't want to just immediately immediately, you know, buy when the market opens. So it opens up, sees this drop to the downside, and we see this immediate rejection higher. So this is where I took kind of like that first trade idea right there, had my stop loss back down here, anticipating a, you know, reversal pullback, basically back up into this last up close candle. So this right here is a, you know, bearish order block from this drop here, high here, drop lower. Wanted to see price come back up here. As price kind of went in my favor, I was able to scale in. So the next candle you can see here opens up, pulls back, comes back within that order block right here. This last down close candle right here, hold within that level, sees a push to the upside. I scale in, trail my stop loss just back below, kind of like the low of the order block there. Really nice. You know, actually a little bit higher, like up here. Trailed my stop loss a little bit higher up here. Still same take profit back up here. And the next candle opened up. Pretty sure my take profit was like up here for 20 points. So I very remember, yeah, about 20 points like up here, perfectly right here. This was my 20-point target perfectly, right? Entry at the lows, and I always look to get 15 to 20 points. I wanted to hold this trade a little bit longer just because we had seen a big move to the downside, and I felt like this could have possibly been the low, and maybe we could push past that to maybe go higher. Well, next candle kind of opens up, comes back on me a little bit near break even, right? It opens up, sees a slight pop to the upside, then sharp decline, ended up taking off for a little bit early there around here for about I think a little bit earlier, like up here, about a $200 profit. This was a situation to where I had a winning trade. It already hit my take profit, but I felt like this was the low, and instead of just taking profit there, I wanted to hold a little bit longer because I felt like this was a low and it could continue pushing higher. So taking profit there, I held it, and it came back to me near break even for only 200 bucks. So this was a missed trade idea based upon greed, external pressures and influences. More so, I wanted to make money, so that's an external pressure that must be to hold this trade. You know, you'll be one to make more money, you know, causes you to be a little greedy at times. So give more details. Every single time I take a trade, I know price is going to give me 15 to 20 points, right? Those are my base hits. You want to look for getting your base hits on a consistent day-by-day basis, right? It already hit my 20-point target. I should have taken it off there, but feeling like this was the low followed by the big drop higher, or this big drop lower, I felt like I could have held it a little bit longer, but obviously, right, bad mistake there, causing me to be greedy. This was the low, and price was gonna keep going higher mistakenly. Mistakenly thinking it was going to go higher. What can you put in place to prevent this in the future? In the future, right, stick to my base hits, 15 to 20 points. Don't get greedy. No, always use today as a lesson of greed and why you want to stay consistent rather than looking for runs, right? We love home run trades, you know, getting those killer trades, getting 30, 40, 50 points. But the thing is, those home run trades do not happen every single day. But you do know what happens every single day. A base hit. It's always going to hit 15, 20 points on a day-by-day basis. So instead of trying to, you know, get those home run 10 to 1R, 8 to 1R trades, stick to getting those base hits on a day-by-day basis, because you do not get paid as a trader until you close. Meaning the analysis I did, entry that I did, everything that I did not matter until I closed the trade. So if you're looking for those home run trades and price keeps reversing on you, you will not make money trading. You want to stay consistent, and being consistent means you have to exit when, you know, when price hits your take profit. So those base hits like 15 to 20 points, you know, 1 to 0.5R, you know, 2 to 1R, those are gonna hit consistently on a day-by-day basis. Stick to your base hits, right? This was only a 1.6R, right? But it hits consistently, right, on a day-by-day basis. So stick to your base hits, and, you know, don't try to be greedy. So this is a trade that we took, right, which was, you know, pretty much break even, like 200 bucks, that we were able to get a lesson from. So in the future, if I find myself in a situation to price hits my 20-point target, I remember vividly on this specific day, price came back on me and reversed on me as I hit 20 points. So in the future, when it happens, I won't make that same mistake. And guess what? You know, this was, you know, 2 weeks ago. I have not made that mistake at all since then. So every single time it hit 15, 20 points, I always took my profits, especially this week, right? Monday, we're able to take buys, took it off there, 20 points, took it off there, you know, 15, 20 points there on, you know, Wednesday this week, took the sells up here, took it off 20 points down here perfectly. Then, you know, Friday, that trade would have been a 20-point target. So since we made that mistake, we never repeated it. So that's the power of being able to learn from your losses, to not repeat those same mistakes in the future. If you want to catch the exact high and sell at the exact low on a consistent day-by-day basis, you need to understand and master top-down analysis. And something that you may be struggling with as a beginner trader is possibly patience and planning. Now, you come to the markets, but you don't know where it's going to go, don't have a necessary plan, you don't know what to wait for or anticipate. And in this video, that's exactly what I'm going to help you fix. I'm going to help you come to the markets with a pre-distinct plan, so when you're in the markets, you're not FOMOing, you're not getting greedy, you know exactly what you're looking for. Once you get the opportunity, you're able to make much more higher quality trades. If you want to become a consistently profitable trader like myself, right, it's one thing to be profitable and make a payout. It's another thing to be consistently profitable, making money week after week, month after month. If you want to achieve that, you have to start planning your trade. Planning my trades and waiting for those higher quality setup allows me to take less trades, but since they're more quality, I am able to win a lot more. And this is exactly how I make over $20,000 per month with over a 80% day win rate, meaning 8 out of 10 days I will most likely win. It's simply by coming to a market with a plan and trading in alignment with that plan. Revolves around top-down analysis. You want to create structure within your trading. There's a specific time that you trade, there's a specific pair that you trade, and I trade between 9 o'clock to around 11:30. You want to create structure within your trading. If you don't have any structure, you'll most likely be a rabbit all over the place. You're trading Asia, then you're London, then this, then that. You want to create structure in terms of what you're trading and when you're trading on a consistent day-by-day basis, so you don't lose yourself in the charts, because the charts are very vast, and if you don't have any level of structure, you'll chase anything, and if you're chasing anything, you won't be consistent. So starting off, I'm on the 4 hours time frame, and when it comes to the higher time frames like the 4 hour and the 1 hour, the main focus is understanding where have we been, where are we currently at, and where can we anticipate price to go next, as it's important to understand the market revolves around 3 things: market structure, liquidity, and inefficiencies. So on the higher time frames, those are the only things we're looking for. What is the overall market structure? Areas of liquidity is there, and what inefficiencies can we see price find support at or bounce off of? So the first thing that I always take note of is the previous daily highs and lows. Previous day highs and lows are areas of liquidity that price tends to take out 90% of the time. So we can see here that price had came lower to take out this previous daily low, right? The candlestick to my right here, called HTF candles by Foddy, basically displays the daily candlestick while I'm on the lower time frame. So it shows that price had came lower to take out this previous day low, followed by this push to the upside. It's very important that when it comes to previous day highs and lows, there's 2 things that can happen. Either price will take out a previous day low in reverse. This is a previous day low reversal or a previous day low sweep, or it would be a liquidity run where price will take out this previous day low and will continue lower. Something like this. On the prior day, price had taken out that previous day low here, gave a little bit of pullback, but ultimately it continued lower. So the prior day was a previous day low run, or it took out previous day low and continued lower. Today, it could possibly be a previous day low reversal, where it takes out this previous day low, followed by this push to the upside. The main key thing that I took note of this morning on the 4 hour was that we swept the previous day low and we have the previous day high above us. If the market is bullish, then possibly price could be reaching back up into the previous day high. Raw liquidity. So we have liquidity marked now. We took our previous day low. The market, since it got that previous day low, seen a push to the upside, possibly anticipate maybe higher prices to come back up into previous day high. So whenever we're creating a top-down analysis, we're framing a story of what we can anticipate or what the market is showing us. We're not trying to predict the markets. We're using the information that the market is giving us to create a story for what we can anticipate to happen. And as we go down to lower time frames and even lower, it will all start piecing together. Right? This is why I want you guys to pay attention and continue to watch this video, because the story has to unfold itself. Another thing that I can take note of is this 4 hour bearish order block, because this is the last up close candle followed by this drop to the downside. So we have to understand that this is obviously a level of resistance. Only do we have this bearish order block, but we also have this rejection block above us. See here how these bodies are equal. This wick is much longer than the wick to the right. From the equal bodies to the longest wick, this is a rejection block. Typically, rejection blocks can be a point of resistance. Have you ever been in that situation to where maybe you have a take profit at the original high, comes close to the original high, doesn't take it out, and then reverses on you? Reversed on you because it was in a rejection block. So you want to pay attention to these specific levels whenever whenever you see them, especially on a higher time frame like a 4-hour and a 1-hour, because they tend to respect those levels a little bit more. The higher time frame picture here on the 4-hour basically tells us that once price took out this previous day low, it saw a reversal. Price could no longer continue going lower, and we're seeing higher prices at the moment. Even though we're seeing higher prices, we have to understand there's resistance above us. The market opens up, I don't want to be buying within resistance. Maybe if the market opened up down here, could buy down here for a pullback, get up here, most likely around the 50% of this order block. The bigger level, we can mark out the 50%, right? This could be a trade setup, or get back up into a rejection block. But if the market is within this order block or within this rejection block, I don't want to be buying up here because it's too high up. So this is where we get into the market structure standpoint. So if we anchor from the high here to the low using a Fibonacci, we want to be buying down here below the 50%. Whenever we get above the 50% here, like up here or up here, it becomes lesser probability. From a market structure standpoint, price gets up here, or if it opens up here, we don't want to be looking for buys necessarily. We want to be looking for shorts. If the market opens up and it's down here, we can look for buys down here. In terms of liquidity, previous day low sweep followed by this reversal to the upside. The market is currently bullish. Market structure standpoint, we can buy here, we could buy here, but we can't buy up here. From an inefficiency standpoint, we have bearish order block right here, bearish rejection block up here. So I hope you guys are understanding it. We're gonna go down to the 1 hour's time frame to get a little bit more information. So on the 1 hour's time frame, we're simply just refining what we did on the 4-hour plus adding additional information. So the first thing that I can do is I can remove this massive box here, right? This right here was the 4-hour order block. Let's remove it down into this 1-hour order block up here. So we don't need a massive box within our chart, right? We want to have our charts looking clean. Here we have that last up close candle as the bearish block right here on the 1 hour, is also in alignment with that 4-hour order block. A lower time frame resistance within a higher time frame resistance, another level of what you call confluence. Basically, which a confluence is basically adding confidence to what you already anticipate. If you're anticipating this to be a resistance, the fact that it has a 4-hour order block and a 1-hour order block, it gives you additional confidence. Okay, this is pretty good resistance level. It has a higher time frame, lower time frame order block within that specific level. Taking note of this 1-hour order block, and we have this rejection block above us on the 4-hour. This is still good. We're not going to refine the 4-hour rejection block because like a 1-hour rejection block, right? You can see as they're equal, this wick is the highest wick. So this is a 4-hour plus 1-hour rejection block. Into markets here, another thing that I can take note of is this 1-hour bearish reverse gap. We have a 1-hour bearish reverse gap, a 1-hour bearish order block, plus a 4-hour plus 1-hour bearish rejection block. This level right here basically tells you that we are within resistance. We know that we're within resistance. Would it make sense to buy up here or buy up here? Probably not, right? It wouldn't make much sense to be buying up here knowing that we're within resistance. Below us, we can also take note of this as a bullish reverse gap. This gap within the markets, this is a bullish reverse gap. Below it is a bullish order block. So this last down close candle here for this pop to the upside, this would be a bullish order block plus a bullish reverse gap. Now that we kind of marked out our levels, right? We marked out resistance plus we marked out some support and create a plan. When we're creating a plan here, it's pretty simple. We understand that there's resistance above us. If the market opens up and goes higher, we cannot be buying up here because this is a resistance level. Understand that there's support below us. If the market opens up and comes lower, this could be buying opportunities where we could look for buys to go higher. My main emphasis for this day, I want to see lower prices. The reason why I want to see lower prices is because the market is up here and let's say it continues higher. I'm not buying up here. I'll look for shorts to come lower. Market opens up and comes lower, comes down into this level. I want to see if it will hold. Basically, I want to see if price will consolidate within these fair value gaps, find support, and then leave it. If the market were to open up and come lower, I would look for buys within these support levels. If the market were to open up and go higher, I would look for shorts up here. Whenever we're creating a top-down analysis, we're simply just creating a story. We're creating a plan. So when the market opens up, we're simply just trading in alignment with our plan. Problem with a lot of traders is they get into predictive trading. They say, oh, there's an order block up here. Let me put a limit order up here. Very tight stop loss, anticipating a reversal lower. You're predicting, and once price gets up here, it's going to go lower. You don't want to predict. You can take note of it, but once the market opens up and gets up here, you want to see price consolidate and then leave it. That's your confirmation. Whenever I'm trading, I create a plan based upon the three things. Have we been? Where are we at? And where do we anticipate price to go next? We've been in an overall uptrend. Reversal at these lows to go higher. We're currently within resistance. Don't want to be buying up here. The market opens up and goes higher. We're sitting on our hands and we're being patient. Can we anticipate price to go next? Price finds resistance. resistance up here and we frame a short, where can we go? We can go back down here in these fair value gaps. It's that simple. Market structure tells us we're too high up, you don't want to be buying up here. Liquidity tells us price sticks out the previous day low and we're seeing a reversal. Inefficiencies tells us resistance up here, support down here. It opens up and comes lower. If it can find support down here, you buy. It opens up and comes higher. If it finds resistance up here, you sell. It's that simple. Create a story, create a plan as the market opens up. When we trade, allow that plan to come to fruition. You don't chase the market and you don't try to predict the market. I'm gonna go down to a 15 minutes time frame. If you don't know, I trade live with my students every single morning, Monday through Friday. Currently for this entire year, we've pretty much won every single week and we've been super consistent. And if you get value from this video and you want to be coached by me, live with me every single morning, learn how to trade, become a consistent profitable trader, and for hundreds of students. If you want to become a student, be coached by me, click the first link, book a free call, talk to me personally. Let me see where you're at and how I can help you. The main idea is we're at levels of resistance. The market opens up and comes higher. I'm not chasing it higher because I understand we're within a premium of that 50% of the market structure. So it would be low probability to chase it higher. You can see here 9:30 opens up. We see this initial pop to the upside. I didn't buy it. Some students in the chat this morning, we talked about, price come down to this fair value gap, to find support to go higher. Why didn't I take this trade? What I told my student is to take every trade that the market gives you, you'll end up chasing everything. My main idea is since we're up here, I want to be looking for shorts. The one trade idea that I have. Yeah, you could buy down here and find support to go higher. You can even buy up here anticipating a breakout to continue. But if you take every little trade within the markets, little scalps here, little scalps there, and you take everything, then you're just taking a whole bunch of low quality trades. You're never going to be consistent trading like that. Want to focus on creating a high quality trade setup. Want to wait for price to give you that opportunity for that one trade. Miss it, or let's say it doesn't give you it, you have to be comfortable saying, we'll trade today, I'll come back tomorrow. Problem that you have as a trader is you try to take every single trade within the markets and they're all low quality, so you end up taking more trades than you need to and you end up winning a lot less. When you create a plan, you wait for the market to come to you in alignment with that plan. Even if the market doesn't come in alignment with our plan, let's just say it goes higher and continues higher forever, don't have a trade, I'll come back tomorrow. That's consistently profitable. It's creating a plan, waiting for the market to allow your plan to come into fruition, and if it doesn't, comfortable saying, I don't care. Market opened up, it went higher, didn't take a trade, didn't care, continue going higher, didn't care, then start to stall around here, right? Create this doji candle, got back up into that rejection block here, right? That purple box, that rejection block. At this point, it's telling me already seen a pretty nice rally, right? We're pretty significantly on the day, getting to a level to where it's starting to slow down. This is exactly what you want to see, but I still didn't take a trade because price could easily just open up and come higher and continue higher. So I still didn't take a trade. I still stayed patient. Next 15-minute opens up right here, and you can see, right, price opens up, right? And how I trade is I pay attention to exhaustion within the candles. If I'm at a level of resistance, I want to see price reject from it. So since I know this is a rejection block, this is a resistance. When you have a resistance, you want to see price come back into it and then leave, come back into it and then leave it. You don't want to see price make an effort to try and break through it. You can see it came back up here, rejected lower, opened up, came higher, rejected lower. It tells you that every single time price made an effort to come up here, someone kept shorting the market, pulling it lower, meaning that it's respecting this level. So for my first trade idea here, rejections, I framed my short and I had a pretty good stop loss back up here. Like pretty good stop loss. Basically just targeting about 20 points down here. Usually I aim for 15-20 points. That's typically the average for the S&P 500. This is why I trade one pair, because I understand my pair a lot. I want to get very good at just trading one thing and become very proficient in knowing the movements of that pair. So I was just aiming for 20 points, which is also in alignment below here of this fair value gap. This was the trade idea here, and the next candle opened up, seeing a pop to the downside. I scaled into the trade. First trade that I have is lower risk with usually 4 contracts. The first trade is more so aggressive. Seeing the rejection at these highs here, it tells me, okay, it's rejecting here, I'm gonna take a short. Basically low risk, staying off of the bias that I had. When I scale in, that's my confirmation. You want to scale in where price is just like, it's gonna go lower. I can trust this. Once this next candlestick opened up and just seen a big pop to the downside, added to that position, meaning I added more to it. So my new entry is now down here. I remember I had a 12-point stop loss. Yep, right here, 12-point stop loss back above these highs. Right, so when I scale in, I trail my stop loss. So originally it was 15 points, now it's 12. So I go from risking about $300 to now risking $400. But instead of, making, $400 on this trade, I end up making, $700-800. You risk an additional $100 to make an additional $300-400. So I was just aiming back below these lows here, 20 points. You can see price ended up coming down there, and that was the exact low. It eventually came down here, took out this 930 low as an area of liquidity, but I take my 20 points, don't get greedy, take my base hit, come back tomorrow. When you're consistent, don't need to go for home runs, right? You can just make your base hits every single single day and make money consistently. And when you're consistent, you just make your base hits, make money, come back tomorrow, do the same thing again. So I made my money, ordered at the exact high, my position at the exact low. Yeah, I ended up coming back on us, over there, but we already took our money, pretty much consolidated for the rest of the day. Most people would look at today as consolidated, choppy, price action was terrible, I blew my account. Now we traded it, we made money, we're gonna do it again tomorrow. This is what consistency looks like. Not forcing setups, it's not chasing setups, it's creating a plan, it's allowing price to come to you, and it's having good risk management, good psychology, and a good strategy that you can trade on a consistent day-by-day basis. This is what I teach all my students. Super solid. From late February till now, we've made well over $12,000 across 5 accounts, which you can see here. I'm going to refresh the page. I'm going to refresh the page once again, as well as I'm going to show you my broker statements, which you can see right here. From late February till now, I've made well over $12,000 across 5 accounts. Within this year alone, I've made well over $60,000 trading, been able to consistently make $20,000 per month, as adding 3 alpha futures to my trading capital, as well as 5 tradeifys to my trading capital, train well over $700,000 worth of funding, with my goal being able to trade over $2 million worth of funding, making anywhere from $50,000 to $100,000 per month trading consistently by the end of this year. $20,000 to $30,000 right now is a great goal. I'm still improving myself as a trader, continue to get better, continue to learn, and bring you guys along the journey to reaching those amazing milestones and help you guys along the way. Difference between trading a funded account versus a live account, and why funded accounts are very important along your trading journey. Upside of a funded account is the leverage. So you pay $50 to $100 to get access to $2,000 worth of capital. So instead of putting $2,000 of your own money into a account or brokerage, you would simply pay $50 to $100 for a challenge to get up to $2,000 worth of that trading capital. The benefits of a $10,000 live account is once you put $10,000 into account, if you, let's say, make $2,000 or $3,000 that day, you can withdraw that same amount that day. $2,000 or $3,000. If you had a $10,000 live account, upside would be you can withdraw that money at any time and you can play with it. But the benefit of a funded account would be the leverage. Instead of putting $10,000 of your own hard-earned money into an account, you can simply buy 5 funded accounts and have the same amount of drawdown. Every single 50K funded account, once you pass the challenge, has a $2,000 max drawdown. So if you have 5 accounts, that's 2 times 5, which is 10. Instead of putting $10,000 of your own hard-earned money, you can simply invest $350 to $500 to get the exact same leverage. This would be the beneficial of using a funded account, because if you have the skill set of trading, instead of putting $10,000 of your own hard-earned money, you can simply use a fraction of that to get the same advantage and leverage. The downside for both of them would be, for the live account, this would be a heavy risk to your finances. I'm not sure if any of you guys would just have $10,000 lying around to play with, you know what I mean? So this would be a heavy risk to your finances. So since you're just putting $10,000 into a live account, especially as a beginner trader, when you don't necessarily have the skill set yet, is very detrimental to your finances, and you can easily lose that amount. And since you have such a large amount in a trading account, fall short of your emotions and go on to over trading, over leveraging, or revenge trading and lose that account, which then you'll be down $10,000, which is not a good feeling at all. The downside of trading a funded account, even though it's a lot cheaper, investing $350 to $500, problem is for you to get access to that $2,000, you have to pass a challenge. And usually with these challenges, it's 2 things. You have to make a certain amount of money, which is $3,000, cannot go below a certain amount, which is $2,000. So as you pay the $50 to $100 for the funded account, you have to make $3,000 on the account. But if you lose $2,000, you basically lose the initial investment, which is the $50 to $100 per account. So you can see the stark difference here between losing $10,000 versus if you were to blow out of 500 accounts, you would only lose $350 to $500. So you can see the clear stark difference between a live account versus a funded account. It's a lot less risk, the exact same upside as a live account. As another downside is whenever you are withdrawing from a funded account, you can only withdraw 50% at a time. So So whenever you do pass a funded account, most likely you won't see a withdrawal until maybe a week later, just so you can give yourself a buffer. An upside of a live account is once you put the money in, you can withdraw it the same day, which the funded account does not have the same upside, which you have to wait a little bit more for your money and you have to pass a challenge. But you can see that the upside for a funded account, only investing $350, $500 is far greater than possibly losing $10,000. Even though the illusion of a live account is very great, you are losing a substantial amount of money trading a live account compared to investing that money into a funded account, especially as a beginner trader when you haven't truly mastered trading. Eventually in your future, you want to take the profits from your funded account and put it into a live account just so you can have that initial money. So, you know, if you have a great day and you make $2,000, you can withdraw that $2,000 the same day. As a beginner, I would not recommend you just immediately put money into trading, especially money that you worked hard for. But the main problem that you guys have when it comes to funded accounts is passing the challenge. These funded account companies make hundreds of millions of dollars per year on the fact that most traders who come into funded accounts come into it with the mindset that they're going to get rich overnight. When it comes to passing this challenge, most traders try to rush it. Even if those traders get lucky and pass the challenge, once they get to the funding stage, the emotions start to kick in and they start getting greedy, over trading, revenge trading, and eventually blow the account. Even though funded accounts are great when it comes to the leverage that they have compared to a live account, most traders, around 95% of traders, will blow funded accounts consistently, making these companies millions of dollars per year. And in this video, I'm going to show you the exact process that you need to do on a consistent day-by-day basis, utilizing risk management, so you cannot be a part of that statistic. It is currently April and I have not lost a funded account since December. You have great risk management and you are aware of your numbers, you will not fall into that statistic of blowing accounts, but instead you'll fall into the statistic of the 5% and even 1% of traders who get consistent payouts and even get moved up to live accounts through the funding process. So I'm going to show you guys the exact risk management approach that you guys need to do on a consistent day-by-day basis if you want to stop blowing funded accounts and make your first $5, $10, and even $100,000 trading. When it comes to choosing the right funded account, I'm going to show you guys 3 funded accounts that I recommend, as well as discount codes that you can use so you guys can pay the least amount of money. The first one that I recommend the most is called Lucid Trading. So you want to go into your browser, type in Lucid Trading. Be the first link, Lucid Trading funded account, or you guys can check the link in the description. You want to scroll down to where it says start trading, and this is where you guys will get your funded account. Right, the best funded account to get with Lucid would be the Lucid Flex 50K account. So the profit target to pass this challenge would be $3,000, but you cannot lose more than $2,000, which is basically industry standard across all funded account challenges with the 50Ks. But the thing about the Lucids is it's very cheap, so you only pay one time, as well as there's no activation fees. Some funded accounts would have it to where you pay for the challenge, but once you pass the challenge, you have to pay some sort of activation fee to activate the account. So instead of paying, let's say, $98 for the account, you end up paying, you know, $150 or something because of the activation fee. With Lucid, there's no activation fee and there's no monthly payments. It's not like you're paying $98 a month. You pay it one time, you pass the account, you get to fund it. So it's the cheapest and most reliable one, as well as I do feel like they're the easiest to get a payout. Started using them around February and already now I've, you know, cleared $30,000 with them. So easiest to get a payout, very affordable. Go to the Lucid Flex, right? You want to go to the 50K account, select a platform, use NinjaTrader Tradeovate up top right here. When it comes to discount code, you want to use code Arkham. So this right here will get you 40% off your funded account. If you're just buying a account with Lucid, you'll also get a additional 10% off as well. So you have that 40% off applied, it's an additional 10%. So I already bought accounts from Lucid. I don't have that 10% off discount for the first time users. So it's only 40% off. If you are a first time user, it will most likely be like $70 or so. Very affordable. And once you get to that funding stage, have $2,000 worth of capital. Once you pass the evaluation, you'll essentially be investing $80 or $70 at $2,000. So that's more than a 10x. That's Lucid trading for the first account that I recommend. So the next would be Alpha Futures. So you didn't want the Lucid, you want more so of an Alpha Futures. So this is great as well. So you want to go up to the top right here and want to click on Start New Challenge. You want to go over to the standard plan. This is the most affordable, same rule, make $3,000. Cannot lose 2,000. Super solid. Payouts is bi-weekly. Like I mentioned, the one downside of funded accounts is you can't just withdraw the same day you make your money. Sometimes they pay weekly based upon how much money you make in a row. So if you make $200 in a row, you can request a payout. Lucid, Alpha Futures, they pay bi-weekly of how much you make. So that's the one downside of funded accounts, but it's definitely worth it since you're not investing $2,000, right? It's a slight cost for a great upside. You want to go over to the standard plan, and over here where it comes to coupon, I want to use code Arkham, right? Since this is my code, I cannot use my own code, but this will get you anywhere from 10 to 20% off based upon what discount they're running that month. So right now I think it's 20% off. So instead of paying, $79, you'll pay anywhere from $71 per account. And the max accounts you can have for Alpha would be 3 accounts, and the max account that you would have for Lucid would be 5 accounts. At least would be Tradingview. So once you create a Tradingview account, or click the link below and create an account, you would go over here to add account up here or right here, and you want to go over to the growth right here, and you want to select the 50k right here. So Tradingview growth 50k, most affordable $87. Same thing, profit target 3,000, cannot lose more than $2,000. And when you go over to discount code, make sure you guys use code Arkham. This gets you over 40% off. So instead of paying the 145 right here for the 50k, you would only paying $87. You can see here from Lucid Trading, right, $84 to the Alpha Futures, which seems to be the most affordable right now, which is $79. With the code, it gets you down to $71. But I still recommend Lucid, just because when you pay Lucid, it's one time, compared to Alpha Futures, it's $71 per month. So if you don't pass the challenge within 1 month, you have to pay $70 again the next month, which is a little lame, but it happens. So Lucid right now is definitely the best in terms of most affordable. Pay one time and you get the account, no activation fee. And the Tradingview is the most expensive, which it being $87 for an account, but it is what it is. Tradingview is good, which you can trade 5 accounts through Tradingview. So Lucid Trading is #1 recommended, Alpha Futures is second, and then third would be Tradingview. If you're someone like me, ignore the losing day today. We lost about $400 across all accounts. Chill. We only lost $400. Ignore the losing day, but you can see I have 5 Lucid accounts, 3 Alpha Futures, and 5 Tradingviews. At first, I recommend you guys just get 1 account through most likely Lucid, and once you pass that account, you could possibly get like 2 more, 3 Lucid accounts, and then so on and so forth. And then eventually over time, as you become more confident, you can start trading more accounts and get max allocation for all 3 firms. Ignore the losing trade, by the way. It's only $400. Now that we understand why we want to trade funded accounts, how can we put ourselves in a position to where we don't be like the 95%, just blow account and spend thousands of dollars, keep blowing accounts, right? How can we be a part of that 5% who consistently passes accounts and reaches that first payout, or that first $5,000, $10,000, even $100,000 trading? If you want to be a part of that 5% and even 1% like myself, who's made well over $250,000 trading, have to focus on these 3 things. First would be capital preservation, second would be our systematic rules, and then third would be our systemic edge. So first would be our capital allocation. Since we're trading a 50k funded account, we have to understand how much we should risk per trade. When it comes to how much you should risk per trade, it's based upon this equation. What is the max loss that you have in a row, your stop loss amount plus your contract size? So this is pretty simple. If you want to be very good at risk management, you have to be a little analytical, but it's okay. If you're not analytical, I'm gonna give you guys my equation. So I know, looking at my trading history, that the max that I've lost in a row is 5, meaning that after losing 4 times in a row, it is a very low likelihood that I will lose for a 5th time. So if that were to happen, that is when I would lose my funded account. Max amount of trades that I can lose in a row is 5, and my average stop loss placement is 15 points. And it's very important, whenever I take a trade within the markets, I always have a 15-point stop loss, right? Trading the S&P 500, my stop loss is always at 15 points. So since I know my max loss in a row is 5 and I have a 15-point stop loss for every single trade, that means that I have to risk 5 micros per trade, which 5 micros per trade with a 15-point stop loss means I am risking anywhere from $350, $400 per trade. Just looking at the simple math here, the S&P 500 for every point is $5. If I'm risking 5 micros, that's 5 times 5, which is 25 points per move higher. 25 points per move higher, and my stop loss is 15 points, so that's 25 times 15. 25 times 15 is $375, right? I'm not trying to take you guys to math class, but I'm just trying to show you what it takes to kind of being consistent at a high level, right? You have to have some type of analytics. So since 375 is my max loss per trade, if I were to lose 5 times in a row, 5 trades in a row times 5, that means I would lose $1,875. I cannot go past, so whenever I'm taking a trade, I cannot go past risking $350 to $400 per trade. When you're taking a trade within the markets, it's based upon how many losses are you willing to take in a row to lose the account. Me, I know from my statistics that losing 5 trades in a row is low probability. So if I lose 5 trades in a row, I'm willing to lose the account. If you're someone with a lower run rate, maybe it may be 6 trades in a row. So instead of risking 5 micros per trade, you'd be risking 4 micros per trade, and so on and so forth. We would not recommend going lower than 5 losses in a row. So typically, if you want to have the highest likelihood of keeping a funded account for a very long time, you need to be risking, especially on a 50K account, anywhere from $350 to $400 per trade. Since I trade the S&P 500, that's risking 5 micros per trade, and every single time I take a setup, I have a 15-point stop loss. This is my capital allocation every single trade that I take. 5 micros with a 15-point stop loss, risking $350 to $400 per trade, usually aiming for a 1.5R, 2 to 1R, so I make anywhere from $600 to $800 per trade. So this puts you in a position to where you know exactly how much you're risking per trade. You don't get into situations to where you blow your account. The main problem that traders have, especially when it comes to funded accounts, they over leverage. They risk more than they should, and they put too much risk on the line. Instead of losing 5 trades in a row to blow their funded account, usually most traders only takes them 2 or 3 trades in a row, which if the market is pretty choppy, you can easily find yourself in a situation to where you can easily blow your account in just one day. So it's very important that you focus on prioritizing capital preservation and making sure you're not putting all of your eggs in one basket in case a situation happens where you lose 2 or 3 or even 4 times in a row. You're not blowing your account. So now that we understand how much we should be risking per trade, rate systems, we want to focus on rule, and we want to have discipline within our trade. Reason why most traders within the 95% low funded accounts consistently and spend tens of thousands of dollars per year on funded accounts without a single payout because of these 4 specific things. First would be over trading, second is over leveraging, third is revenge trading, and last but not least is deviating from their strategy. Most traders blow funded account over the course of just one day or one action. You have a situation to where you were supposed to take 2 trades in a day, but instead you lost 2 trades, and the voice in the back of your head kept telling you, take another trade, take another trade. Next thing you know, you take 3 trades, you lose that one, you take 4, 5, you blow the account. For leveraging, you were supposed to risk $350 to $400 per trade. You feel like this was a great setup, I'm gonna put all of it on the line. You blow the account. Revenge trading, you had a great trade setup, it went to your take profit, but you got greedy, and then it came back on you for negative $400. You were supposed to walk away because now you're emotionally inclined to do something stupid, but instead of walking away, you kept trading, and then you blew your account, deviating from strategy. Into a market, you have a pre-distinct plan. You were anticipating lower prices. The market opened up and it rallied higher. Instead of being patient, waiting for the market to fake out higher and then come back lower, you chase it higher. And then when you chase it higher, the market reversed on you. So you end up taking a loss at these highs. And then once it came lower, you started to chase it lower. Now that you're chasing the market lower, the market reversed on you again, stops you out. you take another loss here chasing it, then you take another buy here because you think, okay, it stopped me out here, maybe it'll go higher, so you take another buy, and then the market reverses lower on you and you get stopped out for a third time. Then next you know, the market consolidates at these lows, you're buying it, you're selling it, you're buying it, you're selling it until you blow your account. So the reasonings why people blow funded accounts is not based upon anything when it comes to their risk management. All comes back to psychology. They have no rules or discipline in place. If you're chasing the market when it's going higher, you're chasing it when it's going lower, have a winning trade but you cut it off early, you hold your losses a lot longer than you should, you will never be in a position to where you will make money consistently trading. So it's very important you understand why people blow funded accounts, then you want to create systems / rules to prevent it. So if you're someone who overtrades, you want to create a rule in place to prevent you from overtrade. So the max amount of trades that I take per day is 2 trades per day. This prevents me from being in a situation to where I'll take 3, 4, 5 trades and then I blow my account. The goal isn't to try to pass the account in one day or try to be, quick to make some money. The goal is to preserve the account and focus on consistency, right? How can you be consistently profitable if you're not consistent in the actions that you do on a day-to-day basis? How is it one day that you take 2 trades a day, but then the next day you take 3 or 4 or 5 trades? You have to create a system that you follow on a day-to-day basis. So if you struggle with overtrading, create a rule in place that maxes out when you should stop trading. For the most part, it should be max 2 trades per day. You don't need more than 2 trades per day. Even if you're a scalper and you trade the lower time frames, you don't want to be trading every single time it goes higher, every single time it goes lower, and just chasing it, right? You want to max out at 2 trades per day, because if you're risking 350 to 400 per day, your max losing day would be only $800, meaning for you to lose this funded account, you would have to lose 3 days in a row, which is very low likely. If you lose $800 one day, most likely the next day you'll make that money back. But let's say if you lose that $800 the next day, and usually on the 3rd day, you'll most likely make at least half of it back, and then the following day, you'll go back to break even. So that's why it's very important to understand how many losses can you take in a row. I understand if I lose 2 days in a row, I will win on the 3rd day. If I know that I'll win on the 3rd day, then that means I have to take a max of 2 trades per day. When it comes to risk management, it's all analytical based upon your numbers and putting things in place to prevent you from going outside of that. Since I know that I cannot risk more than $400 per day and my max loss on a day-to-day is $800, I can only take 2 trades per day. If I take a winning trade, let's say first trade that I win on the day wins, that's it, I'm walking away, that's my win for the day. It's me from being in a situation to where I'll have a winning day and then give it back the next trade, right? If you take one win, walk away. If you lose the first trade, you're permitted to take a second one, but if you lose the second trade, you're done for a day, you have to come back tomorrow. Right, next is over leveraging. It's very important that you only risk what you can afford to lose. I'm afforded to lose per trade $350 to $400 per trade. Cannot risk more than this on a particular trade. It's very important that you do not over leverage, because as you over leverage and you lose, instead of risking $400 on this particular trade, you lose $600 or $700. That means instead of losing 5 times in a row to blow your account, you would only need to lose 3 times in a row to blow your account. So you can clearly see here how when you over leverage, it accelerates the process of you blowing the funded account. Right, the goal is to preserve your capital so you cannot blow the account quickly. Most people don't blow their account over the span of 3, 4, 5 days. Most people, 90% of traders, blow their funded account on just 1 day or even a couple minutes. Some people, right, they'll buy a funded account, in the next hour they'll blow it, go back, buy another funded account, blow it again, and then keep repeating this process. So most people don't blow funded accounts over the course of time. They blow it based upon one bad decision or just 1 day. Revenge trading. A rule in place when it comes to revenge trading is walking away when you feel frustrated or that second voice creeps in. You're in a situation to where, like I mentioned earlier, you were up $800, but instead of getting out at $800, you allowed price to reverse on you. Now you lost $400, right? That's a moment of frustration where you were up $800, but now you're down $400. Very frustrated. You want to go back into the market to make the money back. The problem with that is a lot of it stems from a snowball effect. So once you lose this $400, you'll go right back into the market. So you know that trade, it was low quality. You weren't thinking. Now instead of being down $400, you're down $600. Ooh, I'm down $600. I'm gonna get right back in. Now you're down $700. Ooh, I'm gonna get right back in. Now you're down $800. And then you keep repeating the cycle over and over and over again until you blow the account. The moment that you feel frustrated or you feel like, ooh, gotta get right back in, that was so annoying, close your computer and walk away and come back tomorrow. Right, that feeling of frustration in a position to where you'll take a low quality setup and chase the market. The moment that you're starting to take low quality setups and chase the market and not follow your specific rules is the moment that you will indefinitely probably blow your funded account. So whenever you feel frustrated, walk away. Do not revenge trade. This is the #1 killer of all funded accounts, is revenge trading. People get angry at the markets. They miss a setup, right? Their limit order was right here. Price almost hits their limit order, but it doesn't. They feel frustrated. Oh, I'm gonna buy up here. Price reverses on them. Ooh, I'm gonna buy down here. Price keeps going lower. Ooh, I'm gonna buy down here until they blow their accounts. The #1 killer of funded accounts. Do not fall victim to revenge trading. And deviating from strategy, right? Exercise patience, avoid FOMO, avoid greed, avoid hesitation. Right? If you are anticipating lower prices for the day, when you see the market open up and ride higher, don't chase it, right? Don't chase the market. If you say you were going to take it out at $800, take it out at $800. Don't try to hold it for 900 or 1,000 or however much you feel like you should, take. The whole terminology of set and forget is the stupidest thing ever. You are not in control of the market. The market will give you what it gives you, right? If you are up a certain amount of money and you see that price is approaching a resistance, take it off at that level of resistance. Trying to set and forget it, hopefully price will continue going higher, is hoping. When it comes to trading, nothing matters until you exit. You can have the best entry, the best bias, the best everything, but unless you exit the position, it all didn't matter. You only make money on the exit. So don't be in a situation to where you have greed. Always take your profit. Don't chase the market. Don't hesitate either, right? Situations to where you have a great setup, you're confident in it. No, take the trade, don't hesitate, and follow your rules. Last but not least is defining your edge or your statistical advantage. In trading, you want to have a risk management structure. And if you don't have a risk management structure, that's okay. I'm gonna give you guys mine. So what I do on a consistent day-by-day basis when I look for my setup is pretty simple. I identify my A+ setup, right? I choose quality trades over quantity. So most of the time, right, especially this month of April, I've only taken 1 trade per day since this month started. So most of the time I'm taking anywhere from 1 to most at the max 2 trades per day. So when I'm taking trades within the market, they're always A+ quality setup. But what I do is I start off with low risk, 4 contracts with 15-point stop loss. If you guys remember, right, 15-point stop loss, 4 to 5 micros, I'm risking anywhere from $300 to $400 per trade. So I start off with low risk and a 15-point stop loss. When I gain confidence in the trade, let's say, I short at a resistance. So there's a resistance above us. I short at that resistance and then price breaks below a support below it. Right? This gives me confidence that I'm in the right side of the move. So once I get that confidence that I'm on the right side of the move, I will then scale into my trade. Once I gain that confidence, that's good, right? I feel like, okay, I took the short at this resistance. I'm feeling good. This is a great setup. Or a break of structure. So let's say this low right here is a level of structure. I short up here and price breaks back below that low. That gives me strong confidence that I'm on the right side of the market. Once I get that confidence, I then add to my winning position. So I start off with 4 contracts with a 15-point stop loss, and I add 4 more contracts once price breaks through a level of structure or breaks through a support level, which since this is a short trade, once it breaks through a support, I will then add 4 more contracts. So now with the 4 more contracts, I'm in with 8 contracts total, and then I trail my stop loss. So since I'm adding more to this position, cannot have a 15-point stop loss anymore, because a 15-point stop loss now with 8 contracts is over $500. So that's over my risk parameter that I can take per trade. So I lower my stop loss to 12 points or even 10 points. So instead of risking the same 15 points, as I scale into my trade, I trail my stop loss. So as I scale into my position, I trail my stop loss from 15 points to now 12 points. So as I add more to this winning position, I'm decreasing my risk. So it's in alignment with my max risk amount and I'm not over leveraging. And then I always have my base hits. A typical base hit for me, trading the S&P 500, would be 15 points. So 15 points is a level that price will always hit for me whenever I'm taking a trade. 15 points is what I usually get out of. Sometimes or occasionally, if the volatility is a lot higher, I will get out at 20 points. So 20 points is a great exit for me, right? If the volume is there, I have a great entry. I'll get out at 20 points. Not all the times, but sometimes I'll get out for a max win. So a max win for me would be 25 to 30 points. So a base hit would be me making $600. So I'll be risking $400 to make $600. That's a base hit, a 1.5R. Super consistent hits all the time, especially if you have a high win rate like myself with a 80% win rate at the moment. So base hits, 15 points hits all the time. A 20 point will hit occasionally, but it offers great R multiple. So a 20 point would be a 2-to-1 R, basically making $800. So I'd be risking $400 to make $800. So a 2-to-1 R, it hits occasionally 2 to 3 times per week. Max win is usually 1 time, 2 times per week. Well, I'll hit a max win trade and I'll exit for 25 to 30 points, which for 8 contracts is anywhere from $1,000 to $1,200. So a max win would be over a 3-to-1 R. So I'd be risking $400 to make over $1,200. They don't happen all the times, usually 1 time per week, but for the most part, you always want to look for the base hits, which is the 15 points, because they hit consistently on a day-by-day basis. Sometimes the volume may be there, you might have a great entry, great targeting to where you can hold a little bit longer for the 20 points or sometimes 25 to 30, but for the most part, look to get those 15-point base hits. I trade the S&P 500, base hit for me would be 15 points. If you're trading the NASDAQ, a base hit would be like 60 points. So if you're risking 40 points, you would be exiting at 60 points. Occasional hit would be like 80 to 100 points on the NASDAQ, and a max win on the NASDAQ would be like 150 to 200. So that'd be like a max win on the NASDAQ. So you can see here that if you want to trade at the highest level and receive hundreds upon thousands of dollars in payouts, you have to have structure within your trading. This is what your trading currently looks like. You don't know your risk parameters or metrics, right? You don't know how much you should risk per trade. You don't know your max losing trades in a row. You don't know your systematic edge, right? You don't have any key risk parameters or metrics, and you basically just come to a market, see a setup and trade blind. As well as you find yourself in a position to where you trade a strategy you are confident in. Hey, you know, you go on YouTube, everyone's talking about some orb strategy or, you know, whatever. Yeah, there's like a new strategy every week, man. I've been trading the same strategy for the last 5 years. Like, I have not changed, but every week it's a new strategy, orb this, orb that, and you don't really know the strategy, but everyone's talking about it and you trade it, so you don't really have much confidence in it, but it's a strategy, I guess. And you take a loss, you go back in, you take another loss, you go back in, you have no self-control, and the next thing you know, you blow the account. You don't learn from it, right? You just blow the account and like, I followed the strategy, it didn't work, let me learn a new strategy, let me go right back in. So you blow the account, you don't learn from it, you do it all again tomorrow, and next thing you know, you spend, you know, $1,000, $2,000, $3,000 on prop firms. Lucid Trading, Tradify, Alpha Futures, they're in the boss's office having a pizza party because they just made $100 million this year off of failing traders. Let's go. These prop firms are having yacht parties, pizza parties, all of these parties every single year because 95% of their traders are going through this exact motion of blowing accounts, learn a new strategy, blowing that account, learn a new strategy, no self-control, do it again tomorrow, funding these prop firms' pockets day in and day out, right? These prop firms hate They hate traders like me who don't blow their accounts. I haven't blown a fund account since December. It's been 4 months. Not lost a single account. And I've withdrawn thousands, tens of thousands of dollars from these prop firms. They hate traders like me, and they hate that I'm giving you this information on how to pass funded accounts and make money. So do not be like this. Be like this. Have systems, rules, and discipline. Know your numbers, right? Your capital allocation, how much you should risk per trade. Have a systematic edge that gives you an advantage while keeping your risk small but maximizing your reward. This is how you'll be in a situation, whatever you trade, however you trade, you will make money consistently. You won't blow funded accounts. You'll start getting payouts consistently. Profitably. So I hope you guys got a lot of value from this video. It took me months upon months to really create this course, and I truly hope that by the end of it you are a much more proficient trader and is one step closer to reaching that goal of becoming a consistently profitable trader, or like myself, becoming a full-time trader. And if you want me to help you when it comes to becoming a consistent and full-time trader, I can't necessarily guarantee it, but I can say I have helped well over 100 students achieve that specific goal. So if you want to work with me directly to get one step closer to that goal and give you the exact step-by-step process that you need to follow to reaching that goal with me helping you, make sure to click the first in the description to learn more about the Arkham University. It is my coaching program. I personally work with every single student individually to help them become consistently profitable within the next 6 to 12 months. Click the first link, watch the video, and then answer a few questions. Let me get to know more about you, and then book a completely free call to talk to me personally. Let me see where you're at in your trading journey, whether you're a beginner or you've been training for some time, and let me help you. And if you truly got a lot of value from this video and you want to test your skills on the real trading markets, make sure to check the bottom of the description to get 40% off your first or your next funded account. Make sure you use code Arkham at checkout whenever you're checking out funded accounts. So that's the second link in the description. Check out Lucid Trading, get 40% off your next funded account, and tell me how it goes. So make sure you guys click that like button, subscribe if you're new to my channel, and share this video with a friend, someone that you want to get into trading or someone that you think would benefit from watching this video. Make sure to share it with a friend, share it with a family member, whatever. Spread the word to help more traders out there. Comment what you guys thought about this video and any positive comments. I'm your mentor, Arkhamtrades. Be safe.